morning. Welcome everybody. Welcome to today's MetaStock conference. We are so excited for this week and everything we're going to be doing and covering this week in this very interesting market right now. Obviously there is a lot going on in this market, so we are very excited to be holding the conference right now at this time to talk about what's going on out there. So let me introduce myself. My name is Kelly Clement. I will be your YouTube, Facebook, Twitch host, kind of taking care of the back end back here. Jeff Gibby will be our conference host, and you'll be seeing mostly from Jeff Gibby. I'll be here in the background kind of helping you out. And then, of course, we have our 39 speakers during this conference weekend. So we're excited to have all of our conference speakers hear a lot about what's going on in the market, the different takes on the market, how to approach the market with different trading styles, and maybe you're going to hear what appeals to you. So stick around, be here for the conference wherever you're coming in from. Go ahead and tell us where you're coming in from. I'm here in beautiful Salt Lake City, where it's going to be a very lovely 85 today, so we're excited for that. So again, say hello, say where you're coming in from. We're going to get started in about 6.5 minutes. I'm going to go check with the GoToWebinar presenter side and make sure everything is up and ready to go, and I'll be back with you in just a few minutes. Again, welcome and good morning. It looks like everything is ready to go over on the presenter side, so we are very excited to start off today. Let's actually show you today's schedule, what's coming up, who we're going to be hearing from. So let me go ahead and bring that up for you to see here. All right, here is the schedule for today. If you are interested, you could actually go up to metastock.com. Oh, let me put that back up there. Go to metastock.com, and up at the very top there is the banner for the conference. You can actually just click right on that, and what it'll do is it'll take you to this page where you can see the schedule for today and the rest of the week. You can also register for lots of freebies that are being given out. If you scroll down to the bottom of this page, you'll actually see a list of all the giveaways that we're doing. So let's actually show you here what's coming up today. So we're starting off with Price Headley. Price Headley is awesome if you are into trading stocks and options. Price is awesome. He really dives into the market and options analysis, and he's going to be showing you his tips and tricks for trading stocks and options today. So after that, we will have Steve Bigalow, who will be talking about candlestick pattern setup. We'll have John Osborn. He's going to be talking about looking at reversals in the market and using the GPS system to identify that. After that, we'll have Tushar Chande. Tushar actually just released a new product for MetaStock that is going gangbusters. We've been
having a promotion with it with the launch of MetaStock 18, and it has been very well received. He's going to be showing that today. John Seville, how to predict explosive moves by following the insiders. Martha Stokes, always a really interesting take on the market because she gets into dark pools and how dark pools affect the market. If you're not familiar with what dark pools are, look forward to her presentation today. Larry McMillan, one of the options masters, is going to be joining us today. And then finally, Oscar Carboni will wrap us up with some great enthusiasm at the end of the day, talking about forget the news, read the charts. And the charts are so important. Excuse me, I forgot we actually have a bonus speaker today. So we actually have one more after Oscar. Sorry, this thing kind of jumps around. We'll be having Tyler Wood talking about why technical analysis works for every investment process. So lots to go through today, lots to learn from. But again, down here at the bottom, make sure you register here, because if you register here, you are entitled to the prizes that we'll be doing throughout the conference. So you want to register here. This will get your name in the system so you can get eligible for prizes. If you're watching on Facebook or YouTube and you haven't registered, you're not eligible for a prize, so you want to register here so we can have you in the system for prize entry. All right. Okay, once again, welcome. My name's Kelly Clement. I am your YouTube host today. We're going to have Jeff Gibby on here in about 15 seconds, and we'll get the conference started for today's event. But make sure you go to metastock.com, click on the home banner up there, and then register for the event to make sure that you are eligible for the prizes that are coming up as well. So let's get this ball started.
Good morning, everybody. Hope you're doing well. My name is Jeff Gibby. I'm going to be here all day. Telling me she's coming in, reading legal disclaimers, fun stuff like that. So I'm glad you could make it. I hope you're doing well. We have a fantastic week lined up of 36 speakers, and all of them are going to be good. I'm going to go ahead and mute this because it's going to bleed into the recording. Anyway, let's go ahead and get kicked off. The first thing I promised was a legal disclaimer, so let's go ahead and do that. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock should have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So I want to say welcome, everybody. For all of you that are chiming in and saying where you're from and saying hello, appreciate it. Hello, Anton, Brett, Siobhan, Rick, Jose, and then a bunch more on YouTube too. Welcome. Thanks for coming. I hope you're doing well today. Hope you're excited. We really do have a terrific lineup. Before we get to the speakers, I do want to say thank you to Stocks and Commodities magazine. They've been making stocks and commodities trading articles since 1982. They've got 1.3 million subscribers. They've done 17,000 different trading articles in their archive over the years. And hey, if you're watching this on YouTube and you want to basically want to get a free issue, you can come in and register at the conference link, and I'll actually include that a little bit later. So also want to say thank you to the CMT Association. CMT has been sponsoring the event for a number of years, or actually, well, a year now. So, but they do a great job. CMT is a really, really well reputed organization. We appreciate them. And of course, we're MetaStock. MetaStock's been rated #1 in its price category for 29 years in a row. We're going to be talking a lot about market scanning and finding the best opportunities, testing trading ideas, and how MetaStock can be just a really, really good toolbox for helping you do that. So we'll talk a lot about that this week and kind of why it's been rated #1 for so long. But that's who we are. So our first presenter today is Price Headley. Price has been a friend of mine for, decades now. He wrote a book called Big Trends in Stocks and Options. So one of the things, and I say this every time I introduce him, but one of the things that I really, really like is kind of Price's ability, or his mentality, I should say, and his ability when it comes to the market, and the ability to kind of focus on really kind of those best opportunities that exist in the markets. And I'll let him talk more about his own mentality and kind of how he comes to the market, but he is certainly a well-reputed person. He's won a whole bunch of times the Timers Digest Market Timer of the Year. Great technician, good friend, great mentor of mine. Price, let's go ahead and get you started. How are you doing today?
There we go. I'm doing great, Jeff. How are you? How are you doing today?
Doing really, really well. Let's go ahead and make you a presenter here.
Fantastic. There we go.
I'll make sure we can see your screen. How are you doing?
Just fantastic. You know, markets are, keeping us on our toes, but that's the great thing about trading is that if you know what you're doing, folks, you can find opportunities on both sides, up and down. Obviously, no better year than this year to remind people of how to make money from the downsides. We're going to cover both of those today. Jeff, I assume we're good to go.
Yeah, I can see your screen. I can hear you well. The floor is yours. You bet.
Well, it's great to be with you and to kick off this awesome full week of training. Jeff and I were talking about it's our biggest one ever with 36 speakers. So you're going to have a ton of great information to soak in. And my objective for you, like Jeff was alluding to, is finding the bigger trends, leaving the little fish, throwing those back, the little trends, the little moves, if you're scalping for the little tiny profits, you'll find that works until you get run over by the big trend going the other direction, right? So I feel like you're better off to focus on the bigger move up and down and know how to identify it. We're going to focus on stocks and how I convert those stock ideas into options ideas here for the rest of 2022 and of course beyond. But the principles apply whatever vehicle you trade. If there's any trend period, what I want to do is factor that's where I want to be trading in that vehicle. And if it's not trending, you say, oh, I could trading range it. I could trade it from low to high. That messes up your mentality when it comes time for the bigger trend. My view is I'll rotate to the next opportunity in some other sector, some other area. So I'll be sharing with you a variety of MetaStock charts here with my Big Trends toolkit. That's a part of the MetaStock add-on that I'll have Jeff tell you about at the end of my presentation in this hour. But really want to just remind you, of course, that I'm going to be looking at the current markets, but that everything we talk about here is for education and informational purposes only. What we share with you here should not be considered a specific recommendation or buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and the staff are not responsible for any trades you choose to make. And not all Big Trends products and services and strategies we talk about even here are going to be appropriate for all traders and investors. So consider what's right for you or what's not and make your own judgment on that. We don't provide any personalized financial, tax, or legal advice at Big Trends, so do consult your tax advisor before you make any investment that impacts your unique financial situation. Now, what I trade a lot of different things, and it doesn't have to be something that I created, although I may have tweaked it, as in the case of my friend Larry Williams with his %R, % range indicator. The Big Trends approach is more about finding when something's going overbought and staying overbought. So we're looking for those launches. As you know, when you think about a space shuttle launch on this picture here, you think, well, what's happening to get that thing into the air? I mean, you're having this huge expenditure of energy. And we see that same thing in the charts of these stocks that we're going to look at and the markets as a whole, is that there's huge amounts of money. That money moving around is basically energy to tell you what is the net buying mood or selling mood of primarily the institutions. Let's face it, the institutions are the ones driving the biggest amount of money in or out of the markets. And so we want to be able to track that overall launch effect up, or when we have those surges on the downside, we want to be able to see them. And so I use Larry Williams percent range indicator as a tool to show me if something's just chopping around and not really trending, it's not going to really get that overbought or oversold. But I use it as a way unconventionally to show me when it turns into no longer a range, but rather a trend phase. So this can work across a lot of different time frames for traders and investors alike. We'll look at some of those in the MetaStock platform here after I just overview some of these slides with you. In principle, like Jeff mentioned, it's a mentality, it's a philosophy. Whatever you decide to trade, you want to make sure that that philosophy kind of lines up, and more importantly, that it tests well, which MetaStock's a great tool for running through loads of simulations and data to say, does this work across the broad swath of stocks or vehicles that I'm going to trade? Now, Larry used typically a 14 bar setting, could be even shorter, a scale from 0 to minus 100%. So you get these top 20 and bottom 20% readings, but mainly with the idea that most people use percent R as more of a reversal based indicator, based on a philosophy or mentality that stocks cannot stay overbought or oversold for an extended period of time. My philosophy is kind of different. It's quite different. I'm using a longer setting here, typically 2 to 3 times as long. I'm using a 0 to plus 100 scale, more of what I call the grade school scale. We're looking for A plus stocks on the upside. We're looking for F's and worse, the bottom 20% under this 20 percentile level for downside opportunities. And now these extremes, with my belief system, is that stocks can actually stay overbought or oversold longer than you and I would expect, especially your best moves. They don't always keep going, but the idea is that when they do, you've got some really strong institutional buying or selling pressure. The 50 line is kind of a midpoint dividing line, but I really care mostly about these top 20 and bottom 20% readings. So like in this chart, this is a prior move in AMGN. 50 level kind of shows you the general midpoint of that range. And when you're in the top half of that, it means you're on the upside of it. You can see we kind of tested it in one period back here. But the point I really care about here, and the second move was the best move on this chart, the move into the top 20% of readings. That red line percent R going above that 80th percentile. What does that mean essentially? When you think about percent R above 80%, what does it mean? It means if you're looking back over the last month's worth of action, you've got a high-low range of, say, in this case, say we're looking at a stock that's trading between about roughly, say, 40 and 44. If we were just using some easy numbers on a $40 stock, 40 to 44 is about a 10% range, right? Well, if you're moving into the 80th percentile, it means that you're moving up, essentially into that, roughly that 43 plus area of that 40 to 44 range. So the idea being that that's where you say, hey, isn't it at the top of the range when that happens? And what I noticed was when this thing starts breaking out, like here's the setup point coming in back here on this chart, is you don't buy that setup, you buy as it breaks out above that setup in here and say, hey, it's going overbought and staying overbought. And look what happens. The stock just keeps going up and away. And do we ever come out of that overbought zone? No, that looks like a classic flag pattern, if you will, on a price chart. It's the same kind of flag pattern you want to see when you're staying overbought. That tells you the institutions want more. They want to keep buying more, please. And you can see what eventually happens here about a month after that signal is that eventually it gaps up on an earnings report, right? There's the earnings gap. And you see it still kept grinding up and staying overbought. So how can it do that? Because you're getting more and more new highs. And so the range is actually expanding from a range into an uptrend. But you're also not getting any new lows, right? So you can see that you're basically got the classic definition of an uptrend, higher highs and higher lows. That's what the percent range turning into, essentially, I should call it percent trend here. But in honor of Larry kind of helping create this indicator, and me then visualizing it and then trading it in a way that's been so powerful to ride these trends up and the bottom 20% down. But you notice in this chart, by the way, there was a touch of under the 20% level, but it didn't keep going down. This is why I require what I call confirmation. If it doesn't break down below that low of the range, it's still in the bottom of the range, right? So you don't want to bet on a downtrend until it keeps getting sold off further going forward. So percent R is very similar to stochastics. You've heard of a stochastic. It's kind of like an unsmooth stochastic, essentially, in measuring overbought and oversold levels. And I mentioned a lot of people use a 9 or 10 bar, or even a 14 bar setting. I'm going to give you what I use. I'm using a 30 bar setting here. So 30 bars seems like it would be too slow, right? But it actually smooths it out, but keeps it very responsive to keep riding the bigger trend move up or down. I'm focusing on the top 20 and bottom 20% of that. I'm leaving out the middle 60% because that's the little fish. That's the little chop moves. That's the ones that are less certain and predictable in my experience. It's also the noise. As a trend trader, your biggest enemy is noise. So I'm not using a 1 minute chart or something that's going to whip me around too much. I'm tending to use, I'm going to share with you mostly daily charts here today, but I do go down as little as a 30-minute chart when I want a quicker 2 or 3 day kind of a trade. But I don't really like to go down below that in my bar timeframes because the noise will increase on no matter what you trade, what indicators you use. So what we're looking at is that, okay, I'm looking above the 80th percentile and a downtrend below the 20th percentile here. This will work. There we go. Why 80 and 20? You've heard of the 80-20 rule, right? The 80-20 rule implies that 20% of what you do is going to generate 80% of your results. Thus, the other 80% of what you do, probably the only extra 20% of your results. So you want to focus on that top 20% of what you do. And in the case of trading, the top 20% of your trades are probably going to generate the majority of your profits. Likewise, the worst 20% of your trades could probably generate the majority of your losses, especially when you get into options trading and options buying. You've got to really focus on the best of the best setups and not just trade any old thing that comes along. So the bottom line here is that we're going to look for those, and we're plotting the 80 and 20% level on the chart. The result when we did that was that we're able to visualize when we're getting into a trending phase outside of what we ended up calling big trends bands, and a trading range when we're inside of this big trends band. So let's visualize that real quick. So there we've got percent R. You can see going into the overbought area here on this first level, and we can see it. This is a MetaStock past chart of Apple where we'll look at the current chart in a minute, where it's breaking out. Then when we retest back into and just under that band here. That retest bar must hold on that low, or else we get out of that uptrend. We say that if it's not holding that, we say goodbye and move on. Notice we get another test of that coming up into this area right here, and a third test actually breaks, and we're getting the exit as it breaks down under here. So that's the end of that trend there. That was mid-April on that chart. But you see, it led to a phase. We're staying outside of that upper red line there. That's the big trends uptrend band. So we get outside of that and keep going up. We got our bull confirmation. Then indeed, that's where you want to be long. Likewise, you can see another short signals where you break down below that lower red band. That low gets taken out on that next bar, and there's your sell signal at the close of that bar. You see, that one didn't last as long, but we did have a couple of weeks down in Apple there before our retest was violated. Now, you see, by the time it's violated on the retest, in this case, you're giving up your profit by the end of that particular signal. That's why I'm a big believer that if you can catch even part of a trend move, part of your goal becomes to start booking a partial profit at a healthy level. When I buy options, I say, look, if I can get a double on any option I buy, and the same applies actually to stocks, if I get a double even on a long-term stock position, I sell half of it at a double. Why? Because I get my risk capital back for me and my subscribers back into our pockets. And then we say, okay, we want to just go ahead and let the rest of that trend play out for better or worse. And knowing that we've already put our risk capital back in our pocket, we're playing with the market's money is what a lot of people say. I don't really say that because it's still your money. You're my money when we're in a nice winter like that, but we want to manage the trade, but we want to give it a chance. I see so many traders that I coach and work with that come in and say, I didn't get the double. I was happy to take the 20 or 30% gain and move on. And if you're going for a bigger growth strategy, knowing that you're going to get occasionally dinged as well, you've got to be able to follow your rules to give it a chance to go to that bigger gain and not cut yourself short on your winners. Most people do the exact opposite of let your winners run, cut your losses short. They cut their winners short and they let their losers run. That is not the secret to the game. That's why I'm trying to share with you how to do it in a better way here. You can see there's a couple times where we test down into this oversold area for Apple and then we don't break down. So you would not take these as short signals when they're going the bottom 20% because they might test intraday, but they don't close beyond that low, and so you don't get faked out. So this confirmation method I teach really helps you to see how this is going to work. Now you can see here that also, one of the things that Jeff and the team at MetaStock, they've helped me so much to codify what I've been trading for now over 32 years. I caught the trading bug when I was at Duke University right after the crash in '87. I started learning from it, switched my major from wanting to be an equine veterinarian into wanting to trade stocks and options because I saw the power of how much the markets can move and the liquidity, and just essentially just saw unlimited possibilities for being able to use options to trade up, down, or sideways. But the idea is that, look, we want to focus here on some of these indicators that we put into this mix, and these components will give you this type of a broader trend view. So I use a lot of indicators, from Larry Williams percent R indicator, the big trends way. Some got cut off there, the commodity channel index, or CCI. Acceleration bands is something I developed to help me launch big trends in 1999 after making a lot of money on the accelerations in the tech and internet stocks, primarily in the mid to late 90s. Built up my accounts that I can help teach other people how to do this no matter what the next bubble is. What's funny is a lot of people back then said, that's a bubble we'll never see again in our lifetimes. Think about what we've seen since that tech bubble. We've seen so many other bubbles, whether you call it a real estate bubble, whether you call it a bond bubble, whether you call it another stock bubble, and of course then the move in techs, like, and the move in EV, electric vehicle plays like Tesla and many more. And just a whole host of bubbles that are constantly forming and then deflating and reforming. So it's a pattern that repeats, and that's my objective for you, is to understand that when you can catch the next of these patterns as they repeat, you can find your next really big trends. So what Jeff and his team helped me do is codify all these things I look at, including the directional movement, DMI, and ADX lines that Wells Wilder developed, John Bollinger's Bollinger Bands, like a longer term version of that, to tell me when we're really getting bigger breakouts outside of a broader range. When they all start to work and we grade them bullish or bearish, then we get what I call it big trend score, which is essentially a way to go in and rank all the stocks as to how are they doing in their trend components across all these different tools here. So commodity channel index, there it is, CCI, along with the other pieces. So let's look at what a big trend score would tell you. So should you trade that uptrend? And so here's a great example of one that we got a signal in percent R that turned out to be a fake out back here. I'm going to talk about the one that didn't work here on the percent R right here. That buy signal on percent R turned into a loss, and you're out a week later and you've lost money on that trade. But what we need to see on this big trend score is a move again into the top threshold of signals, which it never hit on that signal. So therefore, I would not take that off of just the one indicator of percent R when I can use all the tools of the big trends toolbox and toolkit that MetaStock so kindly helped codify, not just for me, but now for you when you become a subscriber, to add on that toolkit. Notice on this one, that other percent R signal on the left didn't really get the other big trend score kicking in until this second leg of the move. So you missed this sort of sideways fake out right after the initial breakout. It was still a valid percent R trend that did not violate, but you can see you'd much rather be on this steady uptrend phase or staying in that top tier of readings. You saw another one back here where you avoided this first fake out on the percent R here, said that we're not there yet on the trend score until we really get to this phase. And of course, that second leg phase is where you get a much better steady uptrend phase. So beautiful thing when you start to now overlay kind of a overall trend score ranking across the major tools that I've found to work individually, adding them all up for better or for worse. On the upside, the downside, or most of them end up somewhere in between, right? So our goal is to not trade and by the way, on the left side, you see the negative trend score reading, the bottom tier, and of course, a very nice steady decline phase here for Apple that pretty much stayed in effect until we got our exit signal about a little over a month later. So the beauty of this is it'll help you in riding trends up and down, and also kind of saying, are these other ones not strong enough yet? Okay, so that's the kind of overview. Let me go into the current markets and now kind of walk you through the same approach. And we're going to start with the S&P. Reminder, as I said at the beginning, that this is just my read on things. You know, whatever you decide to do is your choice. But the principles are to look for these repeating patterns for me. And so I'm just kind of sharing with you what's worked for me. So like when you look back at this market, you can see at the end of last October, this is the S&P SPY chart on a daily. And you know, it's been painful in 2022 for a lot of people. And indeed, the charts have shown that for the most part, the bias has been on the downside. The first leg down here when we broke down on the %R to pretty much that wave from January 18th to that first low, January 24th, dramatic 4 days down there. Of course, then you saw %R breaking down here back in late April. And you can see that a couple of times it bounced, but those are what we call those bear retests, and that the bear retests have pretty much kept us intact. Do you see what happened on Friday? Another bear retest. The Friday high is now the key high to watch. That high that was marked on Friday on the SPY was 403.18. And you see, of course, we're down a little bit today. So if it closes above 403.18, that's the exit of this bearish move that's been in place since back in late April. So the point is that, yes, that's a bear trend in the short term on the daily chart. You can see some prior bull moves like the one we had at the start of November, where we were going into that very strong big trend score reading from late October. And we got that first big lift right into November 5th, that first peak. And of course, then it kind of cooled off. You can see our trend score losing some momentum here, and the trend is about to lose momentum on %R. So it gives you kind of an early warning there that, yeah, this new high here is a little suspect, as we're not staying up there on the trend score readings. And even this breakout to new highs at the beginning of the year, into December move in the beginning of the year, we tried to kind of hold those gains. %R looked good. Look at our trend score reading. It's at 50. It's kind of it's positive, but essentially zero now would be about just the middle of the neutral, if you will. But it's positive, but not that positive. So it's kind of giving us a little bit of a bearish divergence, if you will, there. And again, that same thing happened with that trend move that tried to happen there in the middle to end of March. And you see it wasn't that strong on the SPY. So the one thing I would caution you on about getting too negative in the overall market picture is it all depends on your time frame. If you say, look, I want to know when I go and look at, say, a super long-term monthly chart, again, I don't have as much data on the trend score on some of these longer-term monthlies, but you can see this is going back to 2003, and you can see the %R has told you pretty well that you should be pretty long here. The only time it actually got short was in the 2008, the literal fall of 2008 into early 2009, and then told you to cover about a couple months off of that bottom. So it caught that quick downtrend for about a 20 to 25% drop in the market in 2008, early 2009. That's the only time we've seen an active short signal in the last roughly 20 years. But look at what we're having happen right now. If we just zoom this in a little bit. So if you just look at just the last few signals here, you can see that each time we pull back into this kind of %R retest range, we of course had a slight violation at the end of 2018, then had to re-signal to get you back on. Same thing with the pandemic low, slight violation of what should have held in the February low of 2020. That was a low of 285. As you know, the pandemic low didn't hit until March 23rd. And so it had to wait to re-signal it here. Well, we're kind of in the same boat here where it's showing us if we close below last month's low, 411.21, that was last month's low in April, that close below there would be the exit. Right now it's below there, so it's showing it will be another buy exit. But if it gets back above there by the end of this month of May, a close above 411.21 would actually keep us in the game on the bullish signal that's been in place going back here to August of 2020. So the point is, we're not in that bad a shape yet. So don't lose your mind here. But you can see that if you do get one of those exits, until it re-signals, like what happened in the early 2008 exit, is we dropped down to that lower band. Of course, I don't want us dropping down here to 270, that lower band right now. I don't think that's going to happen. But the idea is that it bounced back up to test that upper band there up into 150 before then tanking down to 67, right? So the point is it's trading range at that point. It's not even downtrending at that point. So you have to be careful by getting too bearish and wanting to get rid of everything and just say, oh, this market's been terrible. But it's all a function of your perspective. I do encourage people to start with the monthly charts and then work their way down into daily and then intraday action. The biggest problem for the current markets, as you probably know, is, of course, everybody's talking about inflation, but where's that showing up? It's showing up in the bond market, the TLT chart, which has been obviously a disaster since the peak that happened back here in early December on TLT at 155, now sitting at 116.5. Okay, so, and you can see that. Have we been bullish on TLT? Absolutely not. I mean, it's been a long time since it's had a trend score reading over that plus 80% threshold. You see, we just recently had one that started to break down below that plus 80, which was telling you that was particularly a strong short here in this mid-April into late April phase. That was, of course, one of the most vertical moves down. But you can see it's just one of those. We just had another bearish retest on TLT. And so we have to respect that and say, okay, the bear trend is still intact. That high, when it gave that bear retest, that was back there on the 11th this past week. That was just under 118. So you traded above 118, but you didn't close over 118. So if you get a close over 118, that would be where you'd say that it can be out of the downtrend phase. We're not there yet. So that means remember, when bond prices are going down, what's that mean for interest rates? They're going up. And why are they going up? Because inflation's been high. And so, of course, when you look at something like gold, just a quick market overview before we get into the individual stock piece, say, well, gold, of course, was showing finally starting to show that really nice trend. You can see even got our trend score reading popped up to that plus 90 level there. That was on 224. So you can see 224 is a real volatile day up and then back down, but it's saying we're still above that threshold. So from a closing area here around 177, it made a move up to 190 over about the next 7 days. So you can see a very tradable move up on that super strong trend phase. Then, of course, it's a Fed's claim that they're going to crash inflation back down. Gold has come down, and of course, you have to respect the markets and say, okay, when we started to get the bearish signal in here at 427, we've dropped back from 176 to this low about 169 right here. So bears have been in control here in the short term, but not that powerful of a bear signal comparatively. It's a decent one, but not a super strong one with us not getting under that trend score lower red line. That's the minus 80 threshold. So bear trend, but not that strong a one. We haven't been really actively trading gold on the downside, but we've been avoiding it, right? Because it keeps you away from that trouble. Now, when you think about the generals of the market, of course, like an Apple, you think, okay, AAPL.O, had been hanging in until this past week or so, right? It'd been holding up pretty well. Of course, it's had some of those really strong trend score readings, like the one that happened in the July of last year, lasted for a couple of weeks. Really nice trade from 140 to 150. Another nice little pop here in November, and another one in December. Really nice surge to new highs. This latest move, a little more suspect, right? We didn't get the trend score reading when %R broke out and gave us our buy signal. By the time it gave us an exit, a slight loss, the trend score said that was one to stay away from. Now you got close to a really bearish signal, but didn't quite follow through on it. Just hit down on that slam down into 140 here last Thursday, but didn't really follow through. So you can see that, and again, as you zoom in on some of these, we can zoom it in as much as we like, just to zoom in to see the latest action. Say, oh, isn't that a big break of that 155 level? A lot of people would say yes, and it's hard to disagree with that. Also, 150 as another round number. Of course, the bounce that happened right into our big trend span resistance here, this blue line is now the big trend span resistance. You can see that's about 146 3/4. And so you can see we tested up above there, closed above there, but that high now becomes our resistance officially. That was 148.10 on the Friday high. So it closed above there, ends the bear trend that kicked off here on the recent breakdown about a week ago on 5-4, a couple weeks ago now. But anyway, point being that, you can see where these moves can develop up or down no matter how good the company is. There's no doubt that Apple's a good company. The question is, does a good company make a good stock? It can or it can't. It depends on the environment that we're in. And right now, as you see the market kind of getting to even the biggest names in the market, if you look at Mr. Softy, Microsoft, MSFT.O on MetaStock, you'll see that one's acted a little bit worse than Apple. You can see it had that great run before, and look at that big trends band move back there in late October, and the big trend score move that happened and had a test and then bounced back. Then when that started to give it up here, it was saying get out. That quick run from late October into the middle of November is a very nice trade for an option trader. So what we do is, it depends on our strategy. A lot of times we'll like to buy an in the money option. So the stock's giving us a signal, say just for the sake of a round number at 320, we'll not buy necessarily the 320 or the 330 calls. We'll a lot of times buy, like say the 315 or even the 310 calls, and go about 5 to 10 points in the money and be willing to pay a little bit more premium for that particular move. As it goes then from 320 to 340, you can still make a double plus even on a nice in the money option, and really dramatically reduce your time risk. So don't have a lot of time to go that deep into the option side, but just the idea being that if you're making the move from stocks into options, your best sort of a bridge is the in the money strategy. So do some web searching on in the money options. Typically we like to get them about where we're in the neighborhood of about 75 to 80% of the total premium we pay is intrinsic value, meaning that only about 25% or less of that option is time risk. So that means if nothing happens, you don't get wiped out like an at the money or out of the money option trader could if they just sit there and hold on something that's not moving. If it's not moving, you can still have a nice stable base with a deeper in the money option. But you can see Microsoft recently tried to give that %R move again, not anywhere near that big trend score reading. And of course, it's been downtrending here with the latest action. And again, you can just even look at something like the QQQs, so QQQ, yet another one that's been, it's of course dominated by Apple. So it's kind of like looking at Apple, but it's worse, right? Apple's been stronger than the Qs. And you can see that the Qs have been pretty nasty, particularly this little sharp decline in the middle of January. And then this latest one here, pretty rough, right? So the principle is that, okay, we're not out of the woods yet. It's hanging in there today. You zoom it in, you say, are we at a bottom yet? You can't say it's a bottom yet when you're in a active %R downtrend. We're just giving a retest on the Friday high. The Friday high here you can see is 303. And so we're hanging near it here, but we're still underneath that big trends band. So the beauty of this is, okay, once you have this knowledge, everything that I've picked up in my more than 3 decades in technical analysis as well as in options trading is about gaining the knowledge to then see what should be a tradable move and what you should stay away from. A lot of people think because you move out of a day job or even if you're still in a day job, you're thinking, I can't wait to get out of my day job so I can trade every day. And the idea is that you shouldn't trade until you have an edge. You shouldn't trade until the trends are really strongly in your favor, up or down. If we're stuck in the range, you don't want to trade that range. So a vehicle that I'm kind of watching right here, but it shows you an example of the recent range, would be oil prices, the USO oil ETF. Obviously, it had some tremendous moves here early in the year. You can see the really big trend there. We got a slight violation here and then got a re-signal to catch this next really great big trend score period at the start of March. You can see from the start of March where USO was hanging around March 1st, we were closing just under 72. And in a matter of a week, on the 8th, a week later, we were a high of 87, almost 88, 87.83 at the high. So that's a tremendous move in a week, especially for a vehicle that's not priced like a tech stock, that you can really get some great bang for your buck. You see, it's getting close. We zoom in here and say, should you buy it again? Well, it's getting close. Technically, %R will re-signal for us if we close above the Friday high. The Friday high was 81.42. You can see right now it's 81.46. Should we buy it? Wait for the close on whatever time frame you trade. We're on a daily interval here, of course. So we're on the daily, so the principle is you got to wait for the daily close. If you're on the hourly, you wait for the hourly close. If you're on the monthly, you wait for the monthly close. But the principle is, look at how sideways it's been. Now, that's been a positive relative performer against the market, which has been dropping, right? Part of the reason the market's dropping and interest rates are going up is because oil prices are too high. And that's meaning that, I mean, too high is a relative term, but certainly for most of us, paying at the pump and watching when oil prices a couple of years ago were down to $1.50 or less a gallon during that sort of oil glut. Now we're in the other end of the spectrum where we're seeing, that demand's improving and supply is more constrained, and of course, thus oil prices are rising, and thus inflation is rising. So the point is that, okay, we're watching this. You say, well, it doesn't have to clear these recent highs, perhaps, but you see that that would probably add to the acceleration of buyers. It would be better if we had that big trend score going up, which would probably happen later in this next move. But it's one to watch and say, okay, don't be surprised to see USO test back into those old highs up near 88. 85 maybe a first stop, but good chance that we can test up into the upper 80s, maybe even touch 90 on this next surge. So the point is that, okay, you don't want to just speculate on when that's going to happen. You want to see that we get the confirmation with a daily close and maybe start building what I'll do is I'll build a smaller position in the money option. I'm not going to name strikes because I don't want to be giving you direct investment advice, but it's going to be something in the 70s on the strike price I would choose, and saying, okay, this is USO's in the 81 to 82 range. Probably needs to be 82-ish by the time it confirms over 81.42. But bottom line is that I'm buying something in the money. I'm betting that I build a smaller position to start, and then I can add to it if we get a trend score confirming that it's a particularly strong signal. But obviously, oil prices have been one of the firmest things out there. Of course, you've got other vehicles you could trade, like there's these ETFs on the commodities like wheat, Tecrium Wheat Fund. You say, wheat, you see what's happening with the Russia-Ukraine war, and the supplies that Ukraine was providing to the global wheat trade have now been dramatically diminished. So you see this one's kicking off yet again. You saw that first move was massive, and of course our big trend score was really strong there. We had another decent move in November last year. But the principle is we're not quite at that level yet, but watching it because you see it's starting to launch again. We're getting the gap up this morning. And of course, you got the old highs to deal with near 1275. But again, if you've got these constraints on supply in the commodity markets and demand is still there, then you're going, okay, certainly that's something to watch. Of course, another one in this same area would probably be a name like Mosaic, MOS, which is the fertilizer markets have been dramatically affected. Now, this one doesn't look as good. So fundamentally, you say, well, shouldn't Mosaic benefit like those others? You see, it's nowhere near a buy signal. It's actually come off the bottom of a range here, but the time to be in it, obviously, was when we were getting that really good big trend score. Even back here last year, you see, look at that great big trend score reading. Now, one of the things, before I get into what MetaStock can do with explorations, is show you one of my great trades from last year was partly thanks to this big trend score rating. And this was AMC. AMC Entertainment, has been a very controversial stock. The movie theater chain, they actually just recently bought a gold mining, a stake in a gold miner. I think Highcroft is the name. And you see the stock got an initial pop, and now it's down to new lows. Certainly 52-ish week lows or close to it. But the point is that you look back here where things were really starting to break out on my big trend score reading. That was May 25th. May 25th, AMC was trading, memory serves, back in about the 16 to 17 range. Let's see if we can hover over that. See, May 25th, you say, okay, here we are. And we're starting to launch there. So from the morning of the 26th, there it is. So we show a range here between 11 and 17. It's going from about 16 to 18. And we had the 20 strike calls that we recommended for our 333 options, kind of really aggressive traders where we can target a triple, a 10 bagger, and a 30 bagger. And just these, and that doesn't happen very often, right? It's just not going to happen very often. But it doesn't take very often to make your year. In just those roughly 4 or 5 sessions, the stock went from the mid to upper teens to a high at 72.62. Okay, so our 20 strike call went from in the neighborhood of you can see from the neighborhood of roughly a couple, $2.50 or so, up to more than $50. Everything is so. I think we're in from under $2, actually, from like $1.60. We need like 48 to get our 30 bagger. We got it when it got to about 68 or 69, and cashed out, and we're done with it. Now, obviously, we haven't seen, even with these attempted rallies on %R, we haven't seen that same trend score reading since. So no interest since. But and you can see it had even a down period here in the middle to end of January. You saw that was a more steady downtrend. You can see from about 19 down to about 14 or 13. So, you know, it's a nice little short tradable move there. But the point is that, you know, this is what we're looking for. So you say, okay, so how do we go and find these moves? It's really cool what MetaStock offers. They've got something called the Explorer. And so you can actually back test with the system tester too. But once you have your system, and of course you've got my big trends toolkit. We scroll down here to the B's and the toolkit add-ons. BTT3 it's called, has a whole host of more than a dozen indicators and techniques and strategies that you can use. And so one of the ones that I'm using here is this big trend, BTT3, Big Trends Toolkit, third version here, the big trend score. And I'm doing this as an exploration. So when you do the exploration, and I had actually just recently run this, and it looks like I need to rerun it here. But basically, when I ran it recently, it showed me that, okay, look, this is what you'll see. You'll see something like this that shows you, okay, I want to just look at all the U.S. optional stocks. One of the great things about MetaStock is, in my opinion, they've got the best data in the world. Okay, you've got the ability to not just track U.S. equities, but even things over Europe, Middle East, Africa, and go all over here and see all the other vehicles that you can trade down into South America, et cetera, if you so desire. But I like that they've just got a U.S. optionable list, which you can see is 5,500 names. So when I choose the big trend score reading and I say, okay, go ahead and choose that optional stocks group there and run this as an exploration, and then basically it'll give me a list of names that are worth trading. And I looked at it earlier, and basically a few that were jumping out at me. I'm not going to show the whole list. You can do that when you become a MetaStock subscriber and get the Big Trends Toolkit add-on. But one of them was H&R Block that was popping up, and you're like, really? A tax provider? Look at that move that it's been making over the past 4 sessions. Sure, you know, what are the things that are sure? Death and taxes, right? And so it's like H&R Block is well positioned to continue to serve people on kind of a requirement that we've all got to face on filing taxes. So the bottom line is that you can see that that's actually just given a really nice big trend score reading. I'm not telling you you got to buy it. I'm just saying it's in that leadership position on the upside. It's interesting versus some of the names, like as you've seen recently, like the move in crypto, and you look at a name like, say, Coinbase, you type in coin.o here and select that one. And of course, you know what's been happening with that one, a true disaster in the making, right? I mean, this thing, I don't have enough data on it to go back far enough because it just IPO'd back here a year ago, last May 20th. You can see it shows an open here at like 236. By the way, one of my rules on IPOs, if you're a longer term investor and you're considering buying an IPO, one of my rules on IPOs is I don't buy an IPO until at least it has a 50% haircut. You say, well, aren't you going to miss some great moves? It did have this rally right here. I'm saying, yeah, I will. But you know what? My experience is that typically there's so much hype around IPOs, initial public offerings, that if you're one of those speculators on the front end, you're going to get burned more often than not. Even going back and looking at a name like Facebook, and now called Meta Platforms, of course, even if you go back and look at from the time that they IPO'd, you say, okay, well, show me the beginning of Facebook. You say, okay, you go back here to, you know, that it had a move from 40 down to under 20 before it actually, I don't show it on here, but basically it moved from 40 to 20 and then eventually went on up to 200 plus, right? So same thing with like a Snapchat, you know, so snap.o. So, you know, the point being that if you buy into this stuff on the IPO, you're setting yourself up. Oh, it's not coming up for some reason, but you're setting yourself up for problems in buying the hype. Okay, so be careful with that. It doesn't mean you should buy puts necessarily. It just means you should wait on that. So again, and if you look at even a name that hasn't been around that long, like say the Bitcoin ETF, BITO.K in MetaStock, you can see that we don't have enough data for our trend score, but you can see even just there was one tiny period where maybe you could have gotten a buy signal that retest would have violated when it closed back under here. So you would have lost on that trade. If you're buying it off of that breakout at about, you can see here in the neighborhood of roughly 28 and stopping out back here around 27. So you're going to lose on that one, even though it went to 30 in between, unless you take some real quick profits. And that's not how I tend to think. You're not going to get our double on that move typically. But you see, since this last about a month or so of action, you see it's been in a classic downtrend. We've had multiple retests. Each of these last two retests have been very good resistance. That first one in here, you can see, was hovering around that 25 level, and then this next one was just under it, 24.97, and it got pounded down here to 17 and a quarter. We had a bounce Friday back to 19 and a quarter, and then today we're back to 18 and a half. This is still an active downtrend on the percent R. You can see the last one here, it just IPO'd here back in October, right? Up around 40. Again, the principles of the cut in half from the IPO, we've now satisfied that requirement. Should you buy Bitcoin yet? No. But the point is, okay, at least you've fleshed out that initial hype of, by the time, how are they launching it? They're launching it because the perceptions on Bitcoin are optimistic. But the point is that, okay, there's opportunities on both sides. And one of the ones I was noticing from my exploration that I did before we got started here, on the downside, one that was popping up here more than a week ago was Bausch Health, BHC. I'm not telling you to get into this because we've already seen basically a 50% haircut in the stock in the last 2 weeks. You say, how can you bet on the downside when the stock's already down so much? And the point is, hey, look at that going into that kind of classic May 3rd and May 4th really extreme signal there. So you can see we're getting a bear signal at about 19.4, maybe call it 19. And you see then it gapped down here to start of last week to $8. So it got cut more than 50% over those 5 or 6 trading days. So the principle is, okay, let's be ready to take advantage of next opportunities and making sure that we can go in and go find what's really poised to lead. Another one that was showing up on my scan here that I ran thanks to MetaStock was this VNTR here. And so, or actually, I'm sorry, it was VRTX. I take that back. VRTX, I believe, Vertex. So Vertex Pharma, I believe, was the one that popped up. VRTX.O, select that. Again, these are not recommendations, but just helping to guide you. So that one had popped up previously, actually. So you can see it was making that strong move. When the rest of the market was tanking, VRTX was going vertical from about 260 to 292 over those first couple of weeks of April. Once it told you to get out, of course, you don't hang around and hold on and hope it's going to bounce back. If you've got an exit signal, you must get out and move on and look to come back and play another day. Same thing happened back here, 12/9 into the end of the year. Nice little steady trend move in VRTX Pharma. So the point is that you can look at a whole lot of these and figure out, okay, what's the general setup of the markets? What's the general setup of stocks you should consider owning or not owning? So like one I was looking at, because you think, well, gold miners should benefit, right, from a higher inflation period. You see GDX is the gold miners ETF, and it had a brief window of opportunity here. You can see it back here, March 1st, that same move that we were talking about with GLD. This was the gold miners ETF, the major gold stocks like Newmont, Barrick, and the like. It had that quick week of action where we went from about 36 on up and pushed to 40 and a quarter. So that was a more than 10% move in those gold miners stocks in a week. If you can get a 10% move in a stock or an ETF like that, and in the money option, it's typically going to give you a chance to make between 50 and 100%. So if you make that in a week, I'd say you'd be pretty happy with it. You can see that's the only period that it would say to trade that whole chart on the upside, despite all the inflation talk and hype and hand wringing about, CPI came in last week at 8% plus. Everybody's saying, well, sure, the Fed's going to put a dent in that with their future hikes that are almost assured of a half point in June, a half point in July. We know that. But the point is, of course, the market was telling us that was the time where the inflation was really the biggest concern for the markets, and gold was giving us that brief inflation hedge window to take advantage of that upside pop. Now, of course, it's gotten popped on the downside, though not as strong of a bear signal as we would typically want to see. So it goes back to whatever vehicle you like to trade, you can type it in and you can say, okay, is this one giving me an opportunity or not? You know, there's been names like, I want to show you one with US Steel here, ticker symbol X. And US Steel was really good to us back here in March. We caught it for our Grand Slam option subscribers as we got that kickoff here at the start of March. You can see this thing was just starting to move here. It was about 28 bucks. We bought this slightly out of the money call for a Grand Slam. It's a more aggressive service. And you can see that you had some retests even on the big trend score line, but you actually didn't violate that retest coming out of there until it gave us this exit here in the mid 30s. Now we were already long gone. We had taken a double and a triple on it and said, okay, thanks very much. We'll take that and run to the next opportunity. It went a little higher afterwards and then crashed back down. You can see, of course, that even the best leaders, you thought, well, why is US Steel rallying? Well, there was talk of global recovery and that the Fed was not going to be able to dent that, at least initially was the hope. And now, of course, that hope has been dashed, partly due to just the market weakness. But bottom line is that, hey, you see why you've got to respect the trend lines and don't get caught in any story betting that some stock's going to outlast the averages, right? Because that's where we talked about Apple, Microsoft. Of course, you know all about the other big crashes like in Netflix, you know, which again, you say, well, should I buy or sell Netflix? You know, what should I do with it? Well, you can see the trend is still negative. It's actually giving a violation on our, look at how incredibly negative it was on our trend score, staying in that really oversold phase, I should say, since that last gap down after the second earnings miss. See the first earnings miss, it got the brief bounce back as people were hopeful. By the way, do you see that we were getting a strong sell signal before the earnings? Do you think that could be powerful to help take advantage of an earnings gap? Sure was there. And point being that, okay, then it chopped around. Even though it edged lower, you can see we were doing nothing on our trend score data, and of course had a violation on the percent R here, which was led to that bounce. But you see the bounce hit up into the overbought territory, couldn't keep going above it, and then of course started to roll back down, and then of course kicked into gear with a strong down signal after the next earnings gap, and then that has just ended as we just came back above it at the Friday close. So the point is there's windows of opportunity in the markets. There's windows where the window opens and you can go through it, and there's times when the window or door shuts and you don't want to try to walk through it. So the point is you see these windows of opportunity, and you want to be able to take advantage of that while knowing what not to mess with when it's no longer clear. Of course, you think about a name like Amazon. I mean, again, Amazon is not tradable for a lot of traders yet. Because it's been such a high dollar stock. Do you know what Amazon's about to do? It's about to split its stock, I believe 20 for 1. Now, when it was at 3,000, that was going to be about $150 stock after the split here in the next week or so. You can see down in the twos, that's going to get us closer to about 100, or right now about $110 a share-ish, which is going to make the options trading in Amazon a lot easier to buy an in-the-money option and manage the time risk. If you were before, when it was at 3,000 buying an in-the-money option, you might have to buy like a $200 in-the-money option and pay $300 for it or something, or 3 times 100, meaning like 30 grand to control 100 shares of stock. That's not doable for most traders. Now it's going to be very doable, where you can get in for 1,000 or less, even on an in-the-money option post-split, in my expectation. But you can see Amazon's been big trouble since the earnings gap day. You can see back here on May 2nd, big gap down, big miss on earnings, and that was still just under 2,500, and of course on its way to almost 2,000 over the last couple of weeks. It has bounced, but you see it's nowhere near coming out of this downtrend yet. You can see we're kind of even up into kind of a test area for the big trend score. So a good chance that it probably retraces back towards 2,000. And so this bear retest area would be a better risk reward, closer to 2,300, frankly, but still a decent risk reward here, but not ideal yet. But we're watching it. But the point is, to keep out of trouble. You say, okay, just don't try to buy and say, oh, that was a double bottom back there, and think that you're home free as it bounces into mid-March from, you can see 2,700, it popped up to as high as about 3,400. You'd feel like a hero if you caught that exactly right. But the point is, you can't expect to catch exact highs and exact lows. And in fact, you've got to think more in terms of structure of the markets. Is the structure of this stock bullish or bearish. And you can see essentially that we'd had a prior set of lows in the 3,200 range. We'd pop back up to 3,200, came down to test 2,700, got a hair above 3,200, but of course gave it up quickly. And of course now the longer term resistance is going to be up into that 2,700 level when it does ever retest and try to fill that gap. If it does fill it and close it back to 2,700, that'd probably be a classic resistance area, given all the buyers who were hoping that that would hold and now hopes have been dashed. So point being that, okay, I'm not saying I'm perma bearish on Amazon. I'm just saying you want to pay attention to that. Use the tools like the Explorer and go in and find new opportunities where I'll pop up. Okay, I can search all the optionable stocks for any of the big trends, whether it's big trend score, whether it's a percent R, Larry Williams percent, our breakout system. We even have a retest system to find those kind of retracements. And I love MetaStock, how I'm hovering over that, and it's telling you even the retest system is based on lower risk entry points, and this is something that Jeff and his team and I worked on to help guide people through what these systems can do for you based on different tools that I've used over my 30 years of stock and options trading. So it's really a powerful tool. Of course, the goal is to guide you into the right stocks and also to learn how to start profiting from the downside. Still too many people have this sort of one-way view of where's the great opportunity to buy this market? Well, while you're waiting for a buying opportunity, you could be missing tons of opportunities to make money trading put options, even being in and out quickly. And of course, you can even do this on intraday timeframes too. So I use a lot of stuff on like a 30-minute chart. For the Amazons and Apples of the world. You can see how many bear opportunities. Look at these bear opportunities on a 30-minute chart on Amazon. Golden 2-day trade there on a couple of these windows here. Should you trade it right now? Not according to that indicator I was just mentioning, but what about if we looked at Apple and you think about Apple this past week when it was getting slammed? Did the 30-minute, hold on, I typed in the wrong one there, AAPL.O. You think, okay, how do we do on Apple this past week? Do you see something happening here? Yeah, at the end of the day, at end of the day, Wednesday into Thursday. And of course, you see just really super strong decline phase there from that 148 area down to the low about 139. And then of course, now it's back into that range. So the point is, there's going to be opportunities to take advantage of this stuff, even on intraday trades. I mentioned Coinbase. Again, Coinbase is not for the faint of heart. It's a very pricey option, and that's why you've got to, I believe, trade it more in the money and not pay that super insane time premium. But look at where this thing went down into basically this kind of super strong downtrend phase as it started to pop down there on the 9th. Stock was 92 on its way to eventually hitting 41 basically. So about a 60% haircut, and 55% drop in a matter of just a couple of sessions. Insane, right? And again, even if you say I'm not going to trade the earnings, I'll just catch it in this couple of days before the earnings. You can still catch it from down about 20 points or 20% plus over just those couple of sessions pre-earnings and trade the in the monies and get a nice bang for your buck, even with the earnings volatility, because you buy intrinsic value. It helps to get rid of the time and volatility related premiums that you normally pay for options. I know my hour is up. I know there's a lot of great speakers ahead today and for the rest of the week. So make sure you stay tuned to this phenomenal lineup of speakers. And I'm going to hand it back over to Jeff so he can walk you through how to take advantage of this Big Trends Toolkit at MetaStock's best pricing for attendees today. Thanks, Jeff, for having me.
Price, thanks for coming in. That went quick.
That's fine.
Done already, right? All right. We did have a quick question, and I'm going to answer that. I do want to say before we let you go, thanks for coming in. It's great to have you.
Oh, always a pleasure.
And appreciate all the work you've done with us over the years. What a great session. I appreciate it, Bryce.
Thank you. It's a lot of fun.
All right. Thanks. Thanks again. All right. I hope you guys are enjoying it too. Let me go ahead and just do a few things here. I just need to kind of get swapped over. I need to make myself the presenter. Yes. I need to show my screen. So though, unfortunately, we don't have a lot of time for questions with this one. But one of the questions came in via YouTube. And the question was, I think through Andrew. Andrew wanted to know if it will recommend specific options that you could buy. And with this particular methodology, it does give a lot of very, very specific advice. And so I just want to show that real quick. This is one of the methods that are included in the Big Trends toolkit program. You can see right here, we've got the big trend score breakdown. There's a bunch of information in here that I really don't have a lot of time to talk about. But what I'm going to do here is you'll notice right here, there is a setup and there is a buy signal. This is ExxonMobil. It's the stock that I've kind of pulled up. Great stock so far. This year has been a little bit sideways for the last month or so, but certainly has had some dramatic moves before that. Here we got a buy signal, but I wanted to show us this basically combines all of the methodologies that Price, all of the indicators that he uses, and scores them all together. And it's just based on all of the indicators that we call it the score breakdown. It's one of the like 14 or so methodologies that are included here. So here we have the setup, here we had the buy signal. And what I wanted to kind of zero in is really specifically how it's telling you exactly what option to buy. So here it's saying, okay, the BTS indicator has recently crossed above an 80. The price has also broken above its current high. This indicates a long opportunity. And here to answer your question, Andrew, traders interested in taking advantage of this could buy the stock. You could buy the call option 2 months before expiration. So it's giving us an idea of what time we'd be looking at. Aggressive traders will typically look at call options one strike out of the money or near the money that cost 200 or less, while conservative traders will typically consider the call option with more intrinsic value, with one strike in the money. And then it's going to go on and give you information about how you should get out of the signal. And I wish I had a little bit more time. We are completely out of time to kind of show you this, but I do have a couple of slides that we'll talk a little up to it as well. Let's go ahead and go right here. And we'll just start the slideshow here. So we did work with Price. We were on our third iteration of the Bring Trend Toolkit. It's been one of our most successful add-ons that we've released with Price. It incorporates all of the methods that he talks about in terms of, in his books, Big Trends on Stocks and Options. I had to think about the name real quick, but it includes all of these methods. So there's one that's built on Bollinger Bands, acceleration bands, the Big Trend score, which I just showed you, the DMI difference. All of these are unique individual methods that we've put together based on Price's methodologies and the way he likes to look at stocks. And by methodologies, that includes the ability to like go in, scan with our expert explorations, see what stocks have a condition that might be beneficial today. You can ignore all the garbage that exists in the market and just focus on the ones that have a buy signal or a sell signal. It includes that expert advisor and the commentary that'll get really, really specific about what you should be looking for, what the system is doing, why you should be getting a buy or a sell. And that commentary is awesome. It does include the ability to test these trading ideas to see not only what stocks they work on, but how well they work on broad markets. It includes templates and all the indicators necessary to run it. Again, this is a product that has been so popular, we've made 3 versions of it. And we created it starting, oh man, it was one of the first projects that I wrote when I went into business development. And that's gotta be, gosh, 20 years ago. So 20 years ago, we created it. It's been very popular. We've been iterating it over and over again. And we're on the 3rd version. So normally, the cost of the add-on is $6.99. That's a one-time cost, so you don't have to pay for it over and over and over again. Here at the show, we're going to give you $5.99 as a conference promotion. We're going to give you a 30-day money-back guarantee, and we're going to allow you to try that out. If you're new to MetaStock, maybe you just stumbled across the YouTube channel today, MetaStock has been rated #1 in its price category 29 years in a row. We'll give you a trial to MetaStock as part of this purchase. To do it, you can give us a call at 800-882-3040. You can visit online with us if you have questions that you want answered. Go to metastock.com/saleschat. You can also order at metastock.com/conf-promo. This particular add-on has been super popular. People really, really like it. I'd encourage you to try it. And we do have a low-risk opportunity for you, 30-day money-back guarantee to try it. So $5.99 here at the conference. 30-day money-back guarantee will include MetaStock if you don't have it and you want to try it, and you can find out why it's been rated for #1 in its price category for 29 years in a row. Actually, I believe it's the correct number there. So I do want to say quickly, as we kind of migrate to a different speaker, I want to say thank you for the CMT Association, for them for sponsoring the event today. They've done a really good job. They're a very, very well-reputed organization, and they've done a really good job in supporting us. cmtassociation.org if you want to find out more information about those. So, okay, Gary, I do see your question. I'm going to type an answer for you just because of time. So there we go. We did talk about MetaStock. We'll be talking about MetaStock all day. So our second guest today is Steve Bigalow. You're going to be surprised to find out that he's another good friend of mine. I also really have had the privilege of traveling around with Steve a lot, doing a lot of webinars over the years. I love the way he combines his very unique candlestick patterns with trend identification and moving averages, and the methods that he used are some of my favorites. I mean, one of my favorite patterns to scan for using MetaStock is called the doji best friend, which is just a doji followed by a gap up, and he'll talk about that. But Steve, it's been such a pleasure to work with Steve. He's such a nice guy. He knows what he's talking about, and I've learned a lot from him over the years. So let me go ahead and let's bring you on here, Steve, and hopefully we can hear you okay. All right, Steve.
Okay. All right, great.
I can hear you.
All right. Do I want to put on my camera? I don't know whether that would add any benefit to.
Well, it's up to you. We love seeing you. But it's totally, completely up to you.
Okay. Whoops, I didn't clean up my office, so. But that's nothing new. Okay, now let me show my screen. Now I got to figure out which screen I'm showing. So let's see.
The one I see, the one that says welcome to GoToWebinar on it.
Okay, so that means I need to go here. Whoops. I'm trying to hit.
Are you trying to change the monitor that's being presented? Okay,
yeah.
So right under show my screen in the GoTo console, there's a little down arrow, and it'll list all your monitors.
Okay, now I got to guess which one it is.
We usually use a standard process of elimination.
Okay.
Perfect.
Is that,
first try. Yeah, that's the
that
right
it?
one. Yeah.
Candlestick high profit trade setups?
That's it. I can see it.
Okay, great. All right. And I guess I've got the screen up for taking questions.
Mm-hmm. I'm going to make sure that you can see them right now. So you should be able to now see the questions that come in.
Let's see if that works. So there it is. Okay. All right.
Perfect. It's all yours, Steve. I'll get out of the way.
Okay. All right. Thank you, Jeff. Thank you, everybody. Every time I do this, my first request is to see how many people have seen my candlestick presentation. That gives me a little bit of insight as to how much time I need to spend on each of the charts. So I guess if you've seen it before, click in Y. If you haven't seen it before, click in N. And I don't know whether that's coming up in the, is it coming up in the questions?
Not yet. I don't think we have a lot of responses yet, but we will probably. There's a lot of people here. So
okay.
If you've seen Steve talk before, there they are. No,
all right.
no,
okay.
yes. You can see it. Can you see them?
Yep, I can see them.
Okay, perfect.
All right. Well, I'm going to assume that it looks like maybe a few people haven't. All right. I always start off by telling people that when I came across candlesticks, I had gotten out of the brokerage business because I had discovered that the analysts on Wall Street had no more idea about what made prices go up or down than the man on the moon. So I got out of the business, and then somebody brought an antiquated, ancient information on candlesticks. And it took 3 months of them prodding me to look at it because I had been a stockbroker. But unfortunately, or fortunately for myself, I was one of the worst investors in the world. And that's why I got out of the business, because I couldn't find anybody that showed you how to invest correctly. So after 3 months of them prodding me, I finally picked up the information and I looked at it. And the first thing that came or whacked me in the side of the head was, this makes sense. So everything that you see on a candlestick chart is just common sense put into a graphic depiction. And when we did that, this is why we've got Jeff has put a very effective scanning product together for MetaStock, because everything you can write into a formula is just common sense. So I'll let Jeff explain all that at the end. But I always tell people, when I first started learning candlesticks, I wanted to learn everything I could because I was just a greedy son of a gun. Unfortunately, I didn't have anybody around to give me a second opinion to see whether I was doing it right or wrong. I always tell people the only time I could get a second opinion back then was when I'd go to the doctor. I'd say, "What's wrong with me?" And he'd go, "You're fat." I said, "Well, I think I want a second opinion." He goes, "All right, you're ugly too." So when I started learning candlesticks, I wanted to learn everything I could. What I discovered was that there was, out of the 50 or 60 candlestick signals, there was only 12 you needed to learn. Basically 6 bullish candles, 6 bearish candles. So that helps us find those most powerful trades. This is what we're looking for. We're obviously, everybody's looking for that big price move. This is one that I always illustrate because I was showing my brother how to do it, and we bought at 73 cents on OCGN back when the COVID situation was big, and he got out at the $17 area. Now, obviously, not every trade is like that, but the nice thing about candlestick analysis is just reading what's happening to investor sentiment puts you in the situations where the probabilities of being in big trades are greatly in your favor. So this is what we're always looking for, the patterns that the Japanese rice traders have illustrated for us as being high probability results. This is a fry pan bottom. You can see it looks like a fry pan bottom. And this is the area that allows us to get in knowing that there's a breakout coming out of a pattern. As we go through this, you'll see that I've got stochastics on my charts. And my stochastics are 12-3-3 slow. And the concept is very simple. The Japanese rice traders said if you see a candlestick buy signal in the oversold area, more than likely there's a reversal. If you see a candlestick sell signal in the overbought area, more than likely there's going to be a bearish reversal. So the logic was, if you saw a candlestick buy signal in the overbought area, it didn't mean very much. If you saw a candlestick sell signal in the oversold area, it doesn't mean anything. You want to see the signals that are in the appropriate place of the trend. So this is what we can look for. If we know a fry pan bottom looks like a fry pan bottom, where do we look for a breakout? Right where that pattern started. And what do we expect from that result? A very strong price move. Because this basically is a buildup of investor sentiment, and this is the breakout area. So we can use the combination of candlestick signals and patterns to dramatically improve our probabilities of being in the right trade at the right time, and not only the right trade at the right time, but very strong bullish price moves. And that's, again, what we expect coming out of a fry pan bottom is a strong price move. So I'm just going to kind of take a step back. Here's a doji. A doji is where there's indecision between the bulls and the bears. It looks like a little cross. But we have a doji rule. The doji rule is the price will usually move in the direction of how they open after a doji. So if we see this pattern setting up, and it's right here at the breakout level, and it opens positive the next day, even though we're up here in the overbought area, we can be buying immediately because we know exactly what that's telling us. That's telling us this doji sandwich, which is a bullish candle with a doji, opens positive, means it's going to trade positive and produce another candle the same magnitude as that candle with our doji sandwiched in between. But we know what the results are. First of all, we've got a fry pan bottom breakout, number one. And number two, we know the expected results of a doji sandwich is that there's going to be more upside. As I'm talking real fast here, if you have questions, don't be afraid to ask the questions. I've got the question box right here in front of me. So anyways, this is where you can make your big money. Now, here's the difference. Remember, we're looking for candlestick buy signals in the oversold area. A pattern will usually break out when stochastics are in the overbought area, because that's where the exuberance starts coming back in. So this is what we look for, is the pattern and the breakout. And what do we expect at the breakout? Usually very strong price moves. So this is not rocket science. This is just taking advantage of the information that the Japanese race traders have produced for us for over 400 years. And there's only one basic premise of candlestick signals and patterns. They are the result of human nature that works the same way time after time. So I've studied in my 40 some odd years of investing every single technical or technical technique, I guess that's a redundancy, that you can come across. The most accurate I have found is that the candlestick patterns and signals tell you exactly what human nature is going to do time after time. So we know we can look for a breakout, price move. We know that this is called a classic pattern. There's your fry pan bottom. What do we expect coming out of a fry pan bottom? A strong price move. There's your indecisive pullback right to the T line, and I'll get to the T line here in a minute. The T line is one of your most effective, if not the most effective, technical indicator of what's happening in human nature. But there's your J-hook pattern, which is also a very high probability trade setup, trade pattern. And it gives you not only a calculation of where this next move is, because if this is wave 1, wave 3 is usually going to be the same magnitude. So here's what we're looking for. Indecisive trading, and there's our breakout. This is what we call the RARE process. Research, analysis, reverse engineering. Do we just chase after a big price move like this? No, this becomes the alert to say, hey, there's something new happening in investor sentiment. Let's go see what the news was. Well, if the news is something that's indicating that there's going to be more bullish sentiment afterwards, we can be buying with much more confidence. Look at our doji sandwich. And I don't know. Oh, so this is the T line. This is everything that I have put in my training or my analysis of candlestick analysis is to get rid of the worst thing that I have in my trading, and that's my emotions. Everything I do is to keep my emotions out of my trading. So the T line is the most effective indicator you can use with candlestick analysis. The T line is the 8 exponential moving average. It's got Fibonacci characteristics, means it acts like a natural support and resistance level of human nature. So on our charts, we have the 200 simple moving average and the 50-day simple moving average. The reason for that is every major money manager around the world uses those moving averages to make their decisions about what they're going to do with their portfolio. We don't use it to make our decisions. We use it to see what everybody else's decisions are at those levels. Now, the T line is the 8 exponential moving average, and it has a very simple T line rule. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. I've also got the 34 EMA on here. As you can see, my charts aren't that, I would say, boggled up. They're pretty plain, because the most important factor of seeing what's happening in investor sentiment is the signal itself. So conversely, if you see candlestick sell signals and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. And why is that important? Because if you were anything like me, that if I had a profit in a trade, what's my first fear? Boy, if I have a profit and I don't take it and it goes back to being a loss, boy, would I look stupid. So now I just basically use this rule because there's a very strong correlation that if you're trading below the T line, the bearish sentiment is in control. So the nice thing about candlestick analysis is we can put multiple factors into our analysis. Look at the flat handle. A lot of people say, well, that's a lot of resistance level. Notice when it pulled back, we started seeing buy signals down here in the oversold area. Now we started seeing more buy signals. You can see the little scoop pattern. And then you can see also they brought it up above the T line. So we look at this not as a resistance level, but this scoop pattern says we are going to get a slingshot effect to the upside. And once again, how long do we hold on to this? Once it breaks out, we can either be buying here with the anticipation of breaking out through this level or buying here. And how long do we hold? As long as it doesn't close below the T line. However, there is a caveat. And the caveat is the further away you move from the T line, especially up here in the overbought area, the higher the probability it's going to come back and test it. So that would mean if I saw a sell signal up here way away from the T line, I'm getting very ready to close out that position. Why cannot we pause and rewind? Oh, hey, you can, because this is a live session. All right, and then here's another method. Candlestick signals, the definition of a candlestick signal is it is a graphic depiction of everybody buying and selling during a specific time frame. So you see this is your best friend signal. There's your doji gap up. Do you want to be buying here or buying here or buying here? How do you know? Simple. You go to your 10-minute chart. And as long as your 10-minute chart is still trading above the T line, you could be buying. How to get this T line? It's very difficult. You put the 8 exponential moving average on your chart, just like you would put the 50-day moving average on your chart. So we know what patterns to be looking for that produce high probability results. This is your J-hook pattern. Here's wave 1. Notice how it pulled back indecisively right here to the T-line area and then started back up. What do we know about a J-hook pattern? If it breaks out, wave 3 is going to be the same magnitude as wave 1. We have a much better visual perspective because we can see how investor sentiment is getting indecisive down here and then starting back up. So even if you miss this move, you could be buying here, whether you're buying stock or calls or spreads, because you can now calculate what this next price move is going to be. Same as this right here. And why is this so accurate? Because human nature works the same way time after time. So why could we be buying right here? Because of the doji rule, which very simply says the prices usually move in the direction of how they open after a doji. So what creates high probability trade setups? Look at the doji sitting right here on the 50. What's that tell you? Everybody's starting to decide to close out their short positions and start buying. And then what's our confirmation? There's a doji followed by bullish confirmation and a close above the T line. What's that tell me about my entry strategy? If it opens positive the next day, I could be buying. Whoops, a little bit dicey. But what do I know about the doji? If it opens positive the next day, there's my doji sandwich. After bouncing off the 50, the probabilities are pretty strong. The bulls have taken control. the best friend signal. Now, there is about, as I said, there's 12 major signals, 6 bullish, 6 bearish, out of the 50 or 60 candlestick signals. The reason I've narrowed it down to that is when I was first learning candlesticks, I'd go back through chart after chart after chart and say what happened here at the top, what happened here at the bottom. And as I went through it, I kept coming across signals, and basically the 12 major signals, way more often, not even way more often. Probably those 12 signals occur 99.9% of the time. So I've written 3 books on candlestick analysis. And what I usually tell people is you don't need to learn all 50 or 60 signals. Learn the 12 major signals. You will always have more trades and better analysis of what's happening in a trend just from those 12 major signals. But that doesn't keep you from browsing through the other 50 or 60 signals, not to learn them. But if you recognize them, you can say, oh, that's a signal. I better be, let me go back and take a look to see what that signal is telling me. So the best friend signal has powerful ramifications. If you see a doji, especially in the oversold area, and they gap it up, that tells you after that day of indecision, they've told you which way they're taking it. Not only does this produce a high probability of a bullish direction, but usually a very high profit direction. Are the related candles volumes important? No. When I set up my trading universe, I'm trading stocks that are trading greater than 5, because every time I buy a stock, I want to get as much margin or much leverage as possible. And most brokerage firms won't margin a stock less than 5. And I'll usually also make a qualification that I want to see more than an average of 200,000 shares a day traded, because that does 2 things. One, it creates the candlesticks signals more fluidly. And 2, if I want to get in or out of a trade, I don't want to be sitting around for 3, 5, 10, 15 minutes closing out the trade. I want to have it executed and go on to the next one. So that answer is prices don't move based upon volume. Prices move based upon price. And that's what we're looking for. Now, that doesn't mean that if you happen to see a big volume spike the day of, the day after, the day before at the reversal, that just acts like a little bit more confirmation fluff that there's been a major change of ownership. So this is what we're looking for. Do all the trades work like this? No, but every time we buy something right here, we know we can stay long as it stays above the T line. There's your best friend signal. What's it setting up? Wave 1, wave 2. When they're gapping up from a doji, that means there's going to be a lot of bullish sentiment coming into that trade. Whoops, I'm running way behind. There's a J-hook pattern. There's your doji sandwich. There's your best friend gap up, telling you there's more upside. We can expect wave 1 and wave 3 to be the same. So again, this is not rocket science. You don't have to know formulas. You don't even have to know technical analysis. However, if you do know what a head and shoulders is and all the other technical indicators, you can see a lot more clearly what's happening at those levels that everybody else is watching using the candlestick charts. So not only is the best friend bullish, but you see a doji gap down. Once again, look at the analysis that made this very simple. Look where this is, a doji that far away from the T line in the overbought area. You get ready to take profits, or on that day, probably would have taken off half the position. If it opens lower the next day, the doji rule, you close out the trade immediately, or you get ready to go short. Same thing right here. Stochastics up toward the overbought area, doji. Notice they gapped it down. Your Barry's best friend. Not only did they gap it down, they gapped it down below the 50, which everybody is watching, and they gapped it down and closed below the T line. And why is the T line that effective for us? Because nobody has the T line on their chart. That's what makes it so relevant, is that you see the price of or prices support and resist at that level, at a level that everybody else doesn't have on their chart. Jeff, does he go into the exploser? I don't know what an exploser is.
I think he means to explore, but I will briefly show that, so don't worry about that.
Okay. All right. So here is your strongest signal, the kicker signal. The kicker signal is merely where you see them open here and close here. The next day, they gap it up above the previous day's open and go the opposite direction. Essentially, investor sentiment has been kicked in the opposite direction. This usually produces a very strong price move result. Now, you add that fact to that you have a big fry pan bottom. What are we looking for in a fry pan bottom? A strong breakout. And if the candlestick kicker signal is your strongest signal, it's pretty much illustrating there's a strong breakout. You can be buying. Even though your stochastics are up here, what's our expectation coming out of a fry pan bottom? A strong price move. What's the indicator that tells us they're buying excessively, breaking out of the fry pan bottom? The kicker signal. What is the indicator from the bottom? These are stochastics. My stochastics are a slow 1233. I'll see if I can get something that's, so if I see, this is what we call a bullish flutter kicker signal. Notice you had a bearish candle. The next day they gapped it up and did a doji. Well, what was the alert? The fact that they gapped it up above the previous day's open and did a doji. Now, this is just as relevant as a kicker signal, except this one has better qualities to it. It gives you time to figure out what to do. So if it opened positive the next day, if there was a kicker signal in progress, I'd be scrambling around trying to find money, so in another position maybe to buy it. And on a bullish flutter kicker signal, I'm already prepared. Say, well, this gapped up, did a doji. I found this on my scan. So I'm getting ready the next day that if this opens positive, I'm buying, whether it's I'm buying calls or stock, because I know if this trades positive, I've got a strong bullish flutter kicker signal. And the reason we call this a flutter kicker signal is you take out this little flutter and you essentially have a kicker signal. All right, thank you, Dan. So we recommended CPNG today because there's your bullish flutter kicker signal. Now, if we didn't see it on this day, we're ready to buy on this day if it starts trading positive, because we know this is one of your strongest signals. Where do you think the next price move is likely to move? Up here, at least to the 50-day moving average. This is a trend kicker signal. Notice how it opened here, closed here. Then they gapped it up and did a indecisive day. I mean, that shows strength. And then if they open it positive, what's that telling you? You got a trend kicker signal confirming the fact that the breakout of this fry pan bottom was creating that very strong price move. Kicker signal, right smack dab at a fry pan bottom breakout. Tells you you've got a lot more upside. And the message, these are just things that human nature does time after time. The message is they've gapped this up, and notice they opened it here, but they closed it here. That's not very bullish. But what was the message? The message was they gapped this up with great enthusiasm. Now what do? We watch for the selling to stop and the buying to come back in, because that was the message to tell you there was new investor sentiment coming in. All we had to do was wait for that the selling to stop and then start buying. So this is where I call 2+2, where if you see a flat handle, you see a bullish engulfing, there's what's one of your major signals. Then you see a doji sandwich. closing right here at the T line. And so if it opened positive today, the next day, what's the logic of your entry? Because they're confirming this, and now they're telling us the T line's not acting as a resistance. And what do we expect coming out of a scoop pattern? A strong slingshot effect. Wave 1 starts with a doji sandwich. Wave 2 starts with a bullish engulfing. So essentially, we don't have to be a technical analyst. We don't have to be a fundamental analyst. What we're doing is a lot of people say, well, don't fundamentals influence your decisions? And the answer is no, because all we're doing is analyzing what everybody else's decisions are based upon their fundamental analysis. Breakouts. There's your best friend breakout. Again, 2+2 analysis. J-hook pattern, breaking through this level. Candlestick logic says if they broke through this level, starting with a J-hook pattern, that means this wave is going to take us up much stronger without any resistance. J-hook pattern, this time they came up through the 50. Notice what happened when they came to the 50. Doji, doji, indecision. And then positive trading, wave 3. These are just high probability results, and these aren't rare things. These occur every single day. Every day that I do a scan, I come up with more trades than I can handle. So now the process is, which one of those trades have the highest probabilities? So my supply is way above my demand for what I need each day. So that allows me to scan for the strongest trades. I'm looking for the breakouts. Come and look at all your dojis sitting right here on the T line. This is called a T line crunch. Thanks, Silver. So as soon as it broke out, what are most people afraid to do? Boy, I don't want to be buying up here. I'm gonna. Here's one of the things I always chastise people for. We see a breakout, and they say, "Oh, I'm gonna wait for it to pull back so I can get in at a better price." The fallacy of that reasoning is twofold. One, if it's pulling back, why the heck do you want to be buying it? It tells you the buyers aren't that strong. And two, it tells you think you've got the immaculate execution process, that as soon as you wait for it to pull back and you buy it, it's going to turn right around and head right back up because you bought it. I'm buying into strength because that's the expectation of what's happening when we break out. Patterns work just as well on the bullish side as they do the bearish side. A dumpling top. So this would be the opposite of your classic pattern. Dumpling top, bearish J-hook pattern. We started shorting Carvana. Look at your bearish engulfing, close below the T line, kind of a dumpling top. And how long did we hold this? We just started covering here in the last couple of days. And what kept our emotions out of anytime we saw a potential buy signal of closing out the trade? Because they couldn't close back up above the T line. Netflix. Price was mentioning this one. Look at your dumpling top and then your bearish kicker signal. What did that tell you? I told you the bears were in control. There wasn't any bullish sentiment. You stay short until you see a buy signal and a close back up above the T line. Are you trading stocks in daily or 15 minutes? Arnaud, anything you want to. Because candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame, I used to trade the E-minis off the 1 minute, 3 minute, 10-minute combination. Right now I trade cattle, soybeans, because I can't trade as often. I use the 10-minute chart as my bellwether if I'm intraday trading. If I'm swing trading, I'm just using using the daily charts, because my swing trades are usually going to last anywhere from 2 to 10 trading days. Now, if I get into a situation where we're moving way too far away from the T line, I'll flip to my 10-minute chart. But everything that is done based upon human nature and these charts is just common sense and a common sense trading atmosphere application. Amazon, as you can see, came down, popped back up, and look where it failed, right smack dab at the 50. And look what happened here. They closed it back below the T line. And then look at your bearish best friend. What'd that tell you? There was still a lot more downside. So you get much more clarity as far as what's going on in investor sentiment, knowing what the charts are telling you. PayPal, dumpling top. Look at your gap down. Look at your J-hook pattern. Another downtrend. Little kicker type signal telling you next wave is down. Right now, I think it's just hovering today around the T line. Roblox, same scenario. We were short. Then it did a J-hook pattern. Now we're long because this is your inverted hammer. This is one of your 12 major signals. An inverted hammer is a reverse psychology. If you're short, you're happy, you're happy, you're happy. And then all of a sudden there's a big bullish day. And if you're short, you're sitting there saying, oh man, I'm awfully nervous. And then you're relieved. By the end of the day, they've closed it back down here. Then the next day they start taking it positive, and everybody that's short saying, oh, shoot, the bulls are still here. I'm going to close out my short position. This is an extremely high probability reversal signal. Now, this is only from my own statistical analysis over the last 30 some odd years, that if you see an inverted hammer in the oversold area and it trades positive the next day, the probabilities are probably 95% or greater that you're going to be in an uptrend. So I just advise people, if you search for the inverted hammer, see what the results were. You could see, I think, where was another one? There was a little inverted hammer type signal right here, and they popped it up. No, I won't go through all 12 major signals. We don't have enough time. But Jeff will show you where you can find them doing the scan. So the T-line is a very important factor. That if you see a reversal, especially in the market itself, on Friday we saw a morning star signal in the Dow. Today it was trading lower. Right now it's only off 64. But we have one major confirmation that tells us there's a reversal. You need a buy signal and a close above the T-line. That makes charts like this, like NVIDIA. There's our morning star signal, closed right on the T-line. What do we want to see before going long? We want to see if they're trading positive. We don't want to see them opening down here and trading below the T-line. Trading below the T-line is a very powerful indication that the bears are in control. And the way you want to see a reversal is to see a buy signal and a close back up above the T-line. So candlestick analysis is nothing more than identifying the signals and patterns that are created by human nature. Human nature is the most consistent indicator in the world. It's worked over the last 400 years. It's going to work for the next 400 years because human nature works the same way time after time. And I guess Jeff will go through the scans that produce the high probability or identifying the high probability signals and patterns. So that's about all I've got. Are there any questions on candlestick analysis? Now, I usually, now that we got an extra minute here, I usually tell people you do not have to overanalyze candlestick signals and patterns. They work very effectively. And I illustrate it by the lady that brings her parakeet into the vet and lays it down on the table, and it's just laying there stone cold dead. And she goes, "Can you help my parakeet? He's been my best friend for years." And the vet says, "Well, I'm sorry, but I think your parakeet's dead." And she goes, "Oh, no. Isn't there something you could do? I mean, he's been my best friend." He goes, "All right." So he goes out to the back of his clinic and brings in a big cat, lays the cat next to the parakeet on the table. The cat sniffs it, looks up at him and shakes his head and said, "Ma'am, I'm sorry, your parakeet's dead." She goes, "Oh, no. Isn't there something just to make sure? He's been such a good friend." And he goes, "All right." So he goes out to the back of his clinic and brings in this great big Labrador retriever. The dog puts its paws up on the table, sniffs the bird, looks up at the vet, and shakes his head and says, "I'm sorry, ma'am, your parakeet's dead." She goes, "Oh." So they go out to the front desk, and he said, "All right, well, that'll be $250. She says, "You're charging me $250 just to tell me my parakeet's dead?" He goes, "No, ma'am, I would have done that for $18. But then he wanted a CAT scan and a lab report after that." So I tell people, you don't have to overanalyze candlestick analysis. They would do the same patterns. Silver, yes, on all futures. Remember, candlestick analysis is the graphic depiction of everybody buying and selling during a specific time frame. It doesn't matter what the trading entity is: stocks, bonds, currencies, commodities, tulip bulbs, anything that has fear and greed in it.
I do have a couple questions for you from YouTube.
Okay.
If you've got it, since we have an extra second or two. Blue Cry 2000 says, "This is going great." He did ask, what is the recent move for Netflix, and how do you define a top in that case?
Ooh, let me go back. Hold on, I've got the darn cat here at my desk bothering me.
That's a first. I haven't seen the kitty before. I didn't know you had a cat until today.
She knows exactly when I'm on a chat on Netflix. Is that what he was asking?
Yes. Mm-hmm.
All right, let's go back to that chart. Next one. Netflix, you could see, was rolling over up here. Now, what was the top? Well, that's the definition of a dumpling top or a fry pan bottom. It's just a junky trading range, but the visual aspect of it is you can see that it's rolling over, creating that dumpling top. So if you were thinking of going long or short, when it closed back below the T line and the 50, you should have been short. Now, could you have projected this? Definitely not. But the caveat I always put into my explanations are, if you're below the T line, the probabilities are greatly in your favor. The bearish sentiment is in control. Yeah, this cat wants to check out the parakeet.
I was giggling about that. Okay, one more from YouTube, and I think that'll catch us up on YouTube, actually. Do you have any suggestions for avoiding whipsaws on the T line?
No. If you're starting to see whipsaws at the T line, what's that telling you? That's telling you the price isn't going anywhere. You don't have a trend. So it's not that you should be alerted to it. It should be that you should analyze and say, "Hey, wait a minute, they're going up and down, up and down. I don't want to be in this trade. Get out of this trade and move on to something else." What we're looking for, I mean, I can't even find anything here, but if this was bobbing up and down above and below the T line, it's basically telling us we don't have any idea which way they want to take this. And the whole point of candlestick analysis is, because of the signals and the patterns, we can project with a much greater degree of probability which way a price move is moving. So if we get into something where we can't tell which way that price is moving, there are 9,500 trading entities out there. Just move on to one of those.
All right.
So I hope
one more.
Okay.
And I promise this is the last one because we.
I was hoping that explained it well enough. Go ahead.
Yeah, I think so. Tarzan, and I'm sure that's his. I've seen his movies. Wants to know if on a doji sandwich the candles have to be the same color on both sides on the sandwich.
Yes. Let me go back again here. Whoops. The difference, if you have, let's see, I'm trying to find a doji sandwich. A doji sandwich would be, this isn't quite a doji sandwich, but it would be a red candle, a doji, and a red candle. Now, I don't know how far back I've got to go to find that if you have a red candle in a downtrend, and then the next day they gap it up and do the doji, and then open positive after that for a bullish candle, that's now a flutter kicker signal. So both of them give good evidence that there's going to be either a trend reversal like a flutter kicker signal or a doji sandwich, which implies there's going to be more to that existing direction. I'm trying to find one on here real quick. Back. Can't find one yet. There's kind of your doji sandwich. But if this opened lower, if you're in a downtrend below the T line and you see that doji, we know that if that opens lower and trades lower, you're going to have a doji sandwich, which is a very high probability trade setup. It does work for Forex. Yes, it works for all trading entities. I was answering Sandra's question. All right, so do you want to show them how to use the scanning for these, Jeff?
Unmuted.
Whoops.
Oops. All right. So Silver says, thank you. Excellent presentation. I always enjoy your presentations, and we do. We love having you on. Thank you for spending some time with us. I am going to show the scanning now that my microphone is unmuted. But okay. Thank you, Steve. I appreciate your coming in.
All right. Thank you, everybody. Have a good day.
All right. Thank you, Steve. All right. And let me go ahead and kind of change over. One of the things that I did want to show, I'm going to go ahead and make me the presenter and show my screen. This is the same chart that he was looking at with Netflix. And he had drawn that big, nice looking dumpling top on the chart. And one of the questions that came up that I thought was interesting is how do you, where do you start to see this as being bearish or more bearish on Netflix? And, I think if you just kind of look at the patterns coming in here we had that dumpling top. We did have a bearish harami. There's a bullish engulfing in here, but then you had a left-right bearish. You had a bear kicker, a dumpling top. All of these are going to be automatically labeled for you. And if we just look at the patterns, I think it's pretty clear that the bullish interest in Netflix is kind of going away. And if we're just looking at that dumpling top, we detected it for you automatically, not only here, but also here before that big, huge gap down. And that is something that you can absolutely scan for. And I can't remember the name of the person that was asking for scanning, but it's really, really easy. And I want to kind of just, because Steve gave me a couple extra minutes to kind of talk about it, I want to show you how easy it is to run scans in MetaStock and how that works. And so here you can kind of see a good idea or an example of all the patterns that we're identifying. I do have a list of the patterns that we want to do. I'm going to show that in the side deck in just a second. But if I wanted to run our Explorer, if I wanted to find, like I said earlier, one of my favorite patterns is the doji followed by the best friend, what Steve likes to call that indecisive bar followed by the decision. If I want to find that using MetaStock, all I had to do is come into the scanner right here. We'll click on the Explorer, and they all start with CPS. So I've got this Doji Dynamite scan, the J-hook patterns, the major patterns, the power signals, and the price patterns. These universe scans are more to kind of set up a watch list. They look for stocks that are over $5 and have a certain amount of volume, and you can run those and just kind of narrow down the list of the stocks to kind of the recommendations that Steve has. What I'm going to do just to show this to you, I could select all of these patterns. I could run all of them for you, and I'm going to go ahead and select all of these patterns, but we'll just show you. It's going to run just the first list and then the second scan and the third list. I can show you what they're doing. And I can scan anything that I want to. With the Reuters, the Refinitiv data that we get, we cover, I know there's a lot of people from India. You've all said hello. Bangalore we had. We get a lot of customers that are in Australia, that kind of stuff. And it doesn't really matter, Forex. If you're interested in something here, because of the market coverage that we get through our partnership with Refinitiv, you're going to be able to find it. We have about 200 plus exchanges that are available. And if you just look at this number right here, there's 313,328 instruments that I can scan. Now, of course, you're going to want to narrow down that to the markets that you're interested in. If you're here in North America with us and you just want to do optionables, you can just scan the optionables, and you just select that option right there, and it's going to scan those optionables for you. I'm not going to run this list against the whole optionables. Instead, what I'm going to do is I'm going to come down here, and I'm going to have it scan. There's a list called the index constituents. And so I'll have it scan the Dow Industrials. I'm going to put a check mark here. I'm going to go ahead and find the S&P 500, and we'll put a little check mark in that. And then we'll just run that scan. And the reason I'm selecting a small list is I'm almost out of time already. So let's go ahead and click on Start Exploration. It's going to run through that Doji Dynamite scan. It's going to, and you'll see how fast it's chunking through that 500 stocks. The reject rate right now is 100. So 100% of these stocks we're not interested in on the Doji Dynamite patterns. I'm going to have one to show you because that number just went down to 99, meaning we had something I can show you. So it's going to finish with this relatively quickly. It will probably run faster for you, but I'm broadcasting it, audio, video. Kelly behind me is also looking at YouTube comments and Facebook comments. So it runs a little bit slower if you have less bandwidth available, of course. And just the amount of sharing that we're doing between YouTube and Facebook and Twitch and GoToWebinar, we're using a lot of bandwidth right now. So, okay, anyway, so if I'm looking for those Doji Dynamite patterns, you see that's done. If I wanted to find a Doji best friend, I could look at Edison, or I could look at Entergy. Those are the only two out of those 500 stocks that would have a Doji best friend, okay? Here we have Doji at the top. The 0 says these are not patterns that exist. Left, right bullish, left, right bearish. And so you just kind of look for, if you're looking for a specific pattern, it's easy to find. Here they are, Doji best friend. You can see it's still chunking through that list, but I think you get an idea of how easy it is. And I have exactly 1 minute, so I think that's probably where we're going to leave the scanning demo. It's super easy. You can scan just about anything on Earth that you want to find, and it will allow you to, again, one of the things, I use this every day because I don't want to look at 500 stocks. I want to look at the two that have the opportunity. So if I can just, and Price talks a lot about this, if I can ignore those stocks that lack opportunity and focus on just the ones that have them, that's what I want to be able to do. This is, somebody called it the garbage collector, and I've remembered that. It was one of our very first summits that we did. He called it a garbage collector. It takes out all the trash, you can focus. And by being able to focus, you know, we're looking at 2 instead of 500. It allows us to find those opportunities, and we're not all of a sudden looking at thousands and thousands of stocks trying to find it. Let's focus on the ones that have. We could look at both of those stocks and decide we don't like them. That happens to me all the time, but I'm looking at 2 instead of 500. So it does have scanning built into it. As you can see with kind of the chart we were looking at, it does have all of the patterns that it's identifying on the chart for us. And all of those are defined. So if I go in and I click on this left-right bullish pattern or this dumpling top, it's going to give me a plain English definition. This is what the dumpling top is. Here's what you're looking for. It applies all of the analytics for me and allows me to kind of focus again on the thing. So if I don't know what these patterns are, they're going to be illustrated to me. They're going to be described to me. It's so helpful. especially if you're learning, you're new to Steve's methodologies and you haven't traveled across the country with him or listened to him speak for 300 times. You know, it's very, very helpful. So let's kind of move on just back to the PowerPoint real quick. We are on the second iteration of Candlestick Profit System. It's been hugely popular. It's an add-on I'm really, really proud of. And here's a listing of the patterns that we're identifying. We've got the fry pan. I'm not going to read these all off. We organized them into categories: price patterns, doji dynamite, power signals, and J-hook. All in addition to that, we've added all of these single bar signals, which are just the doji, the bullish engulfing, the bearish engulfing. Again, I'm not going to read them all. We just don't have time to read them all. In total, I believe it's about 30 or so patterns that are identified for you automatically. And in total, I mean, this is a very big add-on. It includes those 6 explorations I was showing you, the expert advisor. It's got 3 different layouts, 36 patterns. One of the things that we did as part of creating the CPS2 is I actually, I realized that a lot of people that are new to MetaStock probably wouldn't know how to run scans or use the expert advisor or, you know, that kind of stuff. So if you're new to MetaStock, what I actually sat down and did is I created a 40-minute training session that just shows you how to get the most out of the candle profit systems with MetaStock, how to run the scans, how to look at different symbols, how to apply the expert, how to make sure you could look at the commentary. And it's a very, very, it's only a 40-minute session, but I tried to make it very, very helpful for you so that you could understand exactly, so you could get off running with it. So with the CPS2, the other thing that we're going to do is we actually sat down with Steve and we recorded a special set of series where we did powerful profits, learning to analyze big breakouts and 5 of the most powerful ranked top signals. This was a paid session. We charged about $500 for it, if I remember right, back at the time, but it's all recorded and it's available for you as part of it. And what we're going to do today is we're going to put together that particular training and the 2.0 in a pretty nice package. So as part of the package, you can get the Candle Profit Systems 2.0, the newest version of the add-on. You can get that Steve Bigalow training that I was just talking about. If you're new to MetaStock, we'll give you a free month of MetaStock real-time, and the Zenith market data will include all of that data for free for the region that you're interested in. We'll include a training video that's a comprehensive set of videos that Kelly recorded, and those will be available for you. And we'll actually even have somebody that will help you get everything installed and walk you through any questions you have. We call it a white glove installation appointment. So normally, all of this would be available at $1,200, and it's a bargain at that price. Our normal retail price for the add-on is $499. And so what we're doing here at the conference is if you just buy the add-on, we're going to throw all that extra stuff in there for you, and we're going to back it with a money-back guarantee. So you can pay $499. That'll get you to the Steve Bigalow, access to the Steve Bigalow CPS 2.0 stuff, all the training, all the recorded videos, etc., all that kind of stuff. If you don't like it, your risk is going to be you'll get a refund. So great risk reward. I wish we could get that in all of our trades, especially right now in the market, but a good way for you to try it. To take advantage of it, give us a call, 800-882-3040. You can visit us online at metastock.com/saleschat or metastock.com/conf promo. So appreciate that. Hope that makes sense for you, and give it a go. It's one of our most popular add-ons. So there you go. We will take a moment to thank our sponsor today, Stocks and Commodities Magazine. They've been a great sponsor of all of our summits and our conferences that we've done over the last 10 years. We've been running them for 9 years now. So if we round properly, we can say it's almost a decade. They've done 17,000 trade articles. They've been writing about how to do technical analysis since 1982, and they've got over 1.3 million subscribers. They do a great job of helping us with the events, and we really appreciate that. So if you do any of the offers today, one of the things, if you spend more than $300, you're going to get 2 years as a subscriptions to Stocks and Commodities. And if you just sign up, you'll get a 5-month subscription. For if you just sign up for like a MetaStock trial, anything under $300, you'll get 5 months from Stocks and Commodities. So we really appreciate them for sponsoring the event and showing, helping us with it. It helps a lot, and we appreciate it. So Okay, I have something that's a little bit out of order here. And I swear I checked this. Okay, so our next presenter is John Osborn. John works with, I think I actually just missed a slide here. John is a great presenter. He did a lot of programming for the value charts. I'm going to figure out why my slides are a little bit out of order in just a second, but he's been working with us for a number of years. One of the things that impresses me particularly about John is he's very, very well organized. And in addition to that, he does a really good job of programming, but also talking about the methodologies that he uses. So, John, let's go ahead and get you on here. How are you doing?
I am doing good. Can you hear me?
I can hear you great. Yeah.
Oh, great.
So let me go ahead and turn the time over to you.
That's the easy part. Now, selecting the right screen is always the challenging part for me.
Hey, we use the process of elimination here. I was just, nope, not right. Okay, so it should give you the choice, and I'll let you know what we see when we do it. I'm also going to make you the organizer so you can see all the questions as they come in.
Okay, that sounds good. There we go. I think we got the right one. Do you see my title slide?
I can see it. Yeah, it looks perfect.
All right. Great.
So I'm going to get out of the way. It's all your turn.
I don't hear you anymore.
Oh.
Now I hear you.
Okay, good. I was like, I didn't do anything. Yeah, we can see everything. I'm going to get out of the way. It's all yours.
Okay, sounds good. Well, welcome everybody, and happy noontime or good morning if you're from the left coast, and happy afternoon if you're on the East Coast. I'm John Osborn, and thank you for that introduction, Jeff. And it was always good to see the Steve, the presentation before. I always love his candlesticks. So I use candlesticks in almost all my trading as well to confirm things, so it's really helpful. So I'm here today to tell you something that's going to change the way you look at your charts forever, because you're going to be able to learn about some new technology that we have that's able to route traders through a chart to find the best in trades, just like a GPS. Or if you have a dog, they can help you route your chart too. Hold on a second. So help you find the best trades, just like a GPS can help you get where you're going, even if you've never been there before, right? So that's what's great about a GPS is you can turn it on and have the confidence to go into a new area and be able to get where you want to go without even doing that before. And that's one of the nice things about GPSs. So I do want to talk about some disclaimers here, and that is, you can read through this if you'd like. Just some pointers that trading is risky, as we know. In fact, we need that risk. That's what helps us make money in the markets here. And we don't want to trade with money you can't afford to lose. Now, we've done our best to ensure the accuracy of the information I'm going to share with you. This webinar is going to give you information to help you make your own independent trading decisions. And a reminder that past performance doesn't necessarily indicate future results. Markets are unpredictable, so you want to be prepared. Here's CFTC Rule 4.41. That's the government wants you to know that trading has both rewards and risks. We know that. And again, don't trade with food or rent money. I'm not soliciting you to buy any stocks, options, futures, or any other securities. And I always suggest that you paper trade any new strategy to make sure you're profitable in paper before you even think about using real money. That way, so you have real money left to trade when you're able to follow the system and use the tools. So today, we're going to talk about how to completely transform, and I chose that verb specifically. When it's going to change the way in a transformational way, because you're going to be able to seriously grow your account by using a very powerful technique that I like to think of as a stock market GPS. Now, I want you to think for a moment. Imagine yourself using the markets in a different way. And if you're frustrated with markets, this is a powerful exercise. Think for a moment what it would be like to wake up and every day you have the guidance that our traders are using every day, where our traders have doubled, tripled, quintupled their accounts with it. This market GPS technology lets you trade with pinpoint accuracy, just like a hedge fund does. That's right. Hedge funds can use this kind of technology. Why not you? Now, do you think if you had something like that that could help you identify where those trades are like you would through an unknown city, do you think you could possibly improve your trading? Like, could you see a tool like this help you drastically grow your own account? Now, if you've never thought that was possible, or you've been frustrated lately, especially in this down market where a lot of people don't know how to trade in a down market, I have some great news for you. It's totally possible with the tool I'm going to show you today. Now, I'm talking about change, and keep imagining with me for a moment here. I want you to think about not just minor inconsequential change. It's about, this is technology that's been in use by our best traders, and it's been used in powerful automated trading systems that we've sold access to. Now, today, you're going to learn what we mean by a stock market GPS and how it's going to improve your trading. This, like I said, this is not incremental. This is a fundamental way to identify trading routes that lead to profits in the stock markets. Like this one here in NVIDIA. This is a $97 per share gain in just 25 trading days. We got the signal on NVIDIA at the beginning of April, and there's still even more potential for this to go further. I don't know if we'll find a bottom here in the market or not. The indicator doesn't say so yet. So we're going to keep an eye on this one. We're still staying in, you would still stay in this position because there's no signal to get out yet. So this one would still be a trade that if we were short in this, we'd still be in it. And like I said, transformational trading like this one, this is a 700% gain in Tesla. That's a $789 per share using this technology. So who am I? Let me give you a bit of history about who I am and illuminate why I'm so passionate about helping other people like yourselves to pull money out of the markets. Now, I've always been interested in the markets, and as a kid, I watched my dad trade. He used newspapers. Right? Every day you'd have to wait for the newspaper to come in. There was no internet or anything like that. So you'd look at the final closing price using newspapers. And he would read magazines and other articles and use his understanding in his career. And it turns out my dad's, at least to me, he seemed like he bragged more about what he did wrong more than what he did right. But he did okay in the markets, and he always thought he could have done better. So he was the one who got me started in trading, got me excited about it, and he made sure I understood that the stock market is how you can keep ahead of inflation, unlike a bank account or other things. And he said it's one of the few places where you're going to be able to get where you want to be when you set your goals. So I heard him say that. I watched him do it. And I dabbled with trading here and there as a kid and even as a young adult. But like my dad, I did okay, but I wanted to do even better. And I started trading more and more actively in the 90s. Of course, that's when the dot-com era was going on, and even monkeys were making money then. I saw the end of that easy money made in the 90s, just as I was really starting to gear up in my trading. So what I realized when the markets turned around, and I didn't have that training that I needed to be able to trade markets in the other way. It's kind of like it is right now. And what I thought, I said, I'm going to just go out and get whatever training I need to learn how to do this right. And then I can teach my dad so he can enjoy trading in the markets too. Well, it turns out that that was a lot more complicated than I expected. It took a lot more money, and maybe some of you have been there, and time than I ever imagined. When I finally learned what it takes to be successful, to be a successful, confident trader, unfortunately, it was too late to share it with my dad. And since I wasn't able to teach my dad, I now teach others like yourselves about trading so you can reach your own goals. And if I'm able to teach you, and you might even be able to teach other people. And maybe some of you have your own father or your mother or son or daughter that you can teach. And I know that helping so many others to achieve their own goals in trading is something that would make my dad proud. And that's why I love to share ways to pull money out of the markets with traders like yourselves who are genuinely putting in the time and effort to learn how to trade. So let's learn how to pull more money out of the markets, all right? So what you're going to learn today is I'm going to let you in on a technology that can help any trader be a better trader. I'm going to explain how this tool can make a huge difference in your trading. And like I said, it's going to completely transform the way you trade and revolutionize the way you pull money out of the markets. And I hope that you will share this with your own family and your friends to help them achieve their own goals. So when you're making money, you'll have other people who are also making money to go do the fun things that you want to do. Let's get started. So I started with an example here. This is something where we talk about trading on the wrong side of the mountain. I want to see if you can relate this to your own trading. So here's an example of where traders can misinterpret what the market is telling us. And this is a common pitfall a lot of traders will do. They don't have all the information they need to be able to make the right trade decisions. So we see a really nice run higher, right? Especially this gap up. So now we're raring to go here. In fact, we saw it move up, and even Steve talked about this, a possible pullback. We look for these pullbacks here, and then what do? We get in right about here, right? And we jump in right here. and up it goes, and we're good, right? Well, unfortunately, it doesn't always happen that, or it doesn't always work out that it follows through for us. In this case, even though we got in here, the market went there. And you can put in whatever expletive you'd like to add to there. I would certainly say something if that happened to me. So when that market pulls back, we bought in, but it pulled back even more. And that's because we got in on the wrong side of the mountain. What do I mean by that? Well, right here, this is like a mountain. And our goal is to get in when the trade's coming up like this. We want to get in on this side. What we did is we jumped in right here where we don't want to be jumping in, or over here maybe. Okay, so we want to be on the correct side of the mountain where there's still room for it to go up. That's important because otherwise it makes trading really hard. So how do we avoid trading on the wrong side of the mountain? Well, that's what we're going to talk about here. Now, what happened here? We got stopped out. Okay, so if we're good, disciplined traders, we would have gotten stopped out perhaps. Then the market continues sideways on us, right? And then we get a signal right here. But since we just got burned on this one, what happens to our confidence? Right? Does anybody feel like your confidence maybe is a little bit lower? You know, and maybe you're afraid to get in. So what happens is you hesitate to get into this trade, and you don't have a clear signal here that says, hey, this is a good trade. In fact, it was going down. Maybe it's going to go down some more. But if you had the right tools, wouldn't it be nice if it told you that, yeah, that actually is a good trade? But in this case, because you just got burned, you don't get in because you don't want to lose anymore. And what happens? That happens. And it starts to make you feel horrible because you feel like, well, they're out to get me. And you start thinking like, boy, I shouldn't put my stops in because they're going to come chasing after me. They see my stops, whoever they is, the market makers, specialists, but they see my trade and they want me to expose my knowledge so they can just take me out. And then they won't let me in another trade. It feels like the market's against you. So has this happened to any of you? Have you ever felt like the market was actually out to get you? Right, and the market's against us because it seems like every time we take a trade, it stops us out. But when we want it waited out, it runs without us, and that's frustrating as all heck. And has an even greater impact on you psychologically than you might realize. That type of flawed chart reading can really wreak havoc on your ability to profit in the markets. When the setup looks good based on the information that you have, and you get in, and it goes against you. I mean, it's a horrible feeling. I've been there, and I'm guessing some of you have been there as well. And when you have this kind of failure, it's so hard to brush off that failure and move on to the next one. So this ends up becoming a cycle, and you've got to find a way to break it as a trader, because once you're in it a couple of times in this cycle, when the trades you do get in fail and the ones you skip run without you, it quickly kills your motivation. And you might even start to second guess whether you're cut out for trading in the markets. Now, we all know the markets is a place where you can turn around and get some real income. And maybe you're feeling like the markets aren't for you, but it's one of those things where you have to find a way to get past that. Because if that's something you've experienced, you're not alone. I felt it. Like I said, most of you have felt it. It's especially for new traders or traders that haven't identified the best way to trade. You know, doubt is just one of the negative energy sapping anti-trading things that traders deal with. And doubt causes other issues too, because there's some other emotions that will sneak in on you. And in addition to doubt's the fundamental thing, but all these other things start to sneak in. And this type of doubt and lack of confidence creates negative emotions. And pretty soon you're associating negativity to trading in general. That's not going to help you get where you want to be in trading. To be a successful trader, if there's one thing you learned in this presentation, remember that you must find a way to get those negative emotions out of your head and start feeling some confidence. Because those are the things that are going to surface when you're in the heat of the moment, subconsciously, when the trade's happening live and when you have real money at stake. Okay, so you have to get rid of that negative thing, because that makes you throw logic out the window and do things like revenge trading and make things worse. So we must break that cycle. But how do you do it? How do you break that cycle? Well, we realized that traders need one thing more than anything else in order to give them the confidence to trade well. And that one thing traders need most is clarity. And we just need, as traders, a clear signal that shows you when to get in and when to get out of trades. But we don't want it in a black box format. I've seen systems where they just say buy here and sell there, and they don't really give you an idea of whether this is a really good setup or just an okay setup, right? I want to know where the best of the best are, right? Or at least be able to have some score or something on them to tell me that this is good. So I don't want a black box. I still want to see what the chart's doing. I still want to read price action, but I wouldn't mind having a little guidance on my chart in the form of a GPS. Just like I'm not ready to have a robot drive my car around for me, but I certainly don't mind having a computer tell me when it's how to turn left and right to get to the spot I'm trying to go. I still want to drive. But that's what we need, is that clarity, the clarity of signals. When we finally have something that can help rebuild that lost confidence that we know we need as successful traders. It's something that can help any trader be a better trader. So what's the answer? Well, we've all heard the axiom, the trend is your friend, right? But if you're not able to hear all that the market's telling you, then the trade entries and the exits are going to be murky. You're not going to be able to find them. We built this tool to give traders that clarity because we know that traders are struggling. We've been there too. And we've seen them. We've coached them. Clarity comes from being able to see what's behind the chart's movement, because the market isn't really out to get you. It's actually telling us, screaming at us what it's going to do. We just have to find a way to hear it and to see it so we can know what a stock is going to do next. Now, our technology interprets the hidden info for you. It helps traders navigate their way through charts to find the optimal entries and the exits, just like a GPS can help us get through a city, even if we've never driven there before. Now, some of you, and we find this when people start using this tool, you're going to see notifications that at first you might not expect. And we even get people writing in or talking to us in the trading room. And I'm running the trading room. Sometimes I'll get a question like, isn't the indicator saying the wrong thing here? They'll contact us and they'll say, why is the indicator telling me it's bullish? Shouldn't it be telling me it's bearish at this point? Is it broken? And I always say, no, it's working right. The algorithms are just looking at the right things that reveal what's going to happen next. And it's not always what it might appear at first. Anybody who's got a GPS here now, think for a moment. Remember when you first got your GPS, you think you know the fastest way across town via the same path you've been taking for years. You get the GPS, turn it on, it says, oh, take a right here. And you never took that right before. And suddenly you find a new path, a new hidden way that you never knew was there. And it gets you there in half the time. That's what it feels like when you're using hedge fund quality tools like this. It's like finding the best route right on your charts to get you where you want to be with confidence and with speed. So what is all this? That's doing all this. It's called Trender Pro or MQ Trender Pro 2.0. And you'll hear me refer to it as Trender Pro or just MTP2. We got all kinds of names for it. We love it so much. So let me show you how it works. So MTP2 is going to help you by mapping out the actions right on top of your charts, like having a Google Maps overlay on your charts on virtually any type of chart or symbol. And it does this through very simple, logical color coding that'll make sense to you immediately. You're going to already know what to do based on the colors. Now, remember that what I mentioned earlier about eliminating doubt in your trading. Well, with MTP2, your confidence is going to increase because it's going to help you get bigger gains and get in at the right time and help you stay in trades longer, maximizing your profits. And all these things are going to line up and say, boy, I feel more comfortable trading. I feel more confident trading. I'm actually looking forward to trading. And therefore, it takes the fear out of trading, right? Just like if you have Google Maps or a GPS, it gives you confidence to get where you're going, even if you've never driven there before. Okay? MTP2 gives you that guidance and that confidence, and then because you can anticipate where the stock market's going. Now, how does it do this? How does it make all these decisions for us and make it happen? So we actually use a number of different Basecamp trading technologies to help us see the market in a new way. A lot of these are some of the indicators that we sell, and a lot of them are other things. We have some that are proprietary, and there are some things that are publicly available. But just like a GPS system, the algorithms will tell us which way to turn in order to reach our destination. So what we do is we get a route laid out for us right on our chart that tells us which way the market is heading at any time. And we can see where it's been in the past, so we can see when it was right or when it wasn't right in the past. So that increases your confidence as well. So it's very simple. We use bullish is up and green, neutral sideways is blue for sideways, and you can change these colors if you want. Down is red for bearish. See, if I showed you a chart with these colors on it, you probably would be pretty comfortable saying green is up, red is down, and blue is neutral. That's a lot of what it takes to understand how this indicator works. So it's nice and simple. And even when you're in the middle of a trade and stressed out because it's a real trade, perhaps when you're first getting started, well, you're going to have that clarity and understanding. Now, it doesn't stop with just those three colors. This tool has been through several iterations. You can see we're in Trender Pro 2.0. It's actually the third iteration because it started out as Momentum Trender, and then it became Momentum Trender Pro, and then it became MQ Trender Pro 2.0. So we've added some things. We also have added a color for when we get extended. That's when we've been running for too long, and there's a risk that we've got to a point where the market's probably not going to keep going. Now, sometimes markets stay extended for a long time and do continue, and you don't want to necessarily jump out of the trade when you get extended, but you wouldn't probably want to jump into the trade. So we use the extended almost like an, we're like, be careful here because you want to lock in your profits when you get extended. It doesn't mean jump right out because it could stay extended for a while. And we're going to try to get every bit of money out of every trade to keep our risk and our risk low and our profits high. The other color we have is our golden color, or yellow. And this is when we have a pullback against the fundamental trend. That indicates sometimes that we're going to reverse. Sometimes it's just a pause. But those pauses give us a great opportunity to trail our stops. So we also call these the trailed stop bars. So golden bars and trailed stop bars are the same thing. It's kind of a yellow for pause. Okay, so we use these golden bars to determine whether to get out or ride it for bigger gains. And we call these trail stop golden bars for another reason, because it's often where we take our profits. Now, all of these colors will automatically appear on your chart. So it's like I said, it's like having a Google Maps overlay right on your chart, showing you exactly how you're going to want to get where you're going. So let me show you how it makes a difference in the way you trade and the way you can pull money out of the markets. Let's go back to that example that we saw a few minutes ago where we got into the trade. Remember this one where we got into the trade at the wrong time, the wrong side of the mountain, remember? Now, what was happening is the mountain was formed and the market was ready to fall, but we couldn't see it. Okay, and we tried to get in right here, remember this? And only to have it reverse and go against us. And remember we said a bad word here? Well, now let's add in MTP2 to see if it can help illustrate the market a little bit better. So let me wind that back. This is without it, this is with it. Okay, it's a little offset here. It'll be exactly overlaid on your charts. But this is the color coding is now added. This is without the color coding. Okay, when we have the color coding added, suddenly we get extra information. Okay, notice here is that when we were getting into that trade, does anybody remember what this color represents? Right, remember we have green is bullish, red is bearish, blue is neutral. Okay, this means extended. And remember I said that we wouldn't necessarily jump out of a trade if we were in it, but we wouldn't want to be jumping into a trade if it's extended. We would not have taken this trade. It was telling us that, you know what, we're pretty high up on the mountain, and I wouldn't trust that we're going to take this. Here's a golden bar. So the golden bar was saying, hey, be careful. That's a pullback, and it's likely to reverse here, possibly. So be careful. And then we dropped. Went into neutral, and at the point where we got stopped out, this is actually an entry opportunity. right? When you see the red, it's a short entry opportunity. So instead of having losses here, we could have not got in here and then jumped in with a bearish trade. You could buy a put and write it down. That would have been a good trade. And even more importantly, over here, remember this point where we were afraid to take the trade? We were saying, oh gosh, I lost money here. I don't want to lose money again. We changed to green. As simple as that. We went from neutral to bullish. That's a signal and confirmation with other things that is time to get in. And so when the market took off, we were comfortably able to recognize that signal and jump in. And if you notice, there's an inverted head and shoulder here that also was triggering at that point that we were afraid to use and get in. Once we turn green here, it gets so much easier to let your other signals tell you that, yeah, it's a good time. And up we went. Now, with Trender Pro guiding us, we can see when to hold off on getting into a trade and exactly when it's the right time to get into the trade. And that's why we love Trender Pro. Well, one of the reasons, another reason I'm going to tell you in a second why we love it even more. But this is also why hedge fund traders use this kind of technology, because with this added info, they know when to get in and when to get out to maximize their gains. Why shouldn't you have that knowledge? Now, again, some people are going to say, how does this work? And we don't reveal all of our code or anything like that. But I will say that there's a lot of our code in this indicator. We brought all kinds of things in. In fact, there's 49 different states that the indicator calculations can be in that we boil down to the colors that you see. So we have multiple algorithms checking simultaneously all the time to read the charts and read them correctly. It's like we have a team of advisors working together behind our charts to guide us. Like you're the CEO, and you've built a team of the best advisors around you to keep you on course. Now, by looking at these different factors, we can accommodate accurate trend across just about every type of chart situation. And we use what are called adaptive filters, which adjust based on what's been happening with the market. And we measure the current stock's movement in all these different ways and then score it. And we give it let's say if we have 10 of 12 filters active, we might be strongly bullish, 7 of 12, we're neutral to bullish, 4 of 12, then we're neutral, etc. It's a little more complicated than that, but that's the idea. And then just like a GPS, there's a ton of technology and complexity going on in the background. But ultimately, what it presents is simple to use. I mean, you don't have to know all about satellites and the nanosecond timing of the arrival of having at least 3 satellites. You just use the GPS. It doesn't matter to understand how the internals work as long as you can use it to drive. What it boils down to is we use those simple color codings to help us know what to do and when to do it. So let's talk a little bit about how this works, how it's going to transform your trading. And I'm just checking for questions here. I don't see too many or any yet, but that's okay. Now, many traders struggle with staying in a trade that's been running for a while. This is the second reason why we love this indicator, because traders get nervous about the profits that they have when they're up even just a little, especially if they've been losing, right? In fact, they might have a bad habit of letting their losers run all the way to the stop, but cutting off their winners with just a little bit of profit. And that's really bad. That makes it so hard to be profitable. You want to maintain at least a 2-to-1 reward to risk ratio to be able to trade easily. And if you can maintain where you make at least twice as much in your winners than you lose on your losers, you only have to be right better than 1 out of 3 trades. So if you're just better than 1 out of 3 trades, and you're using a 2-to-1 reward to risk ratio, you can be profitable in the markets. That means you can be wrong 2 out of 3 times almost and still make money, still watch your equity curve rise. Now, what Trender Pro can do is when you do get a winning trade, you're going to take even more money out of it, because your biggest risk in a trade is right at the open. Right at the point where you start to trade. So every time you go into a new trade, you're exposing yourself to maximum risk, right? If you stay in a trade, you leave that risk behind. If you can keep moving your stop up and up and up and not jump out of the trade, then you're going to be able to take a lot more money back, and you're going to see your equity curve rise, and your win to loss ratio is going to rise. where you only have to be right even less than 1 out of 3 trades. And now it makes it almost so you can't help but make money in the markets if you're doing all these things correctly. So let's see just a simple way to use this tool. Here's our first rules: enter long on green or short on red. Well, we changed to green right here. Okay, and you can see we stay green all the way up through here until we get into a red. Now, what I'm talking about is the bar colors here. And in this case, we went to blue. Now, optionally, you can exit on blue. Some people prefer to wait until you actually get the red reversal bars, but some people will exit on blue, and that's okay. The problem is sometimes you'll get a blue bar in the middle of a run like this, and that's why sometimes I'll prefer to use the red. Okay, but it's this easy. You get in on a change to green, and you get out when you're no longer green. Okay, this lets you stay in the trade the entire time until the trade's done all it can. And then you're pocketing more money per trade and reducing the amount of risk per trade. Now, there's another way that we can stay in trades for longer. And this is one of my favorite parts of the technology because it helps us stay in trades longer while locking in gains at the same time. And this is using those golden bars, those trailed stop bars. Now, what we do is every time we get a golden bar, we trail the stop. So let me get my pen here. So we enter here, right? And then we trail here, and we trail here, and we trail here. And so we could get taken out right here. That's a nice gain. Okay, so you can just do that if you want. What I like to do is a little extra step. I like to look at the bar that follows it, that follows the golden bar. So let the golden bar form. And then the next bar, if the bar closes higher than it opens, I stay in the trade. If it closes lower than it opens, I jump out. So I use the bar that follows the golden bar to decide if I'm staying in. So we'd stay in here, and we'd stay in here. And we'd be confident because we got that signal, we got the golden bar. Yes, we'd pull back, but look, our stop is below the golden bar. We didn't get taken out. It wasn't until here, and if you notice, look right here. We closed lower than we opened. We'd get out there anyways. Okay, we probably would have triggered our stop right there. But do you see how this will systematically, there's no guessing in this. You have a systematic method for exiting your trades once you're in them. Okay, either of these systems will work for you, and you can use them both. You can decide which one you want to use and apply it for that specific trade. This is what I'm talking about with transformational trading and having clarity in your trade, because now you know when it's time to stay in your trades for bigger gains. So rather than jumping in and out of a trade as soon as it runs higher, back over here, it's like, oh, I'm up $100. Let me take my profits. No, you would have missed out on all this run. And Trender Pro, being green, says, no, it's easy being green. Stay green. Green's where the money is in this case. And up we go. Okay, so it's almost like one and done every time. We didn't have to go back into the trade again and again and again as it keeps going up. Okay, now you can see why we like this indicator, I hope, and why the golden bars are so helpful. Okay, so exit if the bar after a golden bar closes against the trade direction. If it closes up, we trail the stop and stay in for the ride. Now, you probably noticed there are some MTP2 signals in here. Okay, we've been talking mostly about the colors so far. These are expert advisor signals. They give us the key points to enter and exit trades. So now you have not just the color, but you also get indications on the chart of when to get in and out. And sometimes you can use these as exit points as well. So for example, if you are long in this trade from here, you could use the short entry signal saying, hey, you know what, I'm going to jump out. Okay, you also got the red there. Okay, they won't always correspond exactly like that. Okay, but you can use the colors alone. You can use the signals. I like to use them both at the same time. And MetaStock is the only platform that we make with this this technology where you have these signals. None of the other platforms that we have offer this. So this is something unique to the MetaStock implementation, because MTP2 loves the MetaStock implementation. Now, speaking of additional features you get in the add-on, you probably noticed that there's a trend ribbon down here at the bottom of the display. That trend ribbon is another Basecamp trading technology called MQ Trend, which calculates trend a bit differently than the way that MTP2 does. MQ Trend's a popular indicator at Basecamp that we sell on its own. I think we sell it for $297. And in MetaStock, we use the wisdom of the longer term market view that MQ Trend provides because we built it into that ribbon. And now you can use this to confirm direction or help you stay in trades longer for bigger gains. Now, I like to have that longer term trend for trades that I want to stay in for more than just a short period. And remember, our goal here is to stay in for trades as long as we can, because that's going to improve our reward to risk ratio and make it easier for us to be profitable. Okay, so this gives us an extra piece of information that we're getting aligned with the trade. I may jump in here before we change to green, but it sure is nice that once we cross over, that we get that extra confirmation. And then I'm not going to be itching to get out of this trade when I get even more things lined up. So here's another example of the Trender Pro guidance and staying in with golden bars. You can see the MTP2 expert advisor signals giving us guidance along the way. Here we have an entry identified right here. Okay, this is on the weekly Google chart. It changes to green. And our first golden bar, we check whether or not it closes up, which it did, so we stay in. Okay, and we can move our stop to a reasonable distance below here. For a weekly chart, you might want to give it a little more room. The next one is slightly more threatening here, but if you look closely, you can see that we closed up. Okay, so we stay in, and then we get another long entry signal. That's even more boosting after this little morale killer here, because, you know, well, I'm still trailing from back here, but didn't take me out. But now we move our stop down below here, and you can see up it goes. We'd still be in this trade with our profits locked in at our trailed stop points. Okay, this is exactly how we can stay in our trades with clarity and confidence, riding out the bigger gains. You can see we stay in here and it takes a little dip and up it goes. And note too that even though we can't see the ribbon in this picture, these are the ribbon transition lines moving from green to red to back to green again. So we got that extra confirmation right here. It's saying, hey, stay in. So let me show you again a comparison of a chart without Trender Pro and then with Trender Pro. This is Facebook on the daily chart. And without MTP2 lighting up the chart, it can be difficult to find where that great entry point is. Okay, even if we start to think about Facebook turning bullish here, where's the entry point? It's really hard to tell. So many traditional methods would have you perhaps look at this previous pivot here and say, well, if I break above this previous pivot high, then I will jump in. Okay, let's turn on Trender Pro. And now we can immediately identify the point where we can enter the trade. And we can do so without waiting to break that previous swing high. Right here, we got a long entry signal. So we can take that trade and up it goes. Okay, we got in $20 earlier, $20 per share earlier, meaning we'd make an extra $20 per share on this move versus waiting from here, which, by the way, from here, it dropped down and might have taken us out with a stop. If our stop was back here under this golden bar, we would not have, well, our stop would have been below the entry here, but we wouldn't have gotten taken out. We just got an entry to say stay in right here. See how we closed greater than we opened on the bar following the golden bar. Okay, and you can see you can have transformational trading and make more money because you're getting in at a better time. And we can make even better decisions using multi-time frame conversions. That's a big mouthful, but all it means is that we're looking on two different time frames. This is one of the setups that you get, one of the layouts where you have the weekly chart on the left and the daily chart on the right. So we can look over here and look what's happening on the weekly and look for what we call convergence or multi-time frame convergence. So this is Netflix having a hard time. This was last summer, and it started to improve at the end of August. Right, we saw mostly sideways movement on the daily chart right here. Okay, so there's where it started to move. Here's the sideways movement, but we got this breakout signal right here. Okay, so now we've got a long entry signal on the weekly. At the same time, we're getting the long entry signal on here on a breakout of this area, and up we went. And notice too that even though on the weekly we went up and there's still room for it to go weekly, we did get a signal on the daily chart that we got extended. And if you look here, there's also a signal right at this point to exit, right? Because we closed lower than the open. So we would have exited here. And we got another golden signal here that also gave us the exit signal. So we'd be out already at this. And that's another help, is that it tells us when it's time to get out. Okay, so it's helping us get into trades with convergence, but also helping us know when to take our profits and be done. So you also saw some of the other features included in Trender Pro. You're getting MQ momentum, which is our momentum indicator. That's this down here. And we use that on every single one of our charts at Basecamp Trading. And we sell it alone as a standalone indicator, again, for about, I think it's the same price as MQ Trend. And remember, you're getting the trend ribbon to illustrate the longer term directional bias for additional confirmation. With these three working together in tandem, we can identify not just time-based trend, but also strengthen our confidence even further. So for those of you who just want to use the signals, you can ignore all this. But if you don't want the black box and you want to know what's a great signal from an okay signal, so you can be more what would be the word? More I can't think of the word, but you want to have better quality ones, more discerning, I guess is the word. Well, here, let's look what happened. We've got the convergence of things happening all at once here. So if we get the convergence and confluence, meaning that we're getting agreement from down here and up here, that makes an even better trade. So at this point, we are changing to green on MQ Trend, right, and the ribbon. And at this point, we are getting a momentum reset. That means that momentum has pulled back to the 0 point, which is where it changes from green to red on the histograms, and says, you know what, this thing could run. We've done a full reset. We changed from being bearish to bullish. We're ready to go right from here. And you can see what the result is. And then we get our signal. Okay, so now you get an extra bit of confirmation. We get our MQ trend telling us that it's time, MQ momentum's telling us it's time, and then you get your signal. So for those of you who want more than just a signal, you've got that extra confirmation. And those who just want the black box signal, it's time to go. So pretty cool how it can all work together. And we can also use it for things like divergence and traditional MQ momentum. So in this case, we get our signal to go short. And at this point right here, you can see it was a great entry here, a short entry down to the bottom. But look how MQ momentum was anticipating that this drop wasn't going to be continuing, because momentum was already rising at the time that this was falling. So we take our profits at the end of this golden bar. Notice we closed up here. And then as soon as we get our signal for the long entry, we're ready to go, because we knew at point C here that this was ready and ripe to go the other way. So no questioning anymore about whether or not the downtrend is over. You are already ready. And out of you've profited and pocketed the money on the way down, and you're ready to turn that around and put it in on the way up. Finally, we have that clarity in anticipating market movement. When you can hear and see what the market's telling you, you can act. And it's that type of helpful info beyond the charts that can help you easily identify the best trades. Yes, you get even more. You get the expert advisor, which gives you commentary on the chart. So when you click on a bar, it'll tell you if it's got certain signals and how to manage them. And there's 3 sections. It'll tell you how to interpret the coloring of the signals. This would be any signals you get, like a golden trail, and how to do that. And then you also get information about the trend status. Okay, and you get all of the expert advisor trade signals built in. You also get 8 explorations to be able to search across the entire gamut of stocks that you have for whatever countries you want to trade. And the way these work, these are looking for long entries or a surge when it moves, say, from neutral all the way to strongly bullish. And these are breakouts, meaning that we're breaking above a previous swing high 5 bars back or even 10 bars back. So you can look for when we're breaking out of a consolidation zone right at the point where we're changing into a bullish mode. That's the start of many really good runs. So you've got those on the bullish side and on the bearish side. Plus you get a user's guide. And this has all kinds of information, including how to use the secondary indicators that you get. So these can be used on, once you start using MQ momentum, you're not going to trade without it. And we know that's the case for Trender Pro. And Trender Pro is going to help you just get extra money out of trades. And that's one of the things that are the best about it. And there's some things about configuration, trade signals, and an FAQ section that's got answers to a lot of common questions that we anticipated. So now that you know more about Trender Pro's abilities that can help you with your trading, you can see that it has the potential to provide that clarity that you need when you were looking for greater confidence in your trading, and therefore increased likelihood of those consistent big gains. When you have both of those combined, that's where the transformational change happens. And you're able to achieve your goals and make it easier to be a successful trader, to make even bigger goals. And yes, I wish I could have shared this with my dad, but he would have loved it. So I told you earlier, I'd show you how to unlock a stock market GPS for better trades. And I showed you how you can use our deep technology to trade like a hedge fund, exposing the hidden information that's behind the charts in order to achieve those massive profits that you want when trading gets easier. Now you have the opportunity to completely transform your trading and getting MTP2 today, like this $116 trade, where this was from last July. Okay. And let me just, this is last July. Yep, last July we got in here and Beyond Meat, and we'd still be in this trade. And this is right up to last week, I think. So we're looking forward to see if there's that bottom in the market, but there's a nice 116 per share. Here's Carvana, same thing. This is a $301 per share gain. Imagine if you traded 10 shares or 100 shares in this. The 91% gain is nice no matter how much you're trading. Okay, we got 3 signals back here to go short before this drop. Okay, this is 91% gain in less than a year. Now, those are the kind of gains hedge funds are making because they have this type of information, because they can see where the best moves are. Why should only hedge funds have that? Why shouldn't you have it? And now that you've seen what the hedge funds do have access to, can you see now that you're at a disadvantage if you don't have these tools? Well, you don't have to worry about that anymore, because now you can get this right now. You can get the same signals you've seen here, so you can stop falling prey to bad entries and start making trades. They're gonna grow your account to the goals you have for you and your family. Okay, so get ready to get those dreams back again that you used to have when you first started trading, because you're going to get excited about trading again, and it's going to start to become fun when all these all start coming together. Because achieving those dream goals is what transformational trading can do for you. Like this 1535 gain in Amazon for $1,500. That's one share. You know, imagine what you could have made trading more shares, or even better, using options. And then imagine doing this over and over again. That's transformational trading. So what does this cost? Of course, we have to get to the money part, right? So Trender Pro, normally about $1,200, MQ Momentum $300, Trender. We sell these at these prices right now in our store. That total comes to $1,791. The normal price for pulling all this together as a package is $14.99, but that's not the price you're going to pay today. Today, because we're at the conference, we're going to give you this for $9.97. Just $9.97. You'll have immediate access. You can start using it right away. All right, let me see if we have any questions. I don't see any questions.
That's interesting. You should be able to. And we do have quite a few, but I can moderate some questions for you.
Oh, okay.
Richard wants to know if it will work on Forex data.
Absolutely. Yep. Forex, crypto, futures, and we use it even on Renko charts. Okay, I found the questions now, but you can ask me.
Good.
Easier.
Well, we have a couple in YouTube too, but I'll let you kind of pick them through as well. There are quite a few coming through. Nigel wants to know if there's a demo version, but we do offer a 30-day money-back guarantee. So, and a free access to MetaStock if you need it as well.
Yeah, that's even better than a demo version, because then you can try it out, see if it works. I mean, that's a way to demo it. And once you have it, I don't think you're going to get rid of it.
Sergeant Dab Jones, nice to see you, Sergeant. Nice to hear your voice again. You're a great teacher with a wealth of knowledge. Last time I was in base camp, Gary had a cancer diagnosis. How's he doing?
Well, Gary doesn't work for us anymore, so I can't really legally talk about him. I think he's doing okay, but I'm not really permitted to speak about him. But yeah, we really miss him. He used to be part of this presentation because his favorite indicator is Trender Pro. And he credits Trender Pro, this indicator you're seeing here, as the reason why he had, $20,000, $30,000 days in his trading, because it let him stay in the trades and he stopped that bad habit of jumping out of trades early. So Gary is an awesome trader, and part of what made him awesome was using this indicator. So we miss him. Maybe someday he'll be back with us. I just don't know, and I really couldn't share even if I did know, but I don't know.
Okay, here's a question from the YouTube chat. Nyla wants to know if, in general, what does your system consider? Is it price averages, volatility indicators, trend? Can you give a brief context of what it's looking at?
I would have to go back and look at it and see what all the different parts are. But my answer is going to be yes. It's like all those things. I don't know if volatility is an interesting one. Maybe we're going to have to make a Trender Pro 3. I don't think it uses volatility, but it definitely uses trend. And what it's using a lot of our other proprietary technology indicators. So we're using the concepts of things that we use in our own trading when we're just looking at raw chart data and building that in as saying, hey, this is a good point to get into your trade. So it's actually like buying a whole bunch of our different indicators and packing them into an answer and feeding that your CEO board that's going to help you make those decisions. So I don't have a list of what they are, of what the different technologies, but like I said, there's 49 different states that the indicator can be in. So it's using a lot of different things.
Let's see. And a couple questions. G and Richard want to know, is this a monthly price, an annual price, or a lifetime price?
This is a lifetime price.
Thanks for that question.
Yeah, this is pay one price. In fact, I think today we're giving away this simple setups for weekly income as well with that. So it's even better than that. This is our head trader, Thomas Wood, walking you through 4 simple setups that you can master in a month. So you get that included with it as well. So
Randy has, go ahead, sorry.
Number 997 is a lifetime price.
Yeah, and we do offer it with a money back guarantee as well. So let's see, Randy wants to know, what is the shortest effective time frame that you'd recommend?
Dave, who is our head stocks and options trader, trades off a 30-second chart. And he has a system called the impulse trading system, which utilizes an exit modeled on Trender Pro's color. That's on a 30-second chart. That's a little short for me. My minimum I go to is 2 minutes, and Thomas's minimum generally is 5 minutes. But we like intraday trading in our trades, both in stocks and in futures.
Going back to YouTube for just a second, Nyla wants to say, what happens to the indicator? How does it work? How well does it work in a sideways or a choppy market?
That's a good question. So if you are seeing it change colors from red to green to red to green in a horizontal mode, I would just stay away, or do something like an iron condor. So identify that you're in chop. The indicator does have a neutral color. It's got a cyan color that will show you when you're moving sideways. But a lot of times it won't just be moving sideways. It will like for example, right here, you see the sideways moving. Can you see this screen, by the way? This is
yes. Mm-hmm.
Okay. So you see how it's recognized that we're moving sideways here, and then it's like, okay, we're starting to go bearish, and then it gave up and went up here. And then when you finally get the red, that's when you're more interested. So the neutral is kind of like, unless you're doing like a time decay trade, like an iron condor or something like that, I would wait for the trend to kick in, which is either a green or red indication. And then, by the way, there's 2 different colors of green and 2 different colors of red. There's a neutral to bearish and a strongly bearish. So you actually can tell a little bit more resolution of how strong the signal is. So what you can do is wait until you get a strongly bearish signal like this one right here before you get in, and you can see the result.
All right. Devonda says, great presentation. And we have had a lot of really good feedback for that. I wish we had a little bit more time for Q&A. But very lastly, I'll say thank you for coming in. We appreciate kind of the presentation. Great job today.
All right. Well, thank you. Have a good one, everybody. Remember, it's a money back guarantee. You get nothing to lose, but just give it a try and see if you like it. It's almost like if some of your friends gave you a GPS, they're going to ask for it back, when they let you borrow it, and you're going to end up wanting that in your car. The same thing's going to happen with Trender Pro. because once you add it to your chart, it's just going to show you where to go next.
Okay, and then Michael wants to know, does it use candles or only bar charts? And you can change them to either one if you want to, Michael. That's fine. Sandra, this is a one-time cost, to reiterate that. John, I'm going to go ahead and switch over to my side, give out the phone number again and the price, and tell people how they can take advantage of it. But thank you again for coming in. Great job.
You're very welcome, and thanks for hosting all this. I appreciate it. Have a good one, everybody. Bye-bye.
All right, thanks. Bye. All right, very good. Let's go ahead and do that. And let me go ahead. A couple buttons I need to push. This one. This one. This one. That out of the way. Ooh, let's go ahead and do this as well, real quick. And this as well. Okay, we're almost ready for that. All right. So as John was talking about, normally it's $1,495. You can go and buy it on the website at that cost. John does such a good job about talking about like how the scanning works and how the commentary is integrated and stuff like that, which is great. Here at the show, here at the conference, we're going to give you a money-back guarantee. 30 days to kind of evaluate it, look at all the signals, make sure it's something that's helpful for you. If it's helpful, it should pay for itself. If not, it's a low risk entry offer. So with that, if you're new to MetaStock, if this is the first time you've heard about MetaStock, or you have heard good things and just haven't decided to buy it yet, we will give you a 30-day money-back guarantee. We'll give you a trial to MetaStock. We'll give you a bunch of training to help you on your MetaStock trading, and all of that stuff is included. So if you want, give us a call, 800-882-3040 to take advantage of that. MetaStock.com/sales chat to kind of chat with some of the reps. They will do a very good job of answering any questions that you've got, or metastock.com/conf-promo to sign up online. So again, go ahead and take advantage of that. Again, such a great opportunity, such a low risk with this money back guarantee, $9.97 here at the show. So there you go. I do want to, as we're going to transition a little bit into our next presenter, before I do that, I want to say thank you to the CMT Association for sponsoring the events today. Chartered Market Technicians is a very, very well reputed, if that's a good name. I'm not even sure that's the word. I should look it up. They have a great reputation. They've been sponsoring the event since our big conference that we did back in November of last year. They're great to work with, and we really, really we love working with them. So if you want to find more about the CMT Association, go to cmtassociation.org, and there'll be all kinds of information. We appreciate them supporting the event. We're going to have them speaking a little bit later today. And of course, we're MetaStock. MetaStock's been rated #1 in its price category now for 29 years in a row. And everything we're showing today is the MetaStock charts, how they work, how they look, the scanning. Oh, I love scanning. I use scanning every day. I wouldn't be able to trade without it. The testing, the ability to do forecasting, it's just a great product. There is a reason it's been rated for so many years, 29 in a row. That's the best software in its price category. So prices for MetaStock starts at $60 per month. You can get a buy 1 month and get a second and a third month for free. Go to metastock.com/conf-promo. Chat online with us at metastock.com/sales chat. Or give us a call, 800-882-3040 here in the US. So anyway, I hope you're enjoying today. I think things are going well. Very, very well. A great question. Thank you for participating. Thank you for coming. Thank you for registering. So far, everything's going really well. So our next presenter today is Tushar Chande. Tushar is going to help me with something real quick. I'm going to give a little intro to him. Tushar is a person, we've been doing demos on the MetaStock route for decades now. And one of the systems, a couple of the systems that we actually have built into MetaStock for free are part of a collection of systems called the Performance Systems Plus systems. And for years in a row, there's a couple of systems. I think one is called the Rune and one is called the Stochastic RSI, have been some of the top performing systems for literally decades. We run system tests all the time when we're doing demos, and they always come up as one of the best systems. So Tushar reached out to me, I think it was about a year ago, maybe 18 months ago. Time goes fast when you get old, right? but he wanted to design subsystems specifically for MetaStock. And I thought it was funny when he was trying to introduce himself to me. I'm like, I know who you are. Let's do something. So he's a really, really great technician. We're happy to be working with him. And he's developed also 3 very unique systems in MetaStock that also test as good as the old systems that we were using before. So a great system designer. Tushar, I need your help with something, though. Can you hear me now? And let me turn on your microphone. And I'll turn on your, there you go. Tushar, it is time for something very, very fun right now. I need to give away a prize. Can you help me with that?
Oh, of course. It might be tough, but I'll try.
Okay, so let me go ahead and have you give us a number. The number I want you to pick is anywhere between 1 and 7,000.
Ooh, 3,653.
Okay, that was very decisive. 3,653, you said?
Yes.
Okay, 3,000. Ooh, I typed in, okay. Okay, now what we are, dang it. Excel is not helping me at all. Let me go ahead and do this instead. We'll just go to the number. This is a William M. is going to win this prize. William M. And I do want to point out to Kelly, I did not say a last name. William, we are going to give you a subscription to Larry McMillan's newsletter, 3 months. It's a $110 value. You probably know Larry McMillan. He's been writing a newsletter for over 30 years. We're going to give you a free subscription to it for the next 3 months. $110 value. Congratulations. I will email you on how to collect that prize. So, well, actually, what we'll be doing is have somebody get in touch with you from Larry McMillan and help you get the prize. So, with that being said, Tushar, I'm going to turn the time over to you. Thank you for the assist there.
Oh, that's hard work.
Let me go ahead and make you the presenter.
Thank
and
you.
I'm going to also make you the organizer. So you should be able to see questions as they come in as well. So let me go ahead and push that button as well.
Yeah.
I can't see your screen already. I can
You
hear
can
you
see my
well. Yep. So yeah, everything looks well. Everything looks good. You are now in organizer, so you should be able to see all of the questions.
So everybody, I guess good afternoon or good morning, wherever you are. And thank you for being here. Thanks also to MetaStock and Jeffrey and everyone back at HQ for organizing another great conference. So I hope you get a chance to look at on many of the other talks. Absolutely wonderful presentations. So my talk today is going to talk about the top trading opportunities with Chande trend meters. So just by way of background, we know the market has been trending lower. So you're going to say, well, what opportunities could be there? Well, let's find out, and we will. So I'll start with the usual disclaimer. Please look at it when you get a chance. The main message here is that markets are random, so past performance is not necessarily indicative of future results. And then there's risk of loss in trading, always, always, so be careful. Just another disclaimer, I'll be showing some charts and scans, etc., which may not exactly match the scans and templates you'll see if you get the package, and I hope you will, simply because as an explanatory tool, I can add things that are not in the in the package itself. Okay, so some of you may not know me. You're probably wondering, who is this guy? Well, I have a background in technical analysis for a long time. These are some of the indicators I've invented, which are now available, some of them, in pretty much any technical analysis package like Stochastic, RSI, or Arun, or Vidya. And then I kicked off the adaptive indicator revolution when I published Vidya, and now they're all over the map and different ways of adapting different indicators. And I was a money manager for a long time. So I've been doing this for quite a while. And since I manage money, you have a different perspective in terms of managing money and risk control and so forth. So that's my background, where I'm coming from. I also have a blog. You can find it at chandeindicators.substack.com, and my website is chandeindicators.com. Okay. So why should you get this package? Everyone over here is going to tell you about how great they are and so on, but I'll make it easy for you because it's simple, easy, and powerful. By easy, I mean that you can start applying it right away, and it doesn't have a very steep learning curve. It's simple because I've taken a lot of complexity and all of my experience and decades of experience and boiled it down into something very simple and intuitive. And it's very powerful because don't let the simplicity fool you. There's a lot of trading technology and power packed into those indicators. It's very clear. So it's very cut and dried. You know exactly where to get in, you know exactly where to get out, you know exactly what the indicator means. So you don't need, you know, pretty multicolored charts or dozens of indicators. You don't have to guess about where to get in or where to get out. It's very clear cut. More importantly, you can use it any time, meaning you can use it on a 5-minute chart or a monthly chart or a weekly chart. And you can use it anywhere, meaning any type of market condition and any exchange. So all of you who are listening to the talk from India or Europe, you're free to use them on your exchange or your exchanges because the technology can be applied pretty much to any tradable instrument. Okay. So what I'd like you to do is I want you to embrace the power of simplicity. And there are really 4 things I'll be talking about: the trend meter and 3 types of systems. So the trend meter is pretty much the best measure of trend strength and persistence ever released to the public. It's most comprehensive. It's got multi-period and multi-indicator, but it's very simple to use. So you have an apples to apples comparison. So if you think of it as a trend thermometer, so just like you can have, temperature measurement in New York, in London, and Hong Kong, all the same scale, mean the same thing. Similarly, the trend meter will allow you to compare anything from here to anything over there, and you can make a decision on whether you want to trade it or not. And then the systems are cut and dried. The rules are specific. You don't need any training, but they're very robust. And the entries are all either trend following or counter trend, and that is their buying strength or buying weakness. But we use trend following exits, which means I use the principle of TOPS COLA, kind of easy to remember, TOPS COLA, and that stands for take our profit slowly, that's TOPS, and COLA is cut off losses at once. So that's the typical trend following principle. And the main thing you'll observe is that I generate very clean signals. You don't have a whole bunch of arrows running around confusing you. So that's sort of the idea that there's a lot of trading experience packed into a very small number of indicators and systems. Okay, schematically, what are we trying to do? We have a needle in the haystack problem. What I mean by that is, if you think of a haystack as an exchange, there's lots and lots of trading opportunities, but not all of them may fit your style or your needs. So how do you just pick out those few trading opportunities that best give you a chance for being profitable? So lots of opportunities, but how do you just zoom in on a few? So it's sort of a needle in the haystack problem, and that's what I'm helping you solve. So one of the things you'll find is when you listen to the various talks, they focus more on how to trade. There'll be this system and that system and this rule and that rule, and they won't tell you very much about what to trade. So if I give you an example of something that's already trending or consolidating, it's very easy to illustrate the problem. But in real life, the problem is, what do I trade? What do I pick? So my talk is reverse of the usual strategy, but I'll focus more on what to trade. Because once you know what to trade, then trading it is easier. And if you listen to some of the big brains in the business, that's what they tell you also. They also tell you to focus on what to trade. So I'm quite different in terms of how I'm solving the problem for you compared to most of the talks you'll go to. So it's a needle in the haystack problem we're trying to solve. Okay. So remember, the big question we have to answer first is it trending? So we want to find markets that are trending now. And once we know it's trending, then we know what to do. We're going to use trend following systems, and we can buy strength and buy weakness, or sell strength and sell weakness, depending on what you want to do. So you can take just the left-hand side, what is trending, and feed it into your existing process, or you can apply some of the principles or systems that I will show you. But the basic technology is what is trending and then how to trade. So what to trade and then how to trade. All right. So we're going to solve or answer the trending problem with the trend meter. And we have 3 types of systems: the volatility breakout system, the swing system, and the long-term system. So as the name kind of implies, the volatility breakout is the instant 1-bar system. We got a giant move. Let's look at this, maybe the trading opportunity. The swing system buys strength after weakness, so it takes a few days to set up. The market comes down or the thing comes down, wants to bounce up, we want to catch that bounce. And the long-term system, as the name implies, is for a, the market is in a lot of work. Now we finally settle into a long-term trend. Now we just want to follow the trend without, too much extra English. So trending, trend meter, systems, 3 types of systems. So let me sort of fill you in on the details of the trend meter. We can spend 2 hours talking about it, but the short summary is that it's a very comprehensive measure. It's a multi-tool. So it uses 4 different time frames, 25, 50, 75, and 100 bars. It uses 5 different classes of technical indicators. So you're not dependent on any one particular indicator. I use bands, channels, returns, oscillators, and patterns. And you can see that these things cannot be readily combined, right? How do you combine a pattern with, some band, or how do you combine a channel with an oscillator like RSI or stochastic? It's very difficult. But we've taken the trouble to sort it out and be able to combine all these things. So you get 28 internal components that we are checking. And so the idea is that you have multiple time periods and multiple tools or indicators, and different sort of time versions of the same indicator, all combined together into a nice package to give you a single reading, and it's breakout friendly. So the big problem whenever you're combining indicators is they have different scales and different speeds. And how do you get all these things to work together in a cohesive and sensible way? And that's what I've worked on and I've solved for you. So visually, think of it as a trend thermometer. So when the trend is cold, you're going to get a reading near 0, like it's going down or not really moving or falling rapidly. Conversely, if the trend is hot, you're going to get a reading near 100. So visually, think of a trend thermometer. You have the data streams going by. You're sticking a thermometer into this data stream and trying to find things that are hot or cold based on what you're going to trade long or short. So that's the visual I want you to remember. And this is what a typical reading would look like. The scale is 0 to 100. And then we've got lines at 80 and 20, which are the 2 main areas, just like most of the other oscillators you're used to. And again, just a reminder, when the trend is hot, you're close to 100. Now, what I wanted to do as a designer was that when the market was trending higher and strongly trending, I wanted it to be above 90 and kind of flat. So I didn't have to worry about too many wiggles in the data. Conversely, when you have downtrends, I wanted to be below 20, ideally below 10 for really strong trends, and then kind of flatten out there. So again, ice and fire and ice, hot and cold. So easy to remember, easy to apply. You can use it on any instrument, any exchange, any time frame, and any type of market condition. And then just the reminder, just to rub it in a little bit, above 80, you have strong uptrends and very strong uptrends, or super strong uptrends, and you do find those. And the converse is also true. You can have a strong downtrend, a very strong downtrend, or a super strong downtrend. So this is a fundamental tool that's worth the price of admission. Once you understand how this works intuitively, you can look at the chart and your eyeball should confirm what the indicator is saying. If it's moving up strongly, yes, it is. If it's moving down strongly, yes, it is. So in the middle, we don't want to think about it. So essentially, if it's between 20 and 80, we just don't want to trade it. Saves us a lot of headache and hassles. If it's above 80, we want to go long. If it's below 20, we want to go short. But you can always reverse it. You can sell strength and buy weakness. So it's up to you. All right. So let's switch over to MetaStock, and I'll actually show you a bunch of things so it'll make sense. So one of the things I wanted to do, because it takes time, is I ran the seat. Let's take a step back here. So if you go to the Explorer and you buy the package, you'll find these TCCT, which is the Tushar Chande's complete toolkit. And you have a long-term system. You have a scan by CTM, scan by Chande trend meter. You have a swing system and the volatility breakout system. So those are the scans that are built in. And then, of course, you can pick whatever it is you wanted to pick here. And then particularly what I've done here is I've scanned the US ETF. So this takes a long time to do. I've just scanned by CTM. It gives you anything that has a trend strength greater than 80, just for the purpose of the discussion. And you can see you have something down around 80 here and something around 100 here. And at the top here right now is UGA. Let's move the symbols over. And that's the US gasoline fund. And I have the chart over here, and you can see that let's expand this out a little bit for a second. This is a trend meter, scale of 0 to 100. This is 80, and you see that this is almost at 100 right now, or 99 point something, and then it's above 90. So anytime it gets above 90, we have a strong trend. So imagine being able to look at 3,200 or whatever US ETFs every day and leverage the power of the scanning abilities in MetaStock. And if you're even if you're not a ETF trader, it's worth looking at this list because it tells you what's happening in the market. So here, if you look at what's trending, UG gasoline is trending higher. That's energy, and then we have high, and bonds are trending low. High short bonds are trending higher. Short euro is trending higher. Then short QQQ is trending higher. Short ultra QQQ is trending higher. So just by looking at the list, it tells you what's happening in the market. So in this case, I've just focused on UGA rather, the gasoline fund. And then if we come down here, see, I have it all. I'll add a expert advisor, and we'll attach the swing system just for the heck of it. So this is a swing system, and I'll tell you things in a moment. And you see that it gives you a strong uptrend. It's moving higher. And if I move this over here, see that we have a green arrow which is moving higher. And let's change the template here to make it a little easier. I'm being a little inefficient. Okay, I'll come back to it in a second. But the main thing I wanted to tell you was that CTM is higher. We have a breakout. Let's take something else. Let's do the UUP, which is the dollar index. And you see that the dollar index is moving higher. If we had a breakout and it's been moving steadily higher, this is a trailing stop going higher. And you see this, what the CTM was doing, right? It was above 90. We had a little correction here, then we had this nice breakout. It stayed above 90 for the whole duration. So in terms of visualizing what the market was doing, we were able to run a scan. UUP is near the top of this list. So we know that there's an uptrend because the value is greater than 90. And then we can apply different trading strategies. In this case, I have a long-term breakout strategy applied here. And you see that we have a trailing stop that's being plotted for you. So it can't get any easier in the sense that we have trend strength. Yes, it's higher, above 90. If you look at the list, it's among the strongest trending objects of US ETF. So hey, that's something going for it. And now, suppose you got in here or here or here or here or here, it doesn't matter. You have a specific exit point that you don't have to worry about, when should I get out? Are they changing colors? None of that is required. Every day you get a new exit point, and you just enter the order and you're done for the day. Or you can try different, different time periods. Okay. So now that we have a general idea of how this works, let's actually retrench a little bit. And I'll give you a bunch of examples here. Let's just close it out. Oh, looks like I managed to close out. That didn't help. I'm going to restart MetaStock. Sorry about that. So what I was trying to do there was I was trying to show you how the scanning process itself would work. So the idea there is that we're going to explore different. Here we go. So what I want to do here is I want to just use the CTM, and I'm going to just use the 11 sectors in the S&P. So the S&P has 11 sectors. We're going to just run the CTM and see what it tells us. So let's do the exploration. We have the answer. Let's move the symbols over and sort them. So if you look at this list, the XLE is at 92, so that's very strong and trending higher. That's energy. And all the other sectors are below 50. And of course, technology and discretionary are well below 10. There are 4 sectors below 10. So right away, as an investor or as a trader, you can either go to the bottom of the list and go short, or as you saw on the ETF list, there were the inverse ETFs at the top. Or you can say, I want to look for trading opportunities in energy because XLE is at the top. And if you just look at this chart, let's apply a template. So see, it's breaking out in new highs. We have a counter trend entry into this over here and a trailing stop. And the CTM has just gotten above 90. So the idea is that if you look at the evolution of CTM without looking at the prices, you know that somewhere over here it started going higher, then it stayed pretty, it stayed above 80 for most of the time. Then we have a little drop here. Now it's trying to go back up. And if you look at this, what's happening here, you see that we had a steady uptrend, a little sideways consolidation, and then a move up again. So the CTM gives you a bird's eye view of what's happening by looking at a lot of different internal details of the market and just reducing it to a single number. So you don't have to think about it. Okay, now what we can do is let's go back to let's close this out. And let's close this out and go back to the search process. And we know I have the energy markets over here. So we know that we did the scan from zero, all the sectors, the top sector was energy. Now we can drill down into the energy sector and say, what are the opportunities here? So again, I'm going to use the CTM. You can use a scan that's built in. It doesn't matter. That was just for convenience. So we have the results of the scan. It's pretty quick. We'll move the symbols over and we'll sort them again. And you see that we have something that's trending very strongly, like Dorian or Vertex, because they have a CTM of 100. Valero is trending strongly. Phillips 66, the Devon Energy is trending strongly. So just by stepping down from the top level of the S&P and finding XLE or energy, the top sector, we can dive into the energy sector and do a ranking by CTM. And now you have many different trading opportunities that you can look at. So if I just open the first one, which is Dorian, and you can see that, what did you expect, right? You expect a breakout because see, there's a breakout here. The CTM is above 90 and at 100. It flagged the breakout. You could find it, and you have a specific trading stop. And then if you wanted, now this is a long-term trailing stop. We can also change the strategy and go to a shorter-term trailing stop. And all I need to do is just change, add an expert advisor. We'll do an attach. And we'll do the swing system. And you see, we got in here. And if you do the expert advisor commentary, it gives you a specific stop to get out at 12.24. So there's no mystery about where you got in because you got a specific up arrow that told you this is the time to enter. And then there's no mystery about when to get out because the commentary tells you get out at X price. So you enter your stop and you're done for the day, or at least to the next trading day. So the idea is that you can take advantage of my trading experience and say that all of these, whatever weighting, et cetera, or the various technical indicators is all buried in a single indicator. And we're just using it to find the opportunities, what to trade. And once you have what to trade, you can look at different ways of trading it based on how you want to trade it. You can go short term, long term. I can change to intraday. So for example, right now it's a daily data, but I can change that to say hourly data. And you'd get a very different look at the market because you got this breakout, you got stopped out here, you got a breakout, now you have a breakout here. So just depending on what you want to do, you can try different things. So this is an example of being able to take the trend following ideas and use the trend meter to find a trading opportunity. Okay, that's great. Now let's try something else. So one of the things you can find here is a long-term system. So I'm just going to apply the long-term system to the energy sector because you want to say that, okay, are there any long-term trends? And I want to trade the long-term trend, which gives you a different set of entries and exits. So let's try that. So we'll try that as an exploration. It's looking through 121 stocks and it's saying, is it meeting long-term? And I'll explain the systems in a minute. I just want to give you a flavor of what's happening. And again, here, Devon Energy is on top. And Oxy is on top, Vertex is on top. So we can apply Devon, for example, here and open the chart. And this is a great example of how the long-term system is set up. So at this point, without worrying about the details schematically, what we're trying to do here is that we have these green bands. There's some measure of very long-term trends. Devon moved its way above the this particular bands over here, so that creates the entry condition. And then we have a trailing stop. And you see the trailing stop can be adjusted. So if I click on that, right now the multiple is 6. The default is usually the multiple is 8. The default is 6. So if I move it to 6, you see that the trailing stop moved up. So based on your individual sort of preference for a loose stop or a tight stop, we can apply. You can use a multiple to be close to prices or far away from prices. So there's a price to be paid on both sides. If you get very close to the price, you'll get stopped out more often, but then you'll get closer to the top. If you're far away, you'll get stopped out less often, but then you'll give more money getting out. So it's a bit of a trade-off. Now, another thing I want to point out is, see, when the prices are going sideways, the stop just kind of dribbles down or mostly stays flat. And when the prices accelerate, the stop accelerates as well. So it is adjusting dynamically to the changing volatility of the market. So the main thing here is that, say, for example, it went here from about, say, 16, 17 to about 70. So let's say let's went to 15 to 70, let's say. So you have approximately got a 5x move. But there was a lot of back and forth throughout this move. So that's one of the challenges that you have to be aware of. That is that if you want to participate in a long-term trend, then you have to be willing to absorb a lot of volatility, because as this Devon shows you, there's a lot of bouncing around, even though it steadily marched higher. So this is an example of a long-term system. Okay, let's close that out. And what I want to do now is sort of use Tesla as my benchmark and demo a couple of system ideas to you. Just explain the systems a little bit in detail. So, let's start with the okay. So let's start with the volatility breakout system, and I'm going to come here and expand this a little bit so you can see. So this is Tesla in December of 2020, November of 2020. They're going to be added to the S&P 500. A lot of excitement. It went up. But before that, it was consolidating for a long time, several months. And you see there's a green dot here. We had a large one-day move when it came out of its consolidation with a big one-day step. And this system reacts to a one-day move. And it said, okay, now I want follow through above this bar. And so it's a volatility breakout, and you're entering one day after the breakout. So the market followed through, Tesla followed through. We bought it somewhere here maybe. And then now we're just following on a trailing stop. And you see the trailing stop keeps moving higher, and we got out maybe 3 days after the absolute high of the move. So this is an example of Tesla with a volatility breakout system that reacts instantly on a 1 bar basis. And then so we have a volatility entry, and then we have a trend following exit. So you see that it's very clear cut and dry. You know, the points plot out. There's no debate about, you know, should we be getting out? It's turning blue, it's turning green, whatever. And you know, you just enter your stop and you're done. And when you get stopped out, you get stopped out. Move on to the next trade. Now let me show you the swing system. So the swing system, this is the green line, sort of approximately a signal line. And you see that above here, I have the 7-day stochastic RSI, which plots on a scale of 0 to 1. So if you just look at this stretch here, the market was weak, and you see the stochastic RSI was at 0. So we have weakness, then we have strength after weakness. So the stochastic RSI is back at 1, and we're buying strength after weakness. So the entry conditions are satisfied. We're in. Once the entry is satisfied, the trade is on. Then we have nothing to do with what happens here to the stochastic RSI or anything else. We're strictly trend following, and we're just going to take a trailing stop. So this is a very clear-cut and dried system. Don't have to think about it. Once you get a signal, you take signal and keep going. So again, I want to go back. I already showed you this volatility breakout system, volatility breakout here. And you see this time the volatility breakout entered here. The swing system entered there. And again, we have the trailing stop, and we got out at pretty much the same point as the other one. So the point is that there's this entry setup condition, but once the entry is satisfied and you're in, then the entry goes away, all that logic disappears, and you just have to worry about the exit logic. And you see that we have top scola, take our profit slowly, or cut off losses at once. And so there's no ambiguity about where you're getting in because it meets some conditions, strength after weakness, we're in, and there's no ambiguity about where you're going out. So it can't be any easier than that. You just get in, you get out, you decided you're going to trade Tesla or not trade Tesla, or you trade something or not trade something, and you're off. Okay. And then I want to show you the long-term system. So Tesla with the long-term system. This is the spike we had to the all-time highs before Elon sold, I don't know, 10 billion or whatever of the stock. Now you see that this is a different logic. We're back to the Devon trade. If you remember, there was the green bands and the price was above the green band. So it's a long-term thing we're buying. And now we have the volatility trailing stop. And you see that that stop got out only 2 days after the absolute high of the move and not very far off from the absolute high of the move. So these exits are powerful, adaptive, and they have a very interesting significance. So if I come over here and if I detach the long-term system advisor, you can see it a little more clearly. You see that once the prices fell below the trailing stop, they had a hard time getting above it. So that's an example of the power of the trailing stop. So it captures more than just volatility. It's telling you something, insights about the market and how the market itself is working. Okay, so let's try to encapsulate. I know I've thrown a lot of information out for you. It's very, very confusing. So this is pro-level technology. It's been boiled down and simplified. So it's very, very simple. You have two sets of problems. The first is what to trade. And for that, we have the trend meter. So it's like putting a trend thermometer, give me a reading. If it's hot, I'll get a reading above 90. Great, I want to be long. If it's cold, it'll be like below 10. Okay, I want to be short, or I don't want to even think about it. And then once you decide that you want to trade an object, you found the object, you found the needle in the haystack, then you can either follow whatever process you want, or you can use one of these systems which give you like two different types of trailing stop, the volatility trailing stop, and then sort of what I call a delay channel trailing stop, which is adapting more through time. And you get a specific exit point. So there's no ambiguity about where to get in. Tesla's at 9, let's say, even if you get in a bit later, so like over there, you can still use the exit. So, you don't have to worry about getting the exact entry or exact day of entry of the system, because you can say, I'm in, now I know where to get out. So that's the power of the package, right? You don't have to take somebody else's opinion for it. You don't have to take my opinion for it. Trust your eyeball, look through the data. This is trending. Okay, I want to trade it now, and in or out, and then when to get out. And if you look at the volatility breakout and the swing system and the long-term system, you have a one-day reaction on the volatility breakout. You have a multi-day kind of entry, slow entry on the counter trend. You're buying strength after weakness. Or the long-term system, like on this chart, where you have a very, very long-term set of band. It takes a long time for the thing to go above. But once it's done all the hard work of getting above the band, then you want to kind of trade it with a rather loose exit to allow it to give it some room to breathe and see how far the trend goes. So in today's market, when there's a war in Ukraine, China is fighting COVID, Fed is fighting inflation, things are so complex and difficult, and even the top dogs on Wall Street are constantly revising their targets down for the S&P. You don't have to take their opinion or my opinion. Just run the trend meter, find what's trending, and trade it. So I'll give you another example. Let's just close this out. Hopefully you've got a sense of what's going on. What I want to do is here, I want to look at the FX images. So I'm going to look at, we know that interest rates are rising because the Fed is raising rates. So when the rates go up, the currency gets stronger. So dollar gets stronger. So dollar gets stronger, i.e. the corresponding other side gets weaker. So the yen is weak and so forth. So even though the equity market is going down, there are trends in the currency market. So let's look at that and see how that is sorting out. So here what we have is let's just move it over, and again CTM. So So Canadian dollars versus the Canadian dollar Swiss franc pair is strong because Canadian dollar is a export economy that exports natural products. So anytime there's a demand for energy or minerals or metals, they're strong. So let's just look at the chart. And surely, we're getting a breakout, as you would expect. Let me just change the template. I'm just going to apply the swing system because it's a little easier to see what's happening. Okay. If I can move my cursor. Okay, here we go. So the CTM is above 90, so we know the strong uptrend. And then we're just buying strength after weakness. So this consolidated, started moving higher above this trigger line we're in. Now we have a trailing stop. And if you look at the expert advisor and the commentary, it tells us get out at whatever. So don't have to think about it. You found the opportunity with the scanner or the trend meter. Now you can trade it with anything else, or you can trade it with one of the systems in the package. And the swing system is kind of a good default basic system where you can get in where you need to, or where you could, or when you thought about it, and now you have a specific exit to get out, right? But we have a trailing stop here, so don't have to think about it. If you want, you can try something else. But let's look at Japanese yen. Let's close that out, and let's look at Japanese yen. So, again, the dollar is strengthening versus the yen. So you see the uptrend over here. The futures will be the reverse, and again we have a trailing stop. You can see that CTM here. If I expand the scale out here, regardless of what, see the CTM rose above, got to 100, and kind of stayed above 90 for a long time. So don't have to think about it. And down here, we have a trailing stop that keeps moving higher and higher and higher. And again, you can just enter your stop at the start of the day or however your broker allows, and you're done. You just have to wait for the next day to do something. So again, the idea here is that yes, the equity markets are not trending, but something else is trending. And we looked at the ETFs, and you could do the UUP as the ETF equivalent of being long the dollar. So there are many different ways to find trends. And then I've given you 4 simple ways to trade the trend. And if you want a very long-term trend, then you have the long-term system. And if you want something shorter, you have the counter trend systems. And then in any case, you can separate entries and exits. So you have a delay channel exit, and you have the volatility-based exit. So in any case, you can still just use the exit part of it to know when to get out. And of course, you can calculate your risk from the entry point to the exit for that day, so you know how much you should trade. So the money management also falls out of it. So you see that there's a tremendous amount of power that's packed into this package and makes it super easy to use. All right, so I'm going to try and go back to my presentation here, just to kind of give you a sort of a summary look at it. Oof. All right. So we're using the same rules across the board here. So we have the trend. Is it trending? We have multiple time periods and indicators. We have the trend meter. For the long-term system, we have a trend following buy. We have buying strength. It's going above those long bands, and we have the volatility exit. Then we have the volatility system and the swing system, which are a counter trend entry. Primarily, we're buying weakness or buying strength after weakness. And then we have the delay channel exit. And remember, these can all be separated, so you can just use the volatility exit on a particular trade if you want, or just the channel exit if you want. So all the building blocks can be put together and used together, or they can be separated, and you can use whatever little block that you think meets your needs for the moment. Again, just to reiterate, it's a tick box culture, absolute trend strength plus persistence. The scale is 0 to 100. We have closing prices, 4 time periods, and 5 different types of technical indicators, bands, channels, patterns, oscillators, and returns. There are no input parameters. You don't have to choose anything. You have to use 14 or 18 or whatever. and any time frame. So I'll show you an example of any time frame. Let's go back and go back here. So I'll use NASDAQ futures as a template just to show you that you can switch time frames from 1 minute to monthly and back again. But and I put the swing system here, so you can see the counter trend entry. So here I have 5-minute chart, and you see that when there was let's go back a little bit here. So in this, on the left hand side, we got a long entry came out over here. This is a 5-minute chart, got stopped out. CTM was above 90, selling. You could have gotten short, and today, of course, we got a counter trend buy signal here. So let's change that to say 10 minutes, and same data stream, but we get a different view of what's happening. So again, you see that when you have strong uptrends, we have values above 90, downtrends, value below below 10 or below 20 here, and counter trend buy, you're buying here and selling there. Buying here, selling there. It's a very, very short time frames. Now, let's say I go to a 30-minute chart. Again, same logic, but expanding the time frame. So you see that we have this big selling, then we got the initial reaction, we got stopped out, we bought very close to the bottom, kept going, got stopped out, but again, stopped out. Now see here what happened. Tremendous selling. NASDAQ was below 20 all the way through the futures, and you see it was going, steadily lower. So now if I come back over here and go to hourly data, again, strong selling, you see it's below 20, strong selling below 20, counter trend buy, trend following, got stopped out here. I think this was a Powell news conference, got in here, got stopped out, a little bit of profit, and then, and you see that just if you want to go short, you just have to look up here. And this is exactly the same logic. Now we went from 5 minutes to 1 hour, and we can keep going. So for example, I can go to 4 hours, same logic everywhere. You see that we got this rally in March. You got in very close to the bottom here. You got 1 move, 2 moves. So you're able to capture the bounce very nicely. And then selling below 20, selling below 20, selling below 20 when it's above 80, above 90, doing strong trend. So that's same logic everywhere, just changing the base time period. We can go to daily data. Again, October, because big nice rebound in the market, we caught that above 90 here, and then selling. See, there's no doubt it's being sold at this point. You can just wait. You got a counter trend entry, you got a little bounce. We captured that move here. So again, if I go further back, various bounces, you caught them. Let's go to weekly data. It's a little easier to see. Now you see when you have a very long time period here, and you see that it was above 90 and all the way across during the major uptrend. This is March 2020. We got not too far from the bottom and followed it up in just 2 moves or 3 moves, depending on how you count it. So the point is that the trend following is very easy to do with the counter trend system with a well-defined exit. There's no ambiguity about when to get in, when to get out. No judgment required. You can use the scanning process to find trading opportunities using the trend meter, which is like a trend thermometer. You want to stick it into the data and say, is it close to, or is it above 90, or is it below 10? What could be simpler? And any exchange anywhere. Okay. So I'm going to wrap up here and just remind you that what we saw, this is the volatility breakout, 1 day of decision. This is the swing system, takes a few days to develop, buying strength after weakness. And then this is a long-term system, the plot develops over a long period of time, and we're just going to be along for the ride. So again, what versus how, that's a very important difference about how the stock is structured. Any exchange, any time frame, any type of instrument, any type of market environment, don't have to take my word, use it. Anyway, the bottom, I'll just enter these 2 slides. This is just a reminder that this is Microsoft. You can go from monthly data to weekly data to daily data to intraday data, and the thing scales seamlessly, is interpreted the same way. When you have strong uptrends, you're above 90. When you have strong downtrends, you're below 10. Nothing could be simpler. And then remember, the market is going to test what you believe every single day. So trading is all about confidence. You need robust tools. We're using the same rules on everything, and confidence, because When you use the same thing again and again, you only have to learn 4 things: CTM and 3 systems, 2 exits. Couldn't be easy. So I'm hoping that you will get the package and try it out, see how it works. I think you'll find it worked quite well for you. And then please sign up for my blog over at chandeindicators at substack.com. And I think I'll hand it back to you, Jeff.
Just trying to type in this real quick. chandeindicators.substack.com. All right, so that way people can click on it or copy it out. Great job, Tushar. We don't have a whole lot of questions. Michael was asking some questions about the different stops that are included, and I tried to answer that a little bit, but maybe you could kind of talk about the different indicators that provide the stop values and how they're used.
The stops, you mean? The stops?
Mm-hmm. Yeah, correct.
The stops are, okay, so there's a long-term volatility-based stop. So essentially that looks at volatility over a certain period and subtracts that from a high or whatever you choose. I chose 100, but you could choose 50 or whatever you need. And the multiplier is 6 by default, but you can choose any multiplier you want. So the whole argument is, how do you define volatility? Should you use 100 bars or 10 bars or 30 bars or whatever? But essentially you're using a recent high, you're taking some backing off some distant x, and x is a multiple of some delta, which is some calculation. So the magic is how do you calculate delta, and there are 5,000 different ways to do that. And then the multiplier, so I've adjusted it so that 6 seems to be a pretty good multiplier, and because you can use y dot at 8. And then the other type of channel indicator is basically a delayed channel. So essentially you're adapting via time. But not only that, you're also adding a delay. So that gives you a little more opportunity to follow the trend. So since we said that our goal was top scholar, we just want a little twist on it. So we're using a little bit longer trend delay channel. So that's just the X bar low delayed by some delta Y. Y could be whatever you want. And then the idea is that obviously there's some balance. If you go too far out, it doesn't make sense. If it's too close, it doesn't make sense. So just a matter of adjusting where you want to be.
Thank you, Tushar. Appreciate it. Good job.
Thank you very much.
All right. And I'm going to actually kind of talk a little bit about the system as well. Tushar, thanks for coming in again, and your work and just your professionalism. It's been great. I appreciate your
great. Thanks, everybody. And I hope you'll get the package.
All right. Sounds good. I hope so, too. All right. I hope you're enjoying yourself as well. Let me go ahead and make me the presenter real quick. Okay. Let me go ahead and turn that on, share my screen, and just talk a little bit about what's included in the package. So as part of the method, all right, thanks, Kelly. As part of the method, you're going to include, it's going to include the, it uses a few of the indicators in MetaStock, like the stochastic RSI that I was talking about earlier, but it's also going to include some indicators that are installed, and here's a list of those. In addition to that, you're going to get basically 3 very unique systems. So you get the long-term system, the swing system, which is a bit of a shorter time frame hold, and a very, very unique volatility breakout system where it looks at ATR and looks at the average movement of a stock to determine if a breakout is significant above a previous high. Very, very kind of unique. As somebody, I like to trade a lot of breakouts, and to be able to scan for kind of the way Tushar likes to look at those works really, really well. So this is a full integration to MetaStock. We've talked about all day how you can use MetaStock as a scanning tool, and it does have scans. We showed how to run scans a little bit. You can scan for the long term. You can scan for just a trend meter that identifies strength or weakness in stocks, or Tushar used it for the industry groups earlier. It does have the swing system and the volatility breakout system as well. So all of those are included as explorations. All of the systems include expert advisor, and we won't, just based on time, I don't think we're going to kind of get into MetaStock too much, but right here you can see that it does have a fully integrated expert advisor. Here it's telling me on this particular Costco back in October when buying was a good idea for Costco. It's telling you that you should get in a long position and giving you a stop and an exit, and being very, very clear about how everything is designed. And so that exists for both the swing system, the long-term system, and the volatility breakout. The other thing that I really like in there is the fact that it also does testing. So MetaStock has a system tester that's built in. It's included as part of the methodology, and it allows you, it's one of the more, I'm biased, I'm 100% biased, but MetaStock system tester is one of the most powerful system testers I've seen. With a lot of system testers out there, you can say, how does this work against Apple or Costco? And you can give it a stock and it'll say, okay, this is how well it worked. But with MetaStock, you have the ability to test whole groups, so like whole groups of stocks, up to 5,000 at once. And so based on that, you can see how well they work on a single stock, on a market in general. You can test different time periods. It's a very, very comprehensive system tester. I just haven't seen anything quite as powerful as our MetaStock system tester before. And you can test these. So this is a test that I ran a little bit earlier, and you can see that on the average that I ran on the aggregated systems, the swing system was very, very profitable over like the 4 years or so that I tested. And then the long-term system, all of the systems performed well. If you drill into that, and we'll talk about system testing a little bit more when I go, but when you can drill into that and see how well it performed on the best performing stocks versus the worst performing system stocks, and you have really good matrices to see exactly what's going on, both specifically to a stock and in general to a whole market. So does a very, very good job. Tushar Chande's complete toolkit is, again, a one-time cost. Normally, it's only $500 as a one-time purchase. Here at the webinar, it's $399 as part of our conference promotion. So, and that will include a 30-day money-back guarantee. It'll include a recorded training that we did here. Let me go ahead and just take out the live bootcamp. I thought I had actually adjusted that. I think I've had a couple of issues here, but it will include a recorded bootcamp training. And as with all the rest of them, free access to MetaStock, a free trial to MetaStock if you need it. So to take advantage of that, and of course, a money-back guarantee, so you can try it if it's helpful for you, if it helps you identify better trades. How's your trading going now? Is there things that you think you could be doing better? Well, what a good way to evaluate this and kind of determine how is this helpful for me by one of the most renowned technicians, Tushar Chande. So here, 800-882-3040. You can visit us online at metastock.com/salespchat, or you can go to metastock.com/conf-promo to take advantage of that. And I would recommend you give it a try. Tests really, really well. As you saw right here with the system test, that swing system tested really, really well. Long term, all of the systems were profitable though, and the swing system extra. So again, 30-day money-back guarantee. You can try it out with MetaStock with a free trial if you need it. It's going to include some bootcamp training that both Tushar and I sat down and did back in April. It's recorded. It's available. Give us a call, 800-882-3040. You can visit us online at metastock.com/salespchat, or you can go online and do it at metastock.com/conf-promo. So there we go. Let's go ahead. Yeah, we'll do stocks and commodities this time. I want to thank our sponsor here at Stocks and Commodities Magazine for supporting and sponsoring the event. They have a 17,000 article archive that's available, 1.3 million subscribers. They've been publishing every article, or they have been publishing since 1982. So one of the most renowned magazines, the only one I'm aware of that actually deals only with technical analysis in stocks and commodities. So as part of what we're doing today, if you do a trial subscription to MetaStock, you're going to get a 5-month subscription for free. If you spend $300 or more, you'll get a complimentary 2-year subscription as part of that. So there you go. And then we have talked a lot about MetaStock. If you just want to try MetaStock, maybe you want to be able to test trading ideas, scan the markets, do forecasting with our patented forecaster, and just kind of see when MetaStock's been rated almost 30 years in a row the #1 software in its price category. What we're doing today is we're going to offer you an extended trial. So if you pay for 1 month of MetaStock, the pricing starts at $59. We're going to give you a second and a third month for free. And what that means for you is for about $20 a month, you're going to be able to try the software that's literally been rated #1 without missing a year for 29 years in a row. And there's a reason. I mean, it's a tool. Over the years, it's kind of funny. We've seen a lot of competitors come and go into the charting space, a lot of them. And very, very, very consistently, we've been rated #1. We've been working on these tools. It's a very, very mature tool. We just added a brand new charting engine to it and 54 more systems. But there's a reason it's been rated #1. There's a reason that you should try it. And this is a great opportunity for you to go ahead and try that, because for about $23 a month, if it doesn't work for you, you can cancel. You'll still be able to try the program out for 3 months. But if it's helpful for you, if it's useful for you, if the scanning, I use scanning every day, you should try it out. Anyway, you can find out more. Go to metastock.com/saleschat. Give us a call at 800-882-3040 and try it out. There's a reason it's been rated #1 for 29 years straight in a row without losing one. So 800-882-3040 or metastock.com/saleschat. You can also sign up for that if you want to go to the website at metastock.com/promo. So there you go. Let's see. And there you go. Our next guest is, and we're right on time. That's not important. It's probably the least important thing for me, but I'm glad we are on time. So our next guest is John Seville. He has been doing a number of presentations for us over the years. Very, very entertaining. He does a really, really good job. We've built a lot of indicators with him around his smart money tactics. He's a great educator. Been doing it for a long time. So let's go ahead and kind of bring him on here. John, how are you doing? Oh, I see you, and I do not hear you.
There we go. Can you hear me now?
Yeah. Okay, good. I thought we were going to run into our one technical issue per day, which is how many we afford ourselves. One. So.
It's okay. I figured there was a mute button somewhere going on.
Yeah. Let me go ahead and I'm going to go ahead and make you a presenter here. It's going to share your screen. You can work on that. I'm going to ask for one assist from you real quick too. What I would like you to do, John, when you have a second, is give me a random number, anywhere between 1 and 7,000.
2,300.
2,300. You know what we're doing here, right? We are giving away a prize. Yes, it took me a few sessions to do a prize, so we're going to give away prizes all the rest of the day. So should I tell them what they've won? With this particular prize, we're going to give you a free month of MetaStock. We're also going to give you a Rahul Mohindar ATM subscription, which is one of our educators that we work with in India. He's built a bunch of tools into MetaStock. We're going to give you a free month of that, as well as a free month of MetaStock, as well as a coaching session. That's a value of around $400 or $500. The lucky winner is, forgot to get going back to 2,300 here. The lucky winner is, come on. I'm only to 2,400, so we're going up here. The lucky winner is Khalid A. Khalid, I'll reach out to you with that prize. I'll probably need to collect a little information from you to get it to you. But congratulations, you won. John, we can see your screen. I can hear you. You look great. It's all your turn. I'll get out of the way.
Terrific. And happy birthday again for the weekend, Jeffrey.
Oh, thank you. Thank you. Appreciate that.
Well, thank you for having me back. I'm really excited to be here. Jeffrey and everyone at MetaStock is such a pleasure to work with, and we've been working with them for years. So I'm really thrilled to be here today, and I'm going to be talking about smart money trading, and specifically what I'm going to be focusing on today is how we track the insiders to find some pretty exciting trade setups. In the market that we're in right now, especially where we're in a bit of a market meltdown, market meltdowns mean opportunity. If we know how to find the right opportunities and how to find the diamonds in the rough versus stepping on the landmines, so to speak. So we're going to talk all about that today. We'll start off, however, by going through a quick disclaimer. Of course, this is for educational purposes only, not a recommendation to buy or sell any of the securities discussed. Acorn Wealth is not a registered financial advisor in any jurisdiction or province. Any of the positions we discussed today, however, may be being held by myself, the Acorn Trading Fund, or the employees and contractors of Acorn Wealth and Smart Money Trading. And there are no guarantees with any financial investment, not stocks, not real estate, not options, not anything. So we won't make any silly guarantees today either. You can assume my results are not typical. I've been doing this for 20 years, but hopefully we will be able to share some deep insights as to how to shortcut some of the learning curves and talk about this today. If we do talk about any customers' testimonials, again, we do not verify their account balances or anything. They are real customers, real testimonials, but we don't verify their financial statements in any stories we share. Okay, so let's get started. How to predict explosive moves by following the insiders. So, I mean, a little bit about me. Again, if there are those of you in the audience that are familiar with Acorn, been to one of our presentations before, maybe the last MetaStock presentation last year, raise your hand, throw a one in the chat box. We've been doing this since 2007, and so we've trained roughly over 5,800 students, and the focus that of everything that we do and teach, is built around what we use ourselves. So when I got into trading years ago, what my interest was in trading was to have something where money could work for me. Buffett says, what's the famous quote? If you don't find a way to make money in your sleep, then you will work until you die. So for me, trading was exciting because it was this way that, if you had a good strategy, you could say, okay, program in your strategy, program in where you wanted to buy and sell, and you could set it and forget it. And you can do that from anywhere in the world as long as you had an internet connection. But the problem with my pursuit of this early on was that I got lured in away from this idea of traveling and trading, and I got much further towards the other extreme, which was being glued to the screen all day long. I was day trading Forex, stocks, options. If cryptocurrency had existed back then, I'm sure I would have been trading that too. And I had 6 screens, and I had spent tens of thousands of dollars on indicators and different systems and things, and I wasn't making any money. I guess that was to add insult to injury. I was spending a lot of money and all of my time and not making any money for it. So, put a 1 in the chat box if you've been there. And of course, I was well off what I wanted out of trading. I now had a really low-paying job, essentially. And so when I met one of my mentors, Strathy, whom some of you may remember, those of you who've been with Acorn in the past, Strathy was my Warren Buffett, and he said, look, you've got to get rid of all the clutter and focus on what is really going to move the needle, and that was smart money, right? As he said to me back then, and it's much more significant now. JP Morgan estimated that anywhere between 80 and 95% of all of the shares bought and sold each day, or stocks bought and sold each day, now come from algorithmic trading. So computers deciding where to buy and sell based on programmed algorithms, programmed patterns. So the first thing he said you really need to focus on is to get rid of a lot of the bright, shiny objects and focus on, most importantly, price action, patterns, right? You want to be on the winning team. You want to be going with the volume, not trying to fight against it. And secondly, he said you really want to focus on is understanding how to detect when those really big money moves or smart money moves start to step in. And so this was the beginning of where the concepts that I'm going to teach you today come from. It's about, our focus is how to keep it simple but sophisticated, but simple. And so the overall rule of how we execute this is to focus on the smart money. And so I'm going to be covering these 2 points in depth today. Is how we use patterns and smart money to create a robust strategy that we can then go into and utilize in any market conditions, but especially in these market conditions where we're seeing these big pullbacks and some amazing opportunities building in the near future. So first of all, what I want to talk about a little bit here is one really powerful part of smart money and how it's applying to what's going on in the market at the moment. And that area that I want to talk about is the bond market. Now, generally, when I say the bond market, to many traders, that's like for some people that can be scary. You know, gosh, I don't understand bonds, treasury yields, inverted curves. So don't worry if you don't understand the bond market. Don't worry. In fact, when I first started trading, I thought bonds were a type of underwear, which they are in Australia. But the area of the bond market that I want to talk about specifically is high yield bonds, or junk bonds is another term for it. So HYG is the symbol. You'd be able to look that up in most charting platforms. Certainly in MetaStock you can. So what's so special about this part of the bond market? Well, firstly, let's also understand that the bond market is the really smart money, right? The bond market is significantly bigger than the stock market. So when we're talking about Federal Reserves, governments, that Fortune 500 companies, it's the really big, really smart money that's in the bond market. And so high yield bonds, what these are in a nutshell, is this is an area where if the really smart money, if the bond market feels confident about the overall health of the market and the economy, they'll feel like taking risk. Right? And so one way they take risk is they lend money to corporations in America. And in the junk bond market, or the high yield bond market, basically this is usually where higher risk companies are. You know, some high flying tech companies, startups, things like that. And in a booming market, the bond market will say, you know what? We've got no problems lending money to these companies, and we'll get our dividend in return. Fantastic. And so they'll buy high yield bonds. Now, if they get spooked, if they think that we're heading into trouble and they want to get out of that risk, they'll sell the high yield bonds and they'll go down. So essentially, it's a very instantaneous way of understanding what the really big money's feeling is on the market. So naturally, what you'd expect to see is the bond market the high yield bonds should go up with the stock market. So as the S&P goes up, high yield bonds go up with it. If the market starts going down, as indexes are going down, high yield bonds go with it. They're correlated. But where this becomes a really powerful tool in tracking the smart money, especially when using it to predict major market reversals, which is how we use it, this has been an incredible tool for looking for divergence. So one of the things that really put us on the map is our calls on major market reversals. We alerted our students back in March of 2008 that we saw a major crash coming. 2015 twice, 2018 twice, in February and October. We warned of those two crashes 3 weeks before they happened. And in 2020, we also made another very similar alert. We did 43 live events. Some of you were probably in those in late 2019, warning of another 2008-like crash. Not because we knew about COVID-19, but because we saw indicators, because we saw smart money telling us something bad was coming. Now, high yield bonds was one of these indicators that was present in all of the crashes, and in all of the crashes warned us that it was just around the corner. So how would we interpret this chart? Well, what we've got on this chart is an upward channel. And an upward channel, so if we're talking about smart money, right? Understanding what the price action is telling us is going to come next. The pattern is one of the most powerful leading indicators of all. Lots of indicators are lagging. Patterns are leading. They tell you what should happen next. So when you see an upward channel, after an upward channel has bounced 3 times along support, right? Think of it like a skipping rock, 1, 2, 3. After 3 touches on long support, you've got close to a 70% probability that that's now going to break down. So after 3 touches, you assume that that support is broken. In this case, it bounced 1 more time. That's fine, but you're planning for a bearish break. And so how much is it going to break down? Well, you measure that channel, and that's the minimum that it should drop to. Okay? So if that makes sense, again, just throw a 1 in the chat box. All right. All right, so next, what happened? Well, we've got this pattern saying that the big money is preparing for a drop, and down it went. So you can see that drop down to that channel target was almost exactly. And then what happened is it rallied back. It's a weekly chart we're looking at here. It rallied back up, tagged that bottom of the channel, rolled over, and got much worse. So this is one of the tools that you can use in anticipating what's about to happen in the market. It is invaluable in predicting major market reversals. So this is something that we look at every single week before we make any alerts to our students and things like that. This is one of 3 smart money indicators that we use that has saved our bacon in every crash. That's how valuable it is. So let's talk about what's happening now. So it should be no surprise that when we looked at high yield bonds last year, what you're looking at here is a daily chart of HYG from early 2020 all the way through to 2022. So take a look again at what the smart money is telling us. When you look at this chart, you don't need to have been understanding what the talking heads are talking about, what was going on geopolitically. All of that is interesting, but the most important thing that I want to know is what's going on behind the scenes, because it's behind the noise, right? What's the data telling me? Because there's so much information out there, but not enough insight. So this gives me insight. It tells me that the bond market is not happy. This tells me that we've got a very perfect rising wedge. And like an upward channel, a rising wedge is bearish. And like an upward channel, the way we measure it is we take a measurement of the widest part. And once we break down below that support, that's the minimum of how far it should drop. So this rising wedge was building all through 2020 and into August of 2021. And then it broke. And this was when we started doing a lot of workshops. Again, maybe you were part of one of those, where we said, look, this is the most dangerous chart in the stock market, because for 2 years, this has been a warning that another correction or crash is about to happen. And the timing of that began right there in August, September of last year. And what you'll be able to see here is as it broke down from that rising wedge, can everybody see the pattern that it formed as it came out of the rising wedge, as it formed that first sell signal, the big warning signal? What pattern came next, guys? What pattern came next? A head and shoulders. Tough. I mean, and this is the way that you are able to simplify it. I mean, what this is telling you in a simple way is the insight into huge amounts of information that's been interpreted for you and lets you know what to do about it. And of course, what this is telling you to do is get the hell out of the way of trouble, reduce risk, update your stop losses on all the longs that you want to hold, and start looking for shorts or go to cash, right, if you don't want to go short. So anyway, obviously that continued to drop And so going into November, September, as early as September, we started telling our students this is the perfect time to be looking for really good shorts. And as you can see, the high yield bonds market rolled over and was diverging down, giving a very clear warning of what was coming next. And then, of course, the market started to break down in January. So to me, this is really, really awesome stuff because it's giving us the insight we need to see major market moves coming ahead of time. And as I said, we don't have time to go through all of the examples, but it gave a clear sell signal in every crash all the way back to 2010. So the next step, the next part to this, right? So we've talked about kind of the smart money from the bond market and some of the ways we chart that. But now I want to take you to the even more exciting area of smart money, which is the focus of today's talk, which is the insiders, right? Because the insiders are also a very cool place to look for ideas and heads up on when big moves are about to happen, explosive moves, as the topic today suggests. And so the chart, by the way, I was showing Adrian was HYG, high yield bonds. G'day, Ralph, by the way. Nice to see you, my friend. So the insiders. So the insiders are a special group of traders that I love to focus on. And the way that I found out, really discovered the value of insiders was through a nasty learning experience that I had. So I'll talk to you about some great wins that we've had soon and show you the value of insiders. But I'm going to start off by telling you about one of my worst losses. Because when I was fairly new to trading, I was in Vancouver and I was sitting in this little pub on Granville Street, for those of you who've been to Vancouver. And, anyway, I'm sipping on my Guinness, I think I was having, and there's this table of guys in bright, shiny Armani suits with the Rolexes on, sipping champagne and cheersing and celebrating together. And I could tell they were talking about stocks and their company specifically. And so, I'm a new trader, and I thought, maybe this is a good opportunity to learn a bit here. And I started eavesdropping and joined the conversation and said, they told me all about how great their company was and how much money they were making, and so I got lured in, and I said, well, guys, how much should I invest in a company like this? Like, it sounds like the company's doing great things. How much should I put in, do you think? And they said, well, Johnny, how much do you want to put into a stock that could go up 1,000%? And I said, ooh, all of it. and I went home and I broke every one of my rules, all of my risk management, everything I'd spent, all of this hard work building, and I put every single dollar of my account into this company. And you know what happened next, of course, right? The thing plummeted all the way down to zero, with my stomach plummeting with it. And I cashed out, and that was how I blew up my account. Expensive lesson. And as horrible as that was, what was even more horrifying was later finding out that at the time I was buying, at the time I had met them, those insiders were selling all of their stock. They were selling all of their stock into the market at the same time they were telling me how great it was. So this was a lesson where I realized that I was the one buying their Rolexes, their champagne, their shiny suits. I could have well been buying their stock off them in the open market. And this is when I vowed to never, get taken again, because I realized, like many other traders, I was just a lamb for the slaughter. And I wasn't going to be eaten for lunch anymore. So instead, I was going to start using this information to my advantage. And so this is where I really started focusing on making sure I never put $1 into a stock, long or short, until I knew what the insiders were doing behind the scenes. right? So I could avoid those dangerous situations and look for where the real opportunities were. And this doesn't just apply to trades, but this applies to the market itself as well. And so let's, again, turn the clocks back to 2020. Who here missed the 2020 shorting opportunity? Or who missed the buying opportunity when we bottomed, right? One of the best buying opportunities we've seen in our lifetime. We're getting another one now, which is, you could see as a huge opportunity. But 2020, lots of people missed that. But there was one, if you look at the news, the headlines were fueled with emotions to keep people on the losing side of that trade, right? When the market was bottoming, right? All the news read was the worst day since XYZ and heading to 2008 lows. If you followed the news, you would have been kept in a constant emotional spiral. But if you followed the smart money, you would have seen some very actionable insights that they gave us a strong heads up on. So not just from the high yield bonds, but from the insiders themselves. In the 3 months leading up to the 2020 crash, there was close to 13.5, I think it was, billion dollars of insider selling. And more impressively than just the number that they were selling, it's the ratio of how much they sold compared to buy. So if you look at this chart, you can see almost no buying, but significant selling, right? And that was in the 3 months leading up to it. Ralph says, I was there with you in 2020. Many thanks. You're welcome. And of course, when the market, so they got out close to the top. And then when the market bottomed, they bought back. And they didn't just buy back. They bought back in close to record numbers, right? They bought back, the insiders took the money out of their own pockets and bought back billions of dollars in their own stock. And it all happened 5 days before the lowest the market got. They bought at the bottom. It was incredible when you look at the data. And when we saw that, that's when we were very confident that the bottom was in. And that's when we started alerting longs. And of course, this has happened before. Does anyone know when this has happened before, when this phenomena of mass insider buying had happened in the past? The 2009 lows of the global financial crisis. They have had an impeccable track record of selling at the top and buying at the bottom. Why wouldn't we follow them? So from when you start to piece these things together, this is why in times of great volatility, the smart money get very wealthy. There's more billionaires and trillionaires created in 2020 than I think in any time before, right? So when most people are suffering, the rich are getting much richer and the poor are getting poorer because of this divergence of the access to the knowledge. So I mean, when I'm doing my research in the market, for me, when I'm looking for great trading opportunities, when I'm interpreting what's going on in the market, I'm far more interested in what the smart money is doing versus trying to outsmart the smart money, right? You can't compete with the smart money. They have an unfair advantage, while the market may be unfair, while I have no doubt that the market is rigged, we can use that to our advantage. We can piggyback off of that activity. These loopholes, by the way, this unfair advantage is known in the industry. Bloomberg reported on this last year about how the insider trading loopholes exist. Because basically, there's a loophole that exists in the US specifically, where insiders can, as long as they submit a plan to their broker or to wherever, as long as they submit a plan of when they're going to buy and sell, they can engage in pseudo insider trading. I'll read it from the article here. Current rules allow executives to time their shares to maximize gains. SEC Commissioner Caroline Crenshaw sees a cooling off period as one solution. They've been trying to figure out how to solve this for a long time, but they haven't yet. Again, from Reuters, SEC targets corporate insider trading loopholes. As you see here, executives have been able to game the system, including engaging in de facto insider trading by creating, changing, and canceling stock trading plans in secret and virtually at will. Dennis Keller, head of Washington-based nonprofit Better Market, says. He argued the SEC initiative was long overdue, and again makes the point that there will be a long runway before any such changes take place, however. So when we see massive insider selling or buying, this is something that I take a really close note of, because they are the best experts, right? You can watch all the talking heads you want. You can read all the news articles you want. You can go into all the chat rooms and blogs you want. But even Warren Buffett himself doesn't know more about the what's going on in a company than the CEO and the CFO, because they're the only ones that aren't guessing. They're the only ones that know. And so why not, when you're doing your research, go directly to the source, directly to the answer that we're looking for? At least that's my approach. Who'd agree? Right? Here's the evidence. Let's look at 2021 as we built into that bubble, as high yield bonds gave us a clear as day sell signal. The insiders were selling too. In 2021, we had close to $40 billion of selling at the top. That's 3 times more than we had in before the COVID crash. Again, look at how non-existent the buying was. These are incredibly valuable sell signals. And what's better, what's even more impressive about this is it's simple to understand. Anyone can understand this. We don't need to know the ins and outs of what they're scared of to take action. The analogy I use in class is, imagine if you're standing in a field and you see thousands of animals running in one direction. The birds are blackened the sky as they fly in one direction. Every animal's coming out of the trees running in one direction. Do you sit around and wait to see what they're running away from? Or do you run? Or do you hightail it out of there as well? Right? And the same thing with 2008. We didn't know that there was the housing crisis would be the reason that we would tip into a global financial crisis, but we saw smart money flooding out the back door for 6 months before the global financial crisis hit, and we took action, and we found out why later, and that is fine for me. I don't need to be the smartest cookie in the jar. In fact, I know that I'm not, but I can. But our system allows us to follow that smart money. To stay ahead of things, to have an edge. So, we'll just fast forward a little bit here. And as I said, when you're combining things like the bond market, and then you're looking at the experts in the industries, and certainly the stocks that we're looking then to make trading or investment decisions about, we've now got a really powerful 1-2 punch. Then combine that with focusing on high probability patterns for timing, you've now got a winning strategy. And again, the insiders, they know about all these kinds of insights that we're looking for when we're about to take a trade. The FDA announcements. If I'm going to take a speculative trade, I'm going to go look for a biotech stock, right? But what do I know about biotechs? Nothing. I'm not a biotech specialist. I haven't spent 60 years working in pharmaceutical research. But if I'm going to look for a pharmaceutical trade, which pharmaceuticals have tremendous upside, because if they go well, you can see a stock go from $2 to $200. So if I'm looking for explosive types of more speculative investments and so forth, biotech is one area that I'll look at. Mining, oil, resources, all these areas can be very exceptional opportunities. But what I look for is I'll look for a stock that has a great pattern, which is something I do know a lot about, right? I'll look for a great pattern, and I'll combine that with, for example, the chief medical officer buying $5 million worth of stock 6 weeks before an FDA announcement comes up, or something like that. Because who would know better about the likely success of the drug than the chief medical officer? So this is giving an example. And again, the edge that this type of research does give us is not a secret. It's common sense. And the studies that have been done on it, for example, the Wharton School of Business study says that investors can reap, by imitating insiders, exceptional profits. University of Michigan, insider purchases have abnormal returns. Harvard and Columbia did a study on it, said that insiders make market-beating returns when trading before big events are announced. Wall Street Journal said insiders have a persistent edge. Peter Lynch said there's no better tip-off to the probable success of the stock. This is credible research. So, I mean, again, silly question, but who here is looking for exceptional profits that consistently beat the market? Like, me. That's exactly what I'm looking for. So, I mean, we can overcomplicate things if you want, but at the root, some of the most powerful research that gives us the insight is staring at us right in the face if we know where to look for it. And especially in a market that's melting down, because how many of you have bought stocks where it's gone for a 10% or a 20% rally, and you get out of it, and you're like, oh, I don't want to lose the profit, I'm going to get out, only to see it go up much more. Right? How many of you done that? How many of you have you done that recently, where you look back on trades, you're like, oh, I left a lot of money on the table, right? Because when you don't have a deep level of confidence in your trade or investment, if you're constantly worrying about the fundamentals and what could be around the next corner, the fear factor is high. Whereas if you know that if you didn't have that level of fear about the company, if you had a level of confidence in the fundamentals that something exceptional could be coming around the next corner, it's going to give you a higher degree of conviction when you get into the trade, to hold on longer, maybe to invest a little bit more, to not sell on pullbacks, because you know that, hey, eight insiders just bought $20 million worth of stock at the same time you did, right? I mean, that's the confidence it gives me, right? And to me, that's a better way. It's a new way of doing things. It's a better way of doing things, and and it allows us to follow the insiders in their wake. So let's look at some examples. I mentioned pharmaceuticals. This is a great example of that from a trade perspective and an investment perspective. So you can see either or here on Cassava Sciences. So this is one that we found, again, it was 2 years ago. And it started off as a trade idea, and but also then continued on to as being a longer term investment idea. This is one where we found it in our Smart Money scan, which scans for a number of things. Insider. So when we're looking for an idea, we're looking for insider buying, but not just insider buying. It has to be the right kind, right? Multiple insiders at the right price. Excuse me. Multiple insiders at the right price, at the right time, with a significant amount of money and a significant percentage. Right, so there's lots of places that will talk about insider buying, but a lot of that's noise. You've got to focus on the right recipe. Big insider buying, big dollars, big percentages, multiple insiders at the right time with the right pattern, right? Because that gives you the timing. So all of that happened in this example. The director, CFO, president, another director bought 177%. Show you in a second, for 932 grand, right? And all of that happened at the same time. Announcement came out about one of their drugs. Stock skyrocketed from $2 to over 10. This is the end of day data, but it had an intraday high of above 10. I mean, that was a 500% move. But so yeah, for a trade, excellent breakout trade, could bank some really good money in a very short period. But for those of you that like looking for some investments too, especially as we're in a meltdown right now where some stocks are selling for pennies on the dollar, this is the time to also be looking for some longer term things, in my opinion. And this is the kind of thing we look for. So again, that insider that bought $932,000 worth at $2.20 didn't sell. They all held on. And to do that crazy math, just to give you an example, hypothetical example, every $1,000 at 2 would be worth $59,000 at 120. And that insider put $932,000 around 2. Let's do that math, right? So this is why insiders, to me, is very exciting. And when I come across these setups in my scan, when everything lines up, it's exciting. It's this is why. So do you see why? Who would agree? Again, put a 1 in the chat box if you you can see the value of tracking smart money, right? From major market reversals all the way down to looking for individual setups. And I'm going to show you some more here, especially some shorts, how this applies to the shorting in the current environment. But the other part to this, that the third piece, is then to automate it. So again, when I first started trading, I was spending 12 to 14 hours a day in front of the screen, research, trading, watching the market, scanning. It was not what I signed up for. And also, the other problem with that is that I found that by micromanaging my trades, by sitting in front of the screen and watching them while the market was open all the time, was negative. Was actually cost me profit, because I would be in a great swing trade and then get out of it because it started to break down on the 15-minute chart. And I would micromanage my trades and get out too soon, or perhaps there was a stock I really liked and great news would come up and it would shoot up 10% in the morning, and I'd get really excited, chase it, pay too much for it, and take too much risk. So swing trading and set and forget trading, I love, because it allows us to take the emotions out of the equation. And when we see a trade that we really like, and there is a really clear pattern as to telling us when to get in and where to get out based on rules, why not set it and forget it? So that you can remove the emotion and the gambling part of the trade and let the strategy do its job. And B, the upside is you then arguably not only make more money by having a more robust rule-driven way of trading, but also you've now got your time back. And that is what I signed up for. The most important thing to me isn't how many zeros behind my bank balance I can create, right? It's not about making, not purely about making as much money as possible. For me, it's actually even more importantly about the freedom it provides. So it has to be both. And that's what everything that we do is all built around. So let's talk about some shorts and some recent setups. I'm just going to fast forward a little bit. So how do you capture the crash? Well, let's take this insider mentality and let's look at shorts. So one of the shorts that we alerted to our students was NOW, Service Now. NOW is a symbol. And so if you take a look, let's just go through the whole process, right? Let's go through the whole process so you can see what it's like to trade this way. First, what's the pattern? Okay, because 80 to 95% of the volume is coming from patterns like this. So let's strip away all the noise and focus on one of the most important aspects, which is the price action. What's the pattern telling us? It's a head and shoulders. Now, out of 140 odd patterns I've studied, head and shoulders is one of the number ones, if not the best, pattern to predict the top of a chart. So if a market is topping or a stock is topping and you see a head and shoulders, that is one of the most reliable, highest probability and most profitable patterns to confirm that, to take as a trade, right? And so here's our left shoulder, there's our head, there's our right shoulder. This is telling us, it's screaming at us what to do. There's no gray area here. The right trade, if you want to follow the rules of probability, if you want probability on your side, the correct trade here is to short this either there or there. right? And the probability is on our side that it'll work. It doesn't always work, but hey, if this is say for example 70% probable, that's enough. Even if it was 60% probable, that's enough, right? And then and take a small amount of risk for a big reward if it works. So here it's telling us what to do. It's telling us where to get in. It's telling us where to get out, right? And because we know where to get in, where to get out, and where the stop loss is based on the rules, right? We can program that in. Is that enough? Well, 15 years ago it would have been enough, but now again, we wouldn't touch it unless it also had the insiders. Because why not demand excellence? Why not have both? So when we looked at NOW, of course, naturally it does have both because our scan looks for this. We saw that not only was it a great pattern, but it also had 8 insiders selling over $47 million, with the CFO selling 75% of their position in that transaction. That's a big exit. 8 insiders with insiders selling as much as 75% of their position. So to me, very, very, very exciting as a shorting opportunity. Now, does that guarantee the stock's going to drop? No, but would I be buying it? Hell no. Why would I buy a stock that has insiders selling? If the experts think it's a good time to get out, why would I disagree with them, right? Anyway, so there you go. And NOW had a target down of around $500. And so there it was, set and forget. There was the alert from January 5th this year. As this is how it appears on our website. We also send you a video breaking every alert down, which is really cool. But there's the written version of it. NOW, active, Jan 5th, short, head and shoulders, entry signal. If this goes to 569.75, that would be our entry. Target, if it goes to 515.67, that's where we would take our first partial profit. Target 2, momentum. Stop loss 592.23, risk reward 2.4, insider activity, and then we again we have daily updates on all of our ideas until they're done. And as you can see, that was straight down to its target, done. Right, easy as that. And so and this idea of set and forget now takes the guessing game and the emotions out of it. This is one of my students in Sydney, Australia. I live in Canada at the moment, but I spend about half the year in Australia. We go back and forth between Canada and Australia, and when I'm in Australia, set and forget is incredibly valuable. This is one of my students in Sydney who again works a full-time job and was trying to day trade. He would come home and start day trading when the market opened at 12:30 at night, and sometimes get stuck in front of the computer till 4 in the morning, then have to go to his full-time career at 8 in the morning. And he blew up about 3 accounts, I think he said, $30, $40, $50,000 worth trying to do this over a 10-year time frame. Set and forget allows him, being in Australia, to not have to be up to be trading. He might have 20 positions open and he can sleep at night because he's got entries, exits, and protective stop losses in place. This is when your strategy is working for you. JYNT is another example. Now you'll notice these all look the same. They should, right? Because it's about doing the same thing again and again and again, focusing on the perfect pattern, the perfect recipe, perfect storm. So there's your head and shoulders, same pattern. So do we have a really high probability pattern? Yes. Check. So this tells us when to get in, it tells us where to get out. What about the insiders? Well, we had 2 directors and the CFO selling $3 million, 25, 34, and 88% worth, right? So do we now have we now done our fundamental research? Yes. Right? We don't need to know anything about JYNT, in my opinion, because the experts that are always going to know more than I could possibly hope to, even if I spent a whole week researching it, they still know more than I do, don't they? So when you've got the pattern and the fundamental research combined here, and you can do that in minutes, we've now got a set and forget setup. And again, you can see that drop from $100 all the way down to 55, which is the first target. And then actually went all the way down, forming a bear flag all the way to 30. GRWG, another example, right? Head and shoulders pattern at $44. Beautiful head and shoulders, picture perfect head and shoulders, and the insiders sold. Do I have that chart? No, I don't have that one. Insiders sold tons. You had the COO sold 100% of their position there. I think it was for close to 5 million, and then you had another mass exodus of the CEO, EV, executive vice president, and so forth, as the head and shoulders built. Big selling, perfect pattern, and again we alerted that one as well at $30.86. That dropped today. It's down at $5.30 from 45. And if you're an options trader, think about how good that would be on a put play. So again, this is the trade setups that we alert. NVEE, another one, beautiful double top. We alerted that one at I think at 137. Still an active alert, in fact. So the insiders, president, COO, executive vice president, general counsel sold 5 mil. CEO, chairman of the board, executive vice president, director, and general counsel sold $5 million more. Perfect double top pattern. And there you go. April 10th, entry signal 130, 181, target 1, 122, target 2, 114.57. Our next target is $100.63, and then the next target below that is 71.57. And so now it's just easy. It's just set and forget. Just keep lowering the stop loss as it keeps breaking down lower until eventually it stops out. So I mean, this is how smart money works. And while I've given you a lot of examples on shorts, what I'm really excited about, what you should be thinking right now is, where the really big money is, in my opinion, is looking for valuable opportunities when this market does put a bottom. Whether that bottom is in this week or whether it's 3 months from now, we have already had a substantial breakdown where some stocks are down 70%, 80%, 90% from their highs. There are great opportunities out there, and there will be more. And so where my thinking is yeah, we can make some money on the way down, sure. But what I'm really preparing for is looking for the great longs on the way back up. Just like $0 oil, when oil tanked and people missed that. How many people missed $0 oil, right? Buy low, sell high. It doesn't get cheaper than free, right? But most people missed one of the best investment opportunities of our lifetime because they didn't know how to act on it. We did, right? We went to our scan and we scanned for stocks in the oil sector where insiders had bought after the crash, and we had a high probability pattern with broad spread mass buying. Click a button, bang, TTI comes up, one of the first stocks. There's 7 here, but actually 8 insiders bought, as much as 982%. And so that was part 1. Part 2, we had a really good pattern, which is called it's like a cup and handle, right? So big buying, and then when it broke out here at 92 cents, we alerted it as a long, and it rallied 470%. Right, but massive insider buying at the right time by the right people in the right quantities with the perfect pattern. And you have to have both. Insider activity on its own is not a reason to buy or sell. Insider activity with the right pattern and timing is what we're looking for. And so CPE was another one. Huge insider buying, 1100% move. CDEV was the one I bought. I didn't buy the first 2. I bought this one because it was a bit more speculative and I like risk. That was at 30 cents. VP director, CFO bought 20 million from the owners. 2100% move. Anyway, that's the recipe we look for: the pattern, the insider, and then automate it so that we can try and remove not with AI, not with robo trading, but program in where our risk is, where our target is, where our entry is, based on the data. And if it all matches up with a good risk reward ratio, execute. I know I've covered a lot of information today, so I can assume that it's a little bit. I hope there's a lot of exciting stuff there for you. I love it, and hopefully you can see that if you follow this, It can make things, it can certainly, as an addition to what you're doing, or even as a standalone strategy, can be very exciting. What we put together for you today as your smart money trading ultimate bundle is to take the next step and learn how all of this works. And we put together it's a complete package, all the way from the alerts, the education, to the indicators. It's pretty cool. So part one is the why behind the what. I know people love to follow alerts, and I think we have some of the best alerts in the industry because our clients tell us so all the time. But I also think it's really important to understand why, right? And so having confidence in what you're doing is so valuable. Even if you're just going to follow others' ideas, having a level of confidence is key. So we've put together this 4-module course. It's about 2 hours each module, so 8 hours in total. You can start going through it right away, and that's going to teach you everything from the foundations of price action, how far back to go to draw support and resistance, how to identify the correct pattern, because a lot of people struggle with that and just draw on lines of best fit. You know, you shouldn't be drawing lines of best fit. You should be drawing the correct pattern, and there is a way to do it. Going left to right, understanding where to start, where your anchor points are. There's a science to it. There's a methodology behind how you do it. We teach you that in here, and that all builds up towards how to scan for these insider setups. We use a free online tool, so no matter what program you use, and hopefully you're using MetaStock, but no matter what program you use, you can log into this scanning tool. We set up all the criteria for you, what kind of price to earnings ratios we're looking for, debt levels, how much insider selling. Like there's a recipe we give you, and then once you've got it, it's yours for life. So you'll have our insider scans, no additional fees. It's yours forever. And we set all that up for you and show you how to use it. The course is normally $19.97. It's worth every penny. That's included as complimentary as part of today's offer. You've also got the alerts. I love researching, just like Jeffrey. He loves his scanning. I love scanning. It's like Willy Wonka looking for the golden ticket, you know, especially with insiders. So we send out a video every week with our 5 favorite ideas, broken down with entries, exits, targets, everything. And the insiders, the options we're looking for, absolutely everything. Ralph says, TTI made a profit and still own a few hundred shares. Awesome. Yeah, trading room also included every Tuesday, Thursday, live, 4 p.m. to 5 p.m. Pacific, 7 to 8 Eastern. It's recorded, uploaded onto the portal, and that's where we'll break down everything like the bond market and things and what's going on and tell you what we're doing next. You've also got one-on-one coaching included, so your own personal mentor for 3 months. So 3 months of alerts, 3 months of trading room, 3 months of coaching, lifetime access to the Smart Money course, and lifetime access to the Smart Money scans. And last but not least, our Smart Money indicators. There's 3 market indicators we use. High yield bonds is one. We also track the percentage of stocks in bullish or bearish patterns, a special way we do that. And we have an S&P indicator, which is critical. Gives us 2 signals a month. And all of that is housed in our customer portal. That is normally $997 a year for a subscription to have access to those. We're going to give you lifetime access to those 3 Smart Money indicators and lifetime access to our market meltdown or bottom alerts. So those 3 indicators we give daily written updates on every few days. That's you're going to get lifetime access to that, so you never miss a major market reversal again. And all of that we're offering for $397 as part of this special event today. So the link to sign up there is acornwealthcorp.com/meta. acornwealthcorp.com/meta. So I think Jeffrey was putting that in the link there. Do we have 2 more minutes, Jeffrey, or I just want to make sure I'm not taking any time away?
Yeah, you have 2 more minutes for sure.
Okay.
Somebody had a really interesting question. Nyla's wanted to know how the bond markets look currently, and I promised to ask, and my apologies if I missed the answer already.
Yeah, well, I mean, so one of the things that I've been saying to all of our subscribers and all of our students, and by the way, this is the kind of alerts you would get lifetime access to, is these big market interpretations of these big market moving indicators. If you take a look at high yield bonds, it is still not finding a bottom. It is still under its 5-day exponential moving average. Now, there's some bottom. We're very oversold, and we may get short squeeze rallies because often the rallies you get in bear markets are more impressive than the rallies you get in bull markets because of the combination of the bottom buys and the short squeezes. But I won't trust any bullish move for more than a short-term trade. Right, and we will do those, but I won't trust that a bull market is as set back in until HYG is bullish, and that needs to set a momentum bullish pattern. So the 5 and the 9-day exponential need to be crossover. The stock needs to not be oscillating, right, not going like this, but actually showing momentum characteristics above the moving averages. Money flow needs to be positive. Then I'll trust a bull market that has come into place. But until HYG is bullish, and it still isn't, I wouldn't trust the bull market. So right now we're protecting our shorts. We're taking some longs. Like there's been some great, things like AVIR is an example of a long that we had talked about with our students last week. That's had a nice move up from 560 to 762. But these are special long setups where, again, perfect patterns, insider buying. But for the most of our alerts, though, at the moment are all shorts. Hopefully that answers your question.
Great answer. That was really good. Okay, John, thank you. Appreciate it. Thanks for coming in today.
It's my absolute pleasure. So hopefully we'll get a chance to work with everyone. Go to acornwealthcorp.com/meta. Got some new alerts coming out tomorrow night. Cheers.
All right. Thanks, Janelle. Cheers. Good to have you. You go ahead.
Pleasure to be here.
All right. Hope you guys are enjoying everything. Let me go ahead and actually just do a few things here. Get resituated. Okay. And then show my screen. And yes. Okay. I want to say, okay, let's do this for a second. Nihilish, you're welcome. I would try and answer all of the questions. Good job, Kelly. All right. Very good. I hope you're enjoying today. I think it's going great. I hope you enjoy. I agree as well. Again, if you have questions as we go through, please paste them in either GoToWebinar or YouTube or Facebook or Twitch, whatever you happen to be watching. I do want to say thank you again to our sponsor, CMT Association. CMT has been sponsoring the events for, I'd say, 6-7 months now, and they've been a great partner. We have Tyler Wood coming in to talk a little bit later. CMTassociation.org is where you can check those out. Very, very well-reputed organization. A lot of money managers, a lot of bankers, a lot of institutions will go, and they'll go through and they'll get whether it's called CMT accreditation. It's a really, really prestigious thing. If you're interested in kind of pursuing that, we're going to have Tyler in here a little bit later. I think he's the last speaker of the day to kind of talk about kind of the benefits of actually a CMT accreditation. But CMTassociation.org is the place to find out about them. And our next presenter is actually a CMT. Actually, before we do that, and of course, we're MetaStock. We are offering an extended trial today. You can buy a month of MetaStock, and we will give you the second and third month for free. MetaStock has been rated the best software in its price category for 30 years. I'm sorry. Only 29 years in a row, but it allows you to do scanning, testing. We have a patented forecaster. It's a great tool. I will use it every single day to look at my trades, decide what I'm doing, and most specifically for me, because I've been doing this for a while, just run a really quick market scan and see what actually appears on my list and what I want to do with those. So you can take advantage of that. Again, if you pay, our end-of-day software starts at $59 per month. Our real-time starts at $197 per month. What we're going to do is if you pay for a month, you're going to get the second and the third month for free, which means literally for about $20 a month, you can try MetaStock for 3 months and find out why it's been rated so highly for so long. So to do that, metastock.com/conf promo. You can give us a call. We've got friendly sales guys that'll answer any question you've got. 882-3040. And you can also chat online at metastock.com/saleschat. To continue my previous thought, our next presenter is CMT certified. And it is quite a number of courses you have to go through and some exams and testing and things like that. We've been working with Martha Stokes for a long time now, and we had her back in the November conference, and she does such a great job. We've been inviting her, every other month or so, every other event or so, because I really enjoy the way she looks at charts and kind of I'm going to call it a rational way of looking at things, but she does a really, really good job. So if you have charts that you're particularly interested in, she might have a chance to look at them, type in some symbols. But with that being said, let's go ahead and see. Let's go ahead and bring you on here, Martha. How you doing? All right.
Can
let's
you hear
try
me
that.
now? Hi, good to be here again.
Okay, I'm going to go ahead and make you the organizer so you can see the questions, and then I'm going to make you the presenter, which will make it so that you get a pop-up that says, "Do you want to share your screen?"
Okay. All right.
And then I will stay with. Go ahead.
All right. Can you see my screen now?
It's coming through. I can see how to identify buy zones.
Yes, very important.
Yes.
Okay. So we're going to go over, I have a list of charts that people requested that I look at today, and I'll analyze it. One of the things I do for my students is I make sure that I show them how I analyze, study, and read stock charts, because when it comes down to it, you really have to learn to read stock charts to be like a professional. And I have many professionals who have taken my courses, and many students who've become professionals after taking my courses, and they make very high incomes. So I just want to remind all of you that we are not a recommendation service. We're not going to give you a stock to trade or that type of thing. My goal is, and my legacy, as I do this in retirement, is to teach the retail side what I teach professionals so that you can have the success that professionals have. So we're going to go into that later. So I'm going to come out of this and go into my charts. The first thing I want to talk about today is the scans that we have constructed specifically for MetaStock. And I just got through talking to my senior analyst, and she said the MCA scans in MetaStock are just awesome. And they are. They've done such a superb job of developing explorations and scans that work extremely well. Now, what we're doing with market condition is something that no one else does. What we're doing is we're saying, which of the 6 primary market conditions are we in at this time? Because that tells you what you can expect on short-term daily trends, intermediate-term trends, and long-term trends. And the more you understand about the market as a professional views it, rather than a retail trader or retail guru trying to tell you, okay, this is what's going on, because they often don't have the information. So the first thing I do is I say, I built this for my trading floor many years ago. And I said, I want to see how many stocks are moving to the upside with strong momentum. And I want to look at the stocks that are going to the downside with momentum, because this gives you the bias for the next trading day, which is crucial, because you may think, oh, the market's going to go down. All right, I'll sell short. But if the bias has shifted, which it often does, in a downtrend, you'll see that you'll go down and then up and then down and then up. So how do you evaluate that so that you can trade successfully? Because I can assure you that if you were trading the Qs and it popped up and down and up and down and up and down like that, your sell short would not last, and you would be so nervous holding it. And the goal is to make sure that you're always trading with the professionals. The dark pools, which are the buy-side institutions of the market, one of the largest groups, and they constitute 80% of all the market activity. They eclipse everything else in terms of what they do. So if you follow them, you will be very successful, because sometimes you may think that something is a great idea, but you want to go with the largest group possible and trade with them, because then you will have more success. So we want to know which side of the market has the bias, and that shows us. We also look at the condition of institutional investors. Are they buying? Are they on hold? They don't use VWAP orders. They use TWAP orders, time weighted at price activities, because they want to not disturb price. The reason there are dark pool venues is because the SEC approved in 2002 that they could be off the exchange. So all the transactions that the dark pools are doing are off the exchange during the day, so you can't see them. But you can see them in the chart price action, and you can see them with this wonderful indicator that we developed for MetaStock, and it works beautifully in telling us where the accumulation is and where it is not. And that's very important. Then we ask for all the bottoming stocks, how many stocks are in bottom formations, and that gives us an idea of whether this downtrend is coming to an end, which is very important, because a lot of people who sell short lose a huge amount of money because they're not prepared for the bottoms or the buy zones that the dark pools create. So the buy zones know where the fundamentals are on a stock chart, and they know where that fundamental lies. So they wait for everyone to sell and panic, and they have their buy zone right there. And as soon as that hits that fundamental value, they trigger and buy in, and they buy on the penny spread. And it takes sometimes several minutes for them to fill their orders, but they'll trigger on that certain price point. And you want to be able to track that. This special indicator that tracks large lots versus small lots that we developed in special programming just for MetaStock. It's uniquely here. And so that makes it very special because it's not everywhere out there. And it gives us that buy zone area that they will start buying on, so that if you're selling short, you can sell before it hits that buy zone, because when they hit that buy zone, the pro traders will recognize it and they'll start buying. And then the HFTs, the high frequency traders, will trigger on the momentum that the pro traders set up charts use. And I'll show some of those today because some of you have those. Then we want to look at the consolidation scan, because consolidations are where we find the pro traders. Pro traders do not move price very much. It's not like many people think. Everybody thinks, oh, high volume, so that must be pro traders, or high volume, this must be dark pools. No, everything is done in a way that it doesn't disturb price. So you have to find their footprints and their buy zones, and then you can trade with them. If you're trading with the largest group in the direction that that huge group is buying or selling, you will have success. You don't have to worry about what other aspects of the market are going on, because they will slowly move or rapidly move price up, depending on whether it's the dark pool buy zone or the pro trader setup that moves with momentum, sets the momentum up, the HFTs, which gap the stocks up. We look at the overbought, which tells us when we're in a trading range, whether there's going to be a conversion to a heavy sell down. And then we look at RSI strength. We also have a special indicators for RSI strength, because I use RSI over RSI that was designed specifically for MetaStock, which is a fantastic charting program. And it works beautifully for that, to determine the relation of price at this point against price at this point. Or is it, sometimes the chart may look like it's going somewhere, but RSI will tell you, no, the price is not really changing over time. It's not improving. It's not developing that momentum that builds when the dark pools are buying. So those are the indicators. This tells me whether we have a topping market, a bottoming market, or if we have a velocity market up or down, a moderately trending market up or down, a platform position market. And those different market conditions are dominated by different market participant groups. So knowing what the market condition is and understanding, because I post every day for my students, market open report and market condition report. I post it. I start writing it in the evening before I get up at 2:45 Pacific Daylight Time. I completed about 3:45. My professionals on the East Coast are waiting for it. They get it and they trade based on that information. So I'm working with a lot of professionals, and I enjoy thoroughly working with retail traders who are very serious about trading like a professional and taking conservative risk, but making very high profits because they take conservative risk. So mine is more in tune with how do you get a lot of money out of the market with very low risk. My professionals have a 90% success rate. My students have a 70 to 80, and eventually those who go on to professionalism get to the 90%. So we're not taking massive losses and then trying to recover that. So we're going to look at the NASDAQ today because the NASDAQ has been going down, and we want to see it broke through some support here, and it has created a certain level of weakness that is going on. And this is something that I identified a few weeks ago for my student that it would break through. Now we're entering this strong support level. Why is this a strong support level? These are the highs of 2021. And going up a little further, these were the highs. So there was a period here where it moved sideways for a period of time, and this creates a fairly strong support level because the fundamental values of many of the stocks, of the 100 stocks on this NASDAQ, are sitting in this buy zone. We had speculative runs of some stocks, but not of others. If you check all 7,000 stocks that are listed on the U.S. exchanges, the almost 3,000 ETFs and REITs, and the ADSs, internationals, we have a very large base of stocks and stock derivatives to trade. So we want to understand what is going on. This support level that comes in here is going to create some dark pool buying going on. There's going to be some buying that happens in this range. So they're going to be seeing that as a potential opportunity. And those who would be trading the Qs, if they continue to try to sell short, they would have big, huge bounce up days at risk of that. So you want to be careful of that. So I'm going to go in now and start looking at your chart. Oh, this is the S&P 500. The S&P 500 was in a trading range for a while, went down and then broke through that second lower tier, and it's now a bit lower. Again, there's a certain point where it's going to find support, and you will want to be careful selling short to SPY or whatever you're using because it can create a problem. So you want to be careful of that. So the next chart I'm going to be talking about is one that you picked. It doesn't do you any good. I could show you charts that I traded all day long. I could show you all these great patterns and setups and say, oh, look, you can make millions of dollars. But that doesn't help you. What helps you is to see how a professional looks at it. And I am also a psychotheorist. So I look for support. Since we're in a downtrend on this stock, it's topped and it's on a short-term trend stock. It's dropped. HFTs have gapped it down. That's an HFT volume spike. It is not dark pools. Write it on a sticky note pad and put it on your chart, on your monitor, because everybody thinks that is dark pools. No, dark pools hardly move volume at all because they buy incrementally, slowly over time to hide what they're doing. But look what happened. This stock sold down, and then who was buying? The dark pools bought because they have a little buy zone right in here. Right in here. And you need to understand that because, see, they were in this. And then pro traders did a setup and moved the stock up. If you swing trading, you need to follow the pro traders because the pro traders will give you setups and they will run up. But what you don't want to do is have the stock go up and go down and go up and go down because it caught, and then all of a sudden up and then way down. You want to swing trade or platform position trade when it is a platform position trading market, which it is not right now, mostly swing trading. You want to exit when the pros are exiting and enter when they're entering and not buy into a situation where you're going to have a huge gap down because you'll lose a lot of money. So you want to be careful and keep track of what's going on. If this turns down in red, this is not a confirmation of a buy signal. So you would not be buying here. You have to use this as a buy entry signal because it's showing you the buy zone. This is the buy zone. Pro traders look for that buy zone. They know what it looks like, and it's in patterns, and then it moves up. Now the stock is back into the buy zone, and the dark pools will accumulate, but it'll also go sideways for a period of time because of this huge HFT, high frequency trading gap down. This is not dark pools. This is not short squeezes. This is not any of that stuff. This is just simply dark pools, the HFTs gapping it down on bad news of some sort, and then dark pools moving in. We have a lot of stocks right now that are not in market crash condition. They're not running down. The stock is finding support at this level. So you need to be very, very careful how you look at charts and really understand. The first thing my students do is they say, okay, I'm looking at this chart right here. Who's in control of price? Dark pools. Who is in control of price? Because if you know who's in control of price, then you will do very, very well. Since the dark pools constitute 80% of all the market activity, it stands to reason that they are the wisest of all and know what to do. There are many different groups and there's many different types, but you also have to understand that there's restrictions on certain things that people can do. You can't announce a bad news that's false about a company. You can't sell out all your shares if you're the CEO of the company. That is against SEC rules. So you have to be careful what you do, at least in the United States. Okay, so we have another one, and this is Bungie Inc. Limited, and what we have developing is a topping action. And we can see that there is some dark pool selling going on. So what's going to happen is this stock is going to be able to move down, but how far you move, the percentages that you can get, or the number of points, I like to have my students work not in percentages, but in points. Why is that? Because percentages create emotion. When you're working with a professional, they have no emotion. They don't care whether it's a bear market. They don't care whether it's a bull market. They do not care. What they care about is how many points can I make on this stock before it hits a support level and bounces back up. Because I do not want to be in a stock that I'm selling short that bounces back up, because sometimes they bounce up so hugely that the loss is enormous, or it takes out your tight stop losses. Never use percentage stop losses, always use point-placed stop losses. Why? Because every professional in the world knows that you retailers love percentages. Oh, percentages. Oh, I made 133%. Well, how many points did you make? Oh, I made 3. You have, if you had 100 shares, you have $300 that you can take to the bank. You don't have 130% that you take to the bank. You have $300 minus any expenses or losses or anything that you had in that. If you don't learn to control your emotions, you're going to be what the IRS classifies as a hobby trader. And that means that every year you take a loss on your income taxes. We are very proud to pay taxes because we're making really good money in the stock market. If you're not making money in the stock market, then you're not successful. And I would like to see all of you learn more about charts because they're so important. And this is a fabulous charting program. It's really helped a lot of my students get ahead. And my professionals use it as well. This is a ETF, and it's a baby, so it's spread out a little bit. And you can see that right now it's in a sturdy downtrend. And it's down to, it started at about $29. That was its issue offer. And it was developed by, looks like BlackRock. But right now it's heading down. And the reason it is because I believe it's based on blockchain or Bitcoin. And so it has been moving down because the ETFs always follow the underlying index upon which it's based, or the underlying asset. Now we're going to be seeing a lot more ETFs. It's very exciting. We're going to see a lot more ETCs. We're going to see a lot more ETDs, and all these going on. Basically, the stock market is becoming the one-stop shopping mall for anything you want to trade, whether it's Bitcoin or Forex or whatever. They have an ETF or an ETC. They will have more and more derivatives, and we're moving to the digital economy, which is very exciting. So there's going to be digitized assets that are available in the stock market, such as inventory from Amazon, and you can trade that. And so this is going to be this huge evolution that's coming, and it's so exciting. But the only way to really, really benefit is not to think that you can just do it in an easy way, but understand that the more you learn to read a stock chart and what it's telling you, the better you will be. And you always want to be with the largest group that trades the largest share of lots. Why? Because all that buying at some point those 100,000 shares, 500,000 shares. Today, there was a whole lot of dark pool buying of 1 million to 4 million block orders for just about the most important the important tech stocks right now. So before market opened, and when I was writing my morning market reports, I saw all these block orders coming through on the professional side, NVIDIA, Microsoft, and everything, because they've hit a certain point where the dark pool's buy zone is. And so they're buying those shares. Maybe somebody is selling it, maybe insiders are selling, but the buy side institutions were buying. So that gives you information that tells you maybe I should be careful about selling short a stock. It doesn't mean that it won't go down, but if the buy zone is there and they're starting to buy, then that is not a stock to sell short, especially when they're buying 1 million shares or trade and buying from either another institution or directly from the company itself. A lot of companies have had buybacks, a lot of buybacks. So there's tons of shares of stock that the buy side institutions, the dark pools, can just go over and negotiate and get a price within the last best bid offer between the bid and the ask. And oftentimes that's just a penny spread. So they can do that, and they can buy 1 million shares or 4 million shares or 10 million shares or 20 million shares. And that doesn't disturb price. The only way you can tell is by looking at these indicators that we developed. We have 5 special indicators that we developed for MetaStock exclusively. My indicators are only on MetaStock. And you can see that there's a pretty heavy selling going on in this ETF right now. There is no dark pool accumulation. So we can look at CDN natural resources, and we can see again, this stock has been trending up. It's been trending up most of the year and has been trending up recently when everybody thinks the market has been crashing. There are things that continue to move up even in a bear market. If they eventually call a bear market, which the professional side has not, maybe the retail side has, but the professionals have not yet called that, then there are still stocks that are going to run and grow and move up that you can also buy. A lot of people don't want to sell short. A lot of people don't want to try to learn that. It is a challenge. It takes about 3 times as long as learning to buy long on a swing trade, position trade, platform position trade, intermediate term trade, all the trading styles that I teach. And so it helps you to understand that you do have opportunities to buy even in a bear market. Not all of the 7,000 stocks or the several hundred ADSs or all the ETFs are heading down. This actually is a very mixed market with a lot of different trends and different analysis going on. There are some big name companies on all 3 indexes that had unusual growth and a huge they had 3 years of revenue all in 1 year in 2020 and somewhat that in 2021. So their year over year is going to look bad because they can't beat that because they had the stimulus checks and everything else that made it possible. So this one is shifted sideways, and we want to see whether it holds that sideways. Now, one thing about trading ranges or sideways patterns is there's inconsistent lows and inconsistent highs. So when we have a situation where it's the inconsistency, I will bring it back down so that just the range shows. So this is the range. So it went down, but it popped right back up. It went up, but it popped right back down. So this is a trading range that is continuing. And this is one way that stocks can pattern out excessive speculation, which is this excessive speculation, by shifting sideways. And we can see that it has shifted sideways several times. So it is patterning out, and it's not a top yet. Let's get that right there. But it may develop a top in the future. Okay, so you can see that it moved up and moved sideways, then ran up, then moved up, went down, popped right back, moved up a little bit higher in its range, popped up, moved back down. It's in a trading range. Trading range is at least 10 points, and that's what we have right here, is a trading range condition. So what you would do is watch it for a break to the upside or downside, and you can evaluate which direction it's going to go based on your indicators. There's 5 indicators that I show, and I'm just showing the 2 today, volume and the TT quiet accumulation indicator, which shows are they quietly accumulating or are they quietly rotating. Right now, dark pools are quietly rotating out of the stock. So their expectations for the next quarter is that it will be lower earnings or revenues. You can always tell what the next quarter is going to be by the buy-side institutions' actions and what they're doing with that stock. If after its earnings, they start slowly rotating out, that means that they don't expect it to have a better earnings season for the second quarter of 2022. But keep it on a chart. It's a good one. We have a very long irregular pattern which had extreme high and back down. So if we look at this as a level of a trading range, because that's what this really is right now, and it's broken a little bit to the downside. But in order for it to continue down, it has to continue to move down, which it may do, but it has some support here. So that means that the stock has been in a trading range and broke to the downside. It will eventually find support from a dark pool. So if you want to sell short, you have to be careful. One of the problems with selling short stocks that are this volatile is, okay, here's an entry signal. I get in. It goes down. Oh, I'm so excited. I made a point and a half. All right. And then the next day it goes up. Oh no, I've lost all my money except for a little bit. Oh no, I'm going to lose money. Oh, and then it goes back down, and then it goes back up, and then it goes down. You have to have, for selling short, a straight run. You want a straight run up for your momentum runs, for your swing runs. And when it's moving down, you want a straight run down. If you have this choppy action and you try to trade this, I assure you, you will lose money. You will not be able to sleep at night. It'll be like this huge, gigantic vacuum that's sucking your guts out, is what it feels like. You cannot trade a volatile condition. You have to wait for a chart that shows a direct path down, and this one didn't. Even now, it's catching on some of the support level. Technicals are critical because the professional side use technicals all the time. They use charts. They study this, and the artificial intelligence and the machine learning that the professionals are using is not like anything you know. They're using AI to track all different kinds of markets and conditions and different ETFs and different things, because they may have anywhere from 2 to 10 legs on a single stock transaction. They'll have options, they'll have ETFs, they'll have futures, they'll have whole kinds of different activities. So the AI gives them all this information from when to sell a certain stock, and they're swinging 500,000 shares to 1 million shares at a time on a swing trade. Okay? You do not want to go against these guys. You do not want to be on the wrong side of the trade. You want to be trading with them because they will drive momentum. And then when they start to show a weakness in the pattern based on volume exhaustion pattern or a decline in vertical angle of ascent, this is a vertical angle of ascent, it will not sustain, it only goes so far. Then you have a little exit point right there, and then it moves down. The indicators will tell you this. RSI will tell you this. The RSI over RSI that I have. So it's all going to be very important to learn these patterns. The professionals tried automated orders. In other words, putting a computer and make the decisions on when to buy and when to sell. Total failure. They have professionals. I assure you that JP Morgan and Fidelity and Vanguard, BlackRock have a huge floor of floor traders. I've been on. And the floor traders are trading actively. They used to have 6 screens, but on my last visit, they all now have 9 screens. So they have their AI up here. They have their machine learning over here. So they route through their machine learning. They choose the stock. They choose the price points. They calculate their run gain potential. But the other artificial intelligence and machine learning they are using to augment the actual order processing. A lot of people would tell you, oh, it's all animated. Well, yes, in a certain degree, but not like they're telling you on social media and in chat rooms. The AI is not choosing the stock, is not choosing the entry point, is not choosing the exit point. A human trader is, because the human mind is far superior to understanding the emotional activity that is going on in this stock and what is happening. The stock is not a buy at this time, and it is not a sell. You could keep it on a watch list, but it's got all kinds of resistance as it tries to move back up, and it's got tons of support as it tries to move down. It would be easier to find a stock that has broken up and is going to be able to run up before it starts to correct and move down. So you want to look for a stock that doesn't have so much clutter and garbage in it. And this is not a head and shoulders pattern. This is just an extreme high in a trading range and then a move down, and it's going to find support right about in here. So this is not an ideal stock. It's too cluttery, it's too messy. There are more retail traders in it than there are professionals. And we have another one that has a lot of up and down, up and down. These are very hard to trade. It did have a run up, but no clean runs in it. And there's a lot of heavy selling. What is the heavy selling? Well, there are smaller funds managers. There's somewhere between 10 and 15,000, and that number will decline rapidly because they're actively trading. They don't have a lot of technical analysis experience. In fact, a lot of them poo-poo it and say, oh, technical analysis, it doesn't work. And so they are just kind of playing by ear or guessing or hoping or trying to do various things. This was a nice sell short, but that's about the only thing in this whole chart. This is a very tough chart to trade. If you have so many different stocks that you can trade, don't choose a chart that's so messy, so full of small funds buying and selling actively and losing money. That's why the market's going down quite a bit, because smaller funds are getting a huge amount of redemptions. And so that's causing them to be forced to sell their inventories before they are really willing to sell it, and they're actively trading and they're losing money. So all the smaller funds are declassified. They're no longer called professionals by the SEC. They're no longer having to submit quarterly reports to the SEC, because the SEC says, you're not trading like a professional, you're trading like an amateur. So these are run by individuals. They may have maybe 100,000 shares and less than 3 billion. 3 billion may sound like a large mutual fund or asset manager, but it's not. It's minuscule. BlackRock has trillions of assets under management, trillions. Most of the big mutual fund companies, pension funds, and derivatives developers have trillions of assets. So 3 billion is a tiny number, and those smaller funds are no longer classified as professionals. They're classified as retail. And that's a very important thing to understand, because you don't want to be trading with retail, and you definitely don't want to be trading with the smaller funds, because they're not even using technical analysis. They need to get MetaStock so they can be professionals. So if you're a small funds manager looking for help, you should consider MetaStock. Okay, we have another one where we have a trading range. It breaks to the upside for a period of time. It tops with a flat top formation. This is not a head and shoulders pattern. This is a flat top. It's one of the new tops that I teach for swing trading. And this flat top will break to the downside most of the time. Then see what happens when it finds the support area. It goes sideways. And this is a way to really bludgeon a new sell short trader or somebody who's in a position that's holding sell short for a long period of time. Most professionals do not hold a sell short more than a few days. They just don't hold it that long. They hold it for a few days and then they're out of it. And the sell short lists are a month behind. So if the professionals are selling short and they're only holding for 3 to 5 days, and those reports come out every month, that's ancient history. So you got to be careful using the sell short, and be very careful with squeezes, because the professionals love to trade against that. So you be careful with that, because those activities are something that requires an enormous amount of training and expertise. Selling short in and of itself is a whole different course that you need to take from me or someone else so that you understand the downside, because the price on the downside is completely different than the price on the upside. They're not exactly the same. The downside action will overlap. They will gap up and then run down, gap up and run down. When we have a velocity run, there will be no overlapping. It will run, there's a little overlap here, but after that, it's up, 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 no overlapping, no gap downs at market open. And that's a huge run that was instigated by pro traders, and then others ran and chased it until they sold out right in here. Pro traders would never hold at this topping, and they would not get into a sell short that is this messy because there's too much whipsaw. There's a little bit here, but look how much it overlaps. That causes you, every time you look at it every day, to check to see where you put your stop loss, because you need to adjust your stop losses constantly. That puts you in panic mode because you're in a losing position. It may go down the rest of the day, but at the first of the day, it may shock you. You want to be calm. You want to be centered. You want to have no emotions in your trading. And the way to do that is to get out of high-risk trades and get out of conditions where you're in a negative position. When you enter a stock, you should be making money from the get-go. If there's a stock that goes against you, it will go against you right immediately, and it will be a very, very small loss. And as I said before, professionals are accustomed to a 90% success rate. 90% of their orders, 9 out of 10, make them a lot of money, and only 1 out of 10 is a small loss, because they keep their stop losses moving very tightly, and they know when to enter. This is the kind of trading profits and trading expertise that you should want to have. You should want to be able to be like the elite traders of the world, like the JP Morgan traders and like the Fidelity traders. You want to be like them. You don't want to go, oh, well, if I have a 40% success rate, I'm okay. You're not okay. Would you trust a surgeon, heart surgeon, to do heart surgery on you or someone you love if he said, well, I have a 40% success rate with this surgery? I don't think so. So why are you, don't tolerate that in your trading. Start with at least a 70% success rate. 7 out of 10 of your trades are successful and 3 are small losses. And then work toward 80 and then work toward 90. Then you're making some real money, and you can go, I don't have to worry about whether there's a recession. I don't have to worry about whether there is inflation. I don't have to worry about anything, because I can trade the stock market and make money anytime I need it. You get that? That's how professionals are. They're not worried. There isn't a single article or any kind of discussion or anything on the professional side about a bear market or inflation. They don't care. Okay, we have another sideways trading range that moved up. Most trading ranges move up. So when you see a trading range market condition, or you see a stock in a trading range, the probability that as it starts to run up and then comes down, starts to run up and comes down, a little higher point right here, and then it moves down, but it always bounces off of this low, bounce off of this low. Okay, why is it bouncing off of this low? Because this is the buy zone area for the dark pools. And then pro traders go, all right, let's push this baby, and up it goes, and you want to get out. Buying with the buy side for long-term investments, or trading with the pro traders, the setups that they have, makes life easy, and it's very easy to track it with these great indicators from MetaStock. I'm really proud of these indicators, and I'm really, really proud of MetaStock as a charting software company that really caters to the retail side. Again, another very sideways pattern. So what you're looking for, I believe, is you're looking for sell short positions. You want a topping pattern that is a flat top or a V top or a W top. And you want to see that there's nothing in the way of your selling short. Because most of the time you won't get a run like this. Most of the time you're going to have up and down and up and down. And I can guarantee that that's not a good idea for that. So a lot of you are looking for selling short, but you're not looking in the right place. I would use my market condition topping scan that I have in MetaStock to look for topping stocks rather than trading range or range bound stocks. We have a lot of range bound stocks, and so it's going to be hard for them to go down as much as you need them to. Also, price doesn't matter. When you get a stock under $20, it's very rare for you to see professionals in it. There will come in from time to time, but you do see that it drops off, and there's actually very little activity going on right now in this stock. It's mostly small funds managers. This is a stock that's been trending up. It does have retracements, but it does catch itself, and it is making higher lows, and it is making higher highs. So this is a good one to take a look at for a long term to see what's going on. And of course, it's Suncor. And as long as we have energy prices and oil prices, speculative. And the other day, I went to my professionals in the oil industry, and I said, one works for Exxon, one works for CBS. And I said, okay, what's the actual give on this situation with these prices? I see it as something that's somewhat manipulated. And I said, is that true? And they said, well, of course it is. And I said, well, how long is it going to last? And they both said, as long as they let us get away with it. So as long as the oil industry is allowed to hyperinflate their prices artificially, price is going to go up. And you can see it's a pretty nice trend up. But you also have to worry about whole number resistance. And you also have to worry about, is this starting to turn and shift to a sideways? Because right here is a sideways pattern. You may not be able to see it as clearly, but that is a sideways pattern. So, and it slowly moved up a little bit before it broke out. So we have another sideways pattern going on here. And sideways is good because from the sideways or the trading range, you will have little pro trader setups or buybacks, and then the stock will move up strongly. You can also trade buybacks. They're just awesome, and they're pretty easy to track because the banks are using certain setups and certain patterns, and they're professional traders. All professional traders trade very similarly. They may have different indicators, they may have different ways of approaching the situation, and they may have different goals. When a floor trader is given the buybacks of a corporation to buy it, his task is to move price. That's his job. His job is to move the price of the buybacks. So the buybacks are not just to support the price, but to move it up. So a lot of great runs occur because floor traders are doing the buybacks. Why does a corporation not buy back its own shares of stock? Because it doesn't have floor traders. It doesn't have the knowledge or the resources to buy back its own shares. It goes to its bank of record after the board has approved the buybacks and the SEC has approved the buybacks. And it goes to its board as bank of record and says, do a buyback. And the bank says, okay, is your goal to just stabilize price, or do you want to move price up? And the CEO says, we want price to move up, or we want it to stabilize. If it's in a downtrend and it's going down, 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 like NVIDIA and all those, and the buybacks are keeping the price from going down too far. So you have to be careful of that because there are floor traders buying back the shares of stock on behalf of the corporation. And that's very important that you understand that. This is a nice uptrend. It looks like it's shifting sideways with a potential move up. It's a good price. You keep an eye on it. But if you're trading oil stocks, you have to watch oil commodities as well. So you need to keep a track of that. And every morning for my professionals, I give all of the foreign stock exchanges, I give all the commodity exchanges, I give all the information on what's going on in all the different markets at that market open, because they need to know what's going on, and I summarize that for them at 3 o'clock in the morning. And we have a very nice downtrend. And this is Tilray. And it's going down. Little teeny tiny candles moving down, moving down, moving down, moving down, selling, selling. Lots of little short, quiet rotation pattern, quiet rotation pattern, quiet rotation pattern, quiet rotation pattern. What's going on here? Who's selling? Any ideas? It's such a consistent trend. It is so precise. And then there's little pop-ups periodically. Boop. Who's selling? This is either a large derivatives developer selling this out so lower ETF units. They're not called shares, they're called units when it's an ETF. And this may be a member of an ETF, and they're lowering their inventory of it slowly over time. And then sometimes there's somebody thinking, oh, this is a great stock to buy on a dip. And then they go, okay, let's sell some more of this. Oh, buy on a dip. So it's going down, and it's not going down very fast. It's going very slowly. And that is what's going on with the stock. Eventually, it will stop at sell down, but this stock may be in a correction for a period of time, and it has to develop a bottom, and it has to develop a quiet accumulation buy zone before it will be a good stock to invest in. Its price points are so tiny, but they are consistent. But it would not net you very much in a sell short. Here's another one, slight incremental going down, almost horizontal here, almost horizontal there, running down. So there's some quiet rotation or rapid rotation going on. And then smaller funds are moving in and they're selling. There's an HFT spike up. That's a boo-boo on the HFT, and then selling down. And then a big, huge run down, probably on news. So this was probably moving down ahead of news. And it's a holding company, so it's a pharmaceutical holding company. So it's trending down. I would say that it's probably close to looking for support or finding a bottom action. So you would have to look on a weekly chart and make sure that it is not too low. And this is the weekly chart. So it's been going down for a long time. So I would be very careful because it gets to a point where it's so low that it doesn't net much as far as a good profit for your sell shorts. Boy, all of you are all really concerned about selling short. Okay, that's our HQQQ. That's the Qs. And that's what happens with the Qs is they follow the NASDAQ 100. So what you need to do, let's see if I can get this to show a little better, is you need to follow prices, the unit value of this QQQ ETF is not based on supply or demand. It is not based on speculative trading. It is based on the NASDAQ 100. When the NASDAQ 100 moves up, it moves up. When the NASDAQ 100 moves down, it moves down. It will mirror it almost perfectly. Why? Because the derivatives developers must maintain the trust account to match the value of the index, underlying index on which it is based. So the QQQs are based on the NASDAQ 100, and there are lots and lots of Qs or NASDAQ 100 ETFs. So there's a ton of shares of stock that are NASDAQ 100 components that are in ETFs that are being held for the long term. Does that make sense? Okay. So the people who are selling the NASDAQ are smaller funds and retail. Now, when you buy an ETF, you will be buying the value. And then what you have to do is you have to check the indicators to tell you whether there are the group of people that are buying the ETFs are accumulating or if they're selling a rotation. You've got to follow the volume. Look at how high the volume has surged. That has nothing to do with the value or the price of the ETF. That has everything to do with how many units exchanged hands in the last few days. There are a lot of people who invested in ETFs because ETFs do not have a redemption clause. You can buy an ETF today and sell it tomorrow. You can buy an ETF 2 years ago and sell it anytime you want. When you buy a mutual fund, you have a redemption clause, and those redemption clauses are often 3 months or longer. And the mutual fund, if there's a market run on the market, we haven't really had a run on the market yet. I know everybody thinks they have, but this is nothing. This is nothing. when we have a run on the market, and if all the ETFs start selling out and all those ETF investors, then the NASDAQ goes down, the ETF goes down, and the individual stocks will go down because we have a huge amount of inventory of stock of the 100 component stocks that are in the NASDAQ 100 for all these ETFs that are based on the NASDAQ 100. So if all the ETF investors sold all at once, this would go down. That's part of the reason why it is, because for a while, the ETF investors, which are younger generation, Gen X's and millennials, were holding. They're going, oh, I don't have to worry about it. I don't have to worry about it. I can just hold this stock and this ETF, and I'll be fine, because if I get scared, I can sell it tomorrow. I don't have a mutual fund redemption clause. I can sell it anytime I want. Then all of a sudden, they started getting worried. They started reading that social media stuff. Oh, man, we're doomed. A recession. Oh, no. Inflation. Oh, no. Interest rates. Oh, no. And the banks did a really good job of scaring the heck out of everybody, didn't they? You're all scared to death. Yeah. Inflation is high, but it's only because of oil prices. And once the oil peaks and the bubble is gone, it will go down. Interest rates actually help the stock market. They don't hurt it. They make it. They help it. Every time interest rates go up, 1996 to 2000, interest rates just kept climbing and climbing, and the stock market climbed as well. Happens all the time. Recession, we have about 8 million job openings and less than 3 million people that want. Recessions happen when companies start to have major contractions of their business cycle or their revenues and lay people off. That's what causes a recession. Corporations can't get enough employees right now, and corporations are recovering. Most of the 132 industries that I write about in my annual industry and sector report stated this year that their industry expected a late expansion in 2022. The first couple of quarters were going to be tougher, but after that, everybody was going to get back to business, and more new technology is displacing older technology. There is a huge amount of investment money going into infrastructure of corporations. They're buying distributed hyperledger technology. They're buying AI. They're buying machine learning. They're building new facilities that are all robots and robotics. They're investing heavily in the infrastructure of a corporation. Now, if they're doing that, do they need more people or fewer people? We have Amazon. Sure, Amazon had a spectacular rise during the thing, but that doesn't mean anything for what we have right now. That's one company. And yes, it is heavily weighted on the NASDAQ, so the NASDAQ is crashing. And of course, a lot of people were telling me to sell it. A little late, should have sold it sooner. Okay, I'm going to end right here because I see I have about 4 minutes left, Jeff. If you want to ask a few questions or something, I'll be happy. I'd like to end on time.
Yeah, absolutely. And you're doing great. I found what you had to say very interesting. So there you go.
I just like to give people the inside information. That's what I do. I mean, that's why I continue to teach. I love teaching, but I want you to understand that the professional side is completely different than the retail side, and what you learn and understand, and it makes your perspective completely different, and it calms you down. You think, oh, I don't need to worry. I'm okay. I'm okay. So this is our special. It's a free trial for 1 week. It's the Elite Methodology course. You can go as far as you can in it. The full course value is $5.99. This is my professional course, so this gives you a taste of what the professionals have. I have beginner courses also that you can ask for if you're just a beginner, or if you're an intermediate or been trading for 2 to 5 years. Then I would say you can, the beginner course. But we're offering this because there's a lot of professionals. MetaStock brings a lot of professionals to the table. So you need to contact us by May 23rd. You can email us or call us. And there's no obligation whatsoever. You get to experience this fabulous course. It's one of my favorites, and see what it's like. So if you're gung-ho to see what the professional trading is like, take it for a week and see how it rides like a Lamborghini, and you'll have fun. Okay, Court, any questions before I tune out?
Which one quick question I think we can have time for. Bill wanted to know if you could take a moment to identify market participants based on quiet accumulation, such as the difference between dark pools and small fund managers, for example.
Yes, okay. What I want to do is quiet accumulation. The bars are small and short. They're very short, and they oftentimes are gray. They will get in. They're going to be in. This isn't a good chart, but they're going to be in a very quiet area. And I don't know if I can find anything today on these charts. Okay. I have a community center for people who are just visitors to our site. There's no obligation whatsoever. All you have to do is sign up and then sign into the community. The community is this thing I just started. I talked about it last time I did a MetaStock performance, and it's up. So when you join the community, I will show you buy zones. I will set some up this week. So if you join that, like I said, it's no obligation. It's just open to anybody who wants to come and visit my site. And I thought it would be fun for MetaStock users to be able to communicate in an open forum that has a professional that can step in and say, oh, this and that, and so you can communicate. So if you feel like you want to, that's a great place to go. Otherwise, if you email me at info@tickandtrader.com, I can provide you with an individual chart that shows you the buy zones, okay? I will do that for you. And we are about out of time. Anything else?
Yeah. One comment I'd like to agree with. Absolutely great, Martha. Love the presentation and love you. That's from NA Fair.
All right. I hope you learned a lot. I really enjoy teaching people. So I hope I know it's kind of like a fire hose, but you need to know this stuff. Thanks, everyone.
It was great.
Bye.
Thanks, Martha. Okay, let me go ahead and do this. All right. And push my buttons. All right. Okay. All right. And I'm going to make myself the presenter real quick. We love having Martha on. She does such a great job. So let's talk about Stocks and Commodities Magazine for a second. Again, Stocks and Commodities Magazine has been supporting the event for a decade now. We've been doing these things for 9 years, so we appreciate that. They help us get people there to the event. They've been really a great sponsor. As a subscriber, you get access to all 17,000 of their trade articles. They have 1.3 million subscribers, and they've been publishing since 1982. So very, very well established company. They've been doing a very good job. We love Stocks and Commodities. Top notch. So if you take advantage of any of the subscription offers, like you get the extended trial that I'm about to tell you about, you're going to get a free 5-month subscription as part of that. If you spend $300 or more on any of the offers today here, we're going to give you a complimentary, or actually, Stocks and Commodities is going to give you a 2-year subscription. So I say we, that implies that this is Stocks and Commodities. They're giving it away. So we appreciate the support, the help. They've been great. They've been fantastic sponsors, and we appreciate that. I do want to say we are MetaStock. I hope you're enjoying the class today. I am. I've learned a lot, especially Martha did great. So if you're not familiar with MetaStock, we've been rated #1 in our price category for only 29 years in a row. It can help you scan the markets to find trade opportunities. You can test trading ideas. We've got a patented forecaster. All of this starts at $59 a month for our DC, what we call our end of day, or our DC version, which means end of day. If you want, you can get an extended trial on any of our programs, whether it's say DC or the real time. What that allows you to do is pay for the first month, and we'll give you the second and the third month for free. But wait, you'll also get some training to help you get started with that. We'll include our Unleash the Power of MetaStock. We also have what we call a white glove installation service, and we call it that basically. We'll have one of our technicians call you. If you want, they can help you install the software. If they can kind of show you how to do scans, how to use different parts of the program, and all of that is just included. So the price of that, if you average it out over 3 months, is about $20 a month. So for less than $29 per month, which is the amount that we've been rated #1 in our price category, you can try MetaStock for the next 3 months. And if it's helpful for you, great. We hope to service you for a very long time. Otherwise, you can just cancel. So to do that, give us a call at 800-882-3040 or visit us online at metastock.com/conf-promo. So we're going to move straight into our next presenter, Larry McMillan. Larry is a guy that almost needs no introduction, but he's a he's huge. He's a great options guru. Today, what he's going to talk about, I'm very, very interested in. He's going to look at some of the option indexes that he uses to give us an idea of what future markets are going to look like, and of what. Well, okay, so what the current option indicators are telling us about the current market. So let me not put words in his mouth. That's exactly what he's going to talk about. So there you go. Larry, let's go ahead and get you on here. How you doing?
Good, Jeff. How are you?
I'm doing great. Thank you. I'm glad you came. Let me go ahead and thank you for participating too, by the way. I'm going to make you the presenter right now. And I'm also going to change you to the organizer so you can see any questions. So both of those are done. And I can see the current state of the market.
Good afternoon, everyone. We're going to spend the next hour or so talking about the market and what the option indicators are telling us about the market. Just a little background on our company. I started this company, it's over 30 years ago now, as a derivatives, oops, sorry, I advanced the page I didn't mean to, as a derivatives research company. And we were originally doing, selling data, giving out comments, that sort of thing. But we then moved into money management. In color, that's what I'm trying to get to. We then moved into money management around 2008 when we had some really good calls on that financial crisis. And then we also do a certain amount of option education. We have a mentoring program and other things like that. So I'll come back to this later, but we are going to have some specials on our newsletters for you. So this is our 4 main topics I'm going to be talking about. We'll go into some subcategories of these, but first and foremost, we're going to take a look at the chart of the S&P 500. No matter what your indicators are saying, if they're not agreeing with the trend of the S&P 500, then you're wrong, because the S&P 500 is, the ultimate pricing mechanism. We'll also look at equity-only put-call ratios and other put-call ratios in individual stocks and futures. We'll take a look at market breadth, where we have a way of looking at that in an option-oriented sense. And then we'll take a pretty good look at VIX and VIX derivatives and other things involving VIX. So I have a very important rule, which is certainly in force right now, and that is oversold does not mean buy. Oversold markets can continue to fall for quite some time. We've seen that this year many times. It amazes me how just one little oversold condition gets all the bulls to come out of the woodwork and say buy the market. And they get these one-day rallies. We've had 3 of them now, and they pretty much have not had any follow through. Yeah, one of them, of course, will eventually. And a related statement, although this doesn't apply right now, is that overbought does not mean sell. We don't have any overbought conditions at the current time, so that's irrelevant now. But there will be a time when there are overbought conditions. So here's a 2-year chart of the S&P. I like to just show this to show you exactly where we sit on this. We started out 2 years ago with a monster bear market. It basically took 1 month to complete, down 35%. Then we had just a couple of minor corrections, 9-10% in this area, September of 2020. Then last fall, again in September, a small one, about 6%. But now we've run into some real trouble, and we're down, 20% actually intraday from high to low on this current move. And you can see that we failed the last couple of times we rallied up to the 200-day moving average. So that's a pretty big negative as well. If we take a closer look at the S&P, you can see there's the downtrend lines that are in effect. So we're in a pattern of lower highs and lower lows, and by definition, that's a bear market. You can talk about trading within that thing, and of course, right now, we got down here and made another new low near 3,900 on Friday before we bounced. And so I thought I changed that chart. But anyways, that is support on the very short term. And then we have resistance right here. Those were two of those big rallies that failed quickly, right around 4,300. And then, of course, the 200-day moving average, which is now rolled over and is aiming downwards, has resistance up there above 4,400. So basically, an oversold rally, if we do get a real one and not just these one-day things, will generally rally up to about the 20-day moving average, maybe a little beyond that. So right now, the 20-day moving average is at 4,190. And I showed you there was that other resistance at 4,300. So any kind of short-term rally, I would say that would be the target for it. And that's, right now we don't even have any buy signals. Well, maybe one that's set up. So we're not really looking for that to happen immediately. But as we grind out down here near the lows, eventually we will get a rally of that size. We had one back in February, March, and it just about mirrored that exactly. It went up above the 20-day moving average, right into resistance, and then failed. So our main thesis is the last sentence here. We are maintaining a core bearish position in our newsletters and in our recommendations. We will trade longs around that if we get confirmed buy signals, and that's what we're going to talk about here today, whether or not we're getting any confirmed buy signals. But as long as that S&P chart is in a downtrend, we're going to maintain that core bearish position. We've had it on for quite some time already now, and we roll it forward, but we are sticking with it at this point. There's another thing that we do with the S&P chart, and as we draw modified Bollinger Bands. So you're probably familiar with Bollinger Bands. And when John Bollinger invented Bollinger Bands, he defined the standard deviation or the historical volatility, however you want to talk about it, of the S&P as being the standard deviation of daily closing prices. So John used this definition here. Unfortunately, Black-Scholes, which we have to adhere to because we're an option firm, and other mathematical guys use a slightly different definition, and that's a standard deviation of daily percentage price changes. So it makes a small difference. So when we draw the Bollinger Bands, we use that definition of volatility, and we look for the market to move outside the plus or minus 4 standard deviation band, and then when it moves back inside, we get a signal. Now, there have been a lot of, it's been a great system, but there have been a lot of failed signals as well. So we've tightened up the criteria and require a confirmation factor, which we call McMillan volatility band. So I'll show you how those look. So this is the current chart of the S&P with those volatility bands drawn on it. So up at the top is the plus 4 standard deviation band right here, and then just inside that, 4 standard deviation. Just inside that is the plus 3 standard deviation band. So here you can see S&P moved outside the plus 4 standard deviation band, then moved back inside, and that was a sell signal. It pretty much immediately hit its target, which was the lower or minus 4 standard deviation band. So that was a successful signal. The last signal we got was actually in February as a buy signal. We went below. Here's the 4 standard deviation band. We went below it for several days, popped back above it, and after some messing around for a while, went up and hit the higher band there in March. That terminated the signal, and right now we don't have a signal. We've come close to falling below the -4 standard deviation band right over here a couple of days, but we did not close below it, and so we don't have the setup for a signal. You will notice here that we closed below it there and went back inside it there. So that little thing right there is what we call a classic Bollinger Band buy signal, and that's the ones I said before. We had quite a few of those that were stopped out. So we require further confirmation, which will be the close above that level. We've obviously gone the other way. But if we were to close above that level, also that's resistance, that would be a buy signal, but that's really not too probable at this current time. So, as I said, we don't really have a McMillan volatility band signal in effect right now. We would get one though at a move above 43.08. What I really would like to see happen, if we're going to really set up an oversold rally, would for the market to go down, close below the -4 standard deviation band, and then give us an actual signal. So these are the kind of things that we follow on our newsletters on a daily basis. You don't have to calculate all these things for yourself. In fact, we have a subscription service that will calculate these volatility bands on anything, stocks, ETFs, futures, indices, what have you. And it's a relatively low-cost subscription. If you're interested, you can visit our website and look that up or shoot us an email. All right, so basically, chart S&P is negative, and we're holding a core bearish position because of it. So what about the other indicators? You're going to see that many of these other indicators are quite oversold. Put-call ratios are an excellent contrary indicator. We use the equity-only put-call ratio, which means all stock options that trade. We use that to predict the S&P 500 direction. Put-call ratios were invented by Marty Zweig back in the 1950s. And in those days, he got the volume of the options out of the ads that were run by the put and call dealers and barons each week. And after a few months of studying this, he realized that if there was heavy put buying, the market tended to rally. If there was heavy call buying, the market tended to go down. So it's a contrary indicator reflecting speculative opinion at an excess is what you're really trying to look for. What is too much put buying, what is too much call buying? Well, I'll show you how we determine that. And let's just take a simple example. Let's suppose that we're looking at IBM, and at the end of the day, we sum up the volume of all the puts that traded. Separately, we sum up the volume of all the calls that trade, divide the two. That's the put-call ratio. Now, put buying generates higher numbers since puts are in the numerator of the fraction. So if put buying is heavy, that makes the ratio go higher. But when is put buying likely to be heavy? Well, that's when the stock is going down, or the market, or whatever we're measuring. So they move in opposite directions. Same thing for calls. Calls are in the denominator of the fraction. So a heavy call buying or an increase in the denominator of a fraction will make the fraction go lower. And when is that likely to happen? When is there likely to be heavy call buying? Well, that's when the stock is going up. So again, they move opposite to each other. We keep a moving average 21 days is what I use just in case there's something to Fibonacci. And this is in theory what your put-call ratio chart should look like. Now in our put-call ratio charts, we always show you the stock price and the put-call ratio. On our website, we publish about 1,600 or more put-call ratio charts every day. And many of them are weighted charts, which we'll talk about in just a second. But here's the theory. Let's say we're seeing this stock and it's dropping like this, and people are buying puts along the way, and they're making money. So during a trend, the public is right, but eventually the put-call ratio tops out and makes a local maximum. So a local maximum on the put-call ratio chart is a buy for the stock, a buy signal. So now the stock starts to move higher. Move over here to the left, stock's moving higher, and the put-call ratio is going lower because people are buying calls in a rising market. Eventually, the put-call ratio bottoms out at a local minimum, and a local minimum is a sell signal for the stock. So ideally, if you're looking at a put-call ratio chart and you don't see this inverse symmetry, or you don't see it very often, then that's probably not a good candidate to use the put-call ratio on that chart. This is not a current chart, but is the S&P 500 index on top and the equity only put call ratio on the bottom. And you can see that the inverse symmetry does exist most of the time, and that's why we use the equity only put call ratio to predict the S&P chart. So here's the current ratio. This is a simple volume ratio, and the most recent signal was the one there in mid-April, right here. And again, remember, a local minimum is a sell signal. So that gave us a sell signal. Well, let me draw a line up here. Gives us a sell signal about in that area. It's been quite good. You can see it's been on a sell signal for much of this year. This one came from a very low level in the chart, extreme optimism down there. This one more of a mid-level. Now we're up here to a very high level, meaning pessimism is running high. There's a lot of puts being bought, and that's the highest actually that this ratio has been since the pandemic of April 2020. But it's still rising, and so it falls under the category of oversold does not mean buy. Yes, it's oversold. There's been a lot of put buying to get us to this level, but a buy signal will actually occur when it rolls over and forms a local maximum. That has not happened yet. Now, we use computer analysis programs to look at these charts and give us some guidance as to whether that's going to roll over or not. But right now, it's still on a sell signal. As computers became more prevalent, we were able to calculate another put call ratio, perhaps a more pertinent one, and that's the dollar-weighted put call ratio, or just the weighted put call ratio. The way we calculate it is at the end of every day, we take an option's closing price and multiply it by the option volume that traded that day. That gives us the dollar volume for that option. Now, you could do it on a tick-by-tick basis, but that's expensive, time-consuming, and it really wasn't. We tried it for a while. Wasn't giving us any better result than just doing it this way. So we make that calculation for every option. Let's again say it's IBM. So we sum up those multipliers for all the puts, then separately sum them up for all the calls, divide the two, and that's the dollar-weighted put call ratio for the day on IBM. So now we're measuring the dollars being spent on bullish opinion versus the dollars being spent on bearish opinion, and that is usually a more extreme measure. The signals occur, oddly enough, in a very similar spot, but you can see again here, this local maximum came in mid-April, about the same time as the other one. But now this thing has raced all the way up here. It's at its highest level since April of 20, and in fact, it's getting up towards where it was in March of 20. But again, it's still rising. So it's oversold, but not yet on a buy signal. The buy signal will happen when it rolls over and starts to head back down. You can see that last fall, I marked here, this low level here, which is 50, meaning $50 are being spent on puts for every 100 calls. That's a very low number for stock options. And so we went from extreme optimism about the market last November to now a very pessimistic stance on the market. We're now at about 170, meaning $170 are being spent on puts versus every $100 being spent on calls. And this is just in stocks now, not indices or something else like that. So an interesting and oversold condition, but still not a buy signal. So we're waiting for a buy signal here. It's too late to act on a sell signal here, but it is still in progress. So as I said already a bunch of times, oversold does not mean buy. So we won't have buy signals here until these ratios roll over and begin to decline. Now you might think since they're 21-day moving averages, we're not going to be anywhere near the top of the ratio or the bottom of the market. But those computer programs that I talked about will help us get in pretty quickly, usually when the thing begins to roll over. So what options do we actually buy when we're, trading these signals? So we talked about a Bollinger Band or a McMillan volatility band signal. We're talking here about a put call ratio. So I usually trade an option in the money with a fairly high delta because I'm in the business of predicting the underlying here. and I don't want to lose money on the option I'm using to trade that with. So the higher the delta of a call, the more it behaves like the stock. So the delta of a call ranges between 0 and 1. 0 meaning it doesn't go up at all when the stock goes up, and 1 meaning it goes up point for point with the stock. So a normal option is somewhere in between. But the higher call deltas will respond quickly when the stock moves, whereas if you're buying something way out of the money, an option with a striking price well above the current price, that's a low delta, and it may not move depending on what else is going on in the market. So we typically buy SPY options for trading the broad market, 1 or 2 strikes in the money, and looking for a delta of 0.7 or higher. If we're buying put-call ratio signals, especially on stocks or something, and we're going out a few months, then I'll buy an at-the-money option. But even that still has a delta of 55 or so. So if it starts to move, the call is going to move with it. So you see on TV a lot where they talk about option trading. They're talking about spreading all the time. And in my opinion, they're overly obsessed with it. I don't know why exactly, but if you go into the theory of it, you really should only do a bull spread or a bear spread, which is also called a vertical spread. You would only do that if the options are expensive, but most of the time options are not expensive. And so if you're buying a call at this strike, let's say, and it has, buy that call, it has unlimited profit potential. But if you sell a call at a higher strike, which is what makes a bull spread out of it, then you cut that profit potential off. So you should be very careful about cutting off your profit potential, because that's where you're going to make your really big money. The options is the times when you really get something that takes off for you. You don't want to limited your profit potential in the beginning. Now, if the options are really expensive, then yes, a bull spread or bear spread does make sense. But even then, if the options are expensive, it means the underlying is volatile, and you could have you could be still unnecessarily limiting your profit potential. Now, I know the reason that they always say is, well, you're putting up less money, but that's silly. What you're risking in both cases, whether you buy a call or buy a call bull spread, is 100%. You're risking 100% of the money you put up. So dollars aren't really that important. You can adjust the dollars just by the quantities that you buy, but you're risking 100% in both cases. So why cut off your profit potential if you don't need to? Now, there are things you can do if you put a spread on to mitigate the negative aspects of the underlying moving too far in your favor. It's a good thing it moves in your favor, a bad thing it moves too far. So one is to widen the difference in the strikes. So for example, if we're doing a SPY call spread right now, I'll make the strikes 13 to 20 points apart, depending how far out in time I'm doing the spread. But on puts, the puts are a different animal in SPY because of the way the skew is and everything. So here we go 30 to 40 points wide on the SPY puts for a bear spread if we're doing a bear spread. In addition, whether you got a bull spread on or bear spread on, once your underlying hits your short strike, now you're running into the profit limiting part of the spread. And so what we do at that time is we roll the whole spread. We take our profit on the one we're in, and we move it, say in a call situation where it's gone higher, we move the whole spread up, or in puts, move the whole spread down. So those two things will help you mitigate the negative effects of being in a spread when the underlying is moving very quickly and has gone through your short strike. So let's look at some individual put call ratio charts too. Those are always kind of interesting. In terms of individual stock options, we only use extremes on the put call ratio chart. So this is UPS, for example, and you can see that it got up here the other day and formed a local maximum, which is a buy signal for the stock. Now, you can see the stock is in something of a downtrend, so you might want to wait for it to break out through that little downtrend or something. But basically, here's your local maximum. There was a nice one back here. You got a pretty good pretty good run out of the stock for a while there. So we don't use these little ones in the middle here. That would be to buy, local minimums to sell. We don't use those for stocks and for futures. What we do use is the extremes. Down here was a very low extreme. This is a weighted ratio. Only $25 being spent on puts for every $100 being spent on calls. That was a pretty good sell signal. It got you in that downtrend. This one was not so good. And so when we mark them with a blue letter, that's generally a losing signal, where the red letters are winning ones. We don't know yet whether that one will be winning, but we'll be optimistic about it. This is Qualcomm. Again, most recently we got a buy signal here. Now this one, since you just made a new low, I'm not really interested in owning this stock unless it can break out either above there or maybe at least above here. So I'd want to see the stock reverse upwards a little bit before I acted on that new buy signal from the put call ratio. Seagate, this is one we got a buy signal a little over a week ago, and we're waiting to see if the stock can move up through that resistance area there. If it can't, then fine, we won't buy it. But if it does, we'll use some technical analysis in line with the put call ratio signal. This is a sell signal we just recently had in CMT. Now we're already short that one, or long puts, but you can see that it's kind of set up another little support area. So if you're interested in this, you might see if it breaks down below there, then you could move in using the put call ratio signal as your guide. Citigroup, another one, gave a buy signal, but it's in a steep downtrend. So I'd want to see it break that downtrend before I bought. You can use futures options too. So this is gold. And on the bottom here, this put call ratio chart right here is drawn using the gold futures options that trade on the COMEX, or the old COMEX. And so you don't have to trade gold futures options, though. You can trade GLD options. And in many cases, there's an ETF that simulates a commodity, in this case, GLD. And so you can see we got a couple of recent sell signals there. The last one is not real fresh, came in late April. Then also one more chart, T-bonds. Everybody hates T-bonds, of course. And so as rates are starting to rise, everybody's buying puts. Eventually, the put buying ceased. That gave us a local maximum on the T-bond option chart. And again, these are the T-bonds that traded on the board of trade, T-bond options. And but we don't have to trade those, the board of trade options. You can trade TLT, which is a ETF that simulates the long bond. Here again, I think though that I would wait for this downtrend to be broken before you moved in. Okay, enough for put call ratios. Let's move to the next topic, which is market breadth. So breadth is simply the advances minus declines on a daily basis. You can keep a cumulative total, or you can calculate an oscillator. We calculate an oscillator defined this way. Today's oscillator value is equal to 90% of yesterday's, so today's oscillator is equal to 90% of yesterday's oscillator value plus 10% of the difference between today's advances minus declines. Now there's a couple of data sets you can use here. One is New York Stock Exchange advances and declines. That's the common one. Pretty much everybody pays attention to that. That's into technical analysis, and that's easily obtained from the Wall Street Journal website or other places. But there are things on the New York Stock Exchange that are not stocks, and so you can get a distortion there. So we also calculate a stocks only put call ratio. And what stocks do we use? Well, you could use just stocks from the New York Stock Exchange, but for us it was easier. We use all optionable stocks. There's about 6,000 of those now, more than 6,000 actually. So we use that data set as well. So this is the oscillator using the stocks only data, and it goes back to 2009 here. And this is up to date as of yesterday, I believe. And so if the oscillator moves higher, it gets overbought by our definition. It's over 200. gets oversold if it's below minus 400. And, most of the time in the last 10 years, 9 years, the market's been going up. So we don't have that many oversold conditions, but we have a couple of monster ones. This was December of 2018, right before Christmas. They were a very nasty market. This was the pandemic, which ironically was, bottomed out in its oversold condition at about the same level that the December 2018 one did. And now we're in trouble again, basically. Here's where we are right now. We were just there a little while ago. And so we're very oversold in these situations. So this is oversold right now, despite the big rally on Friday. And we're waiting for it to not be oversold before we get a buy signal. So again, oversold does not mean buy. Same thing for overbought. You can see here, this massive oversold condition here in December of 2018 eventually resulted in a buy signal. It didn't miss the bottom by much, but maybe there. And then you got massively overbought for a while. But again, overbought does not mean sell, and so you didn't really sell till later on. So this indicator, it does pretty well. It has some whipsaws to it, and we're always cognizant of those. But it's been on a sell signal for a while, since right back here, and we're still clinging to that sell signal now, I would say. But it's probably going to take, today advances led declines by like 50 issues. That's not going to do much. It's going to take a couple of days of better positive breadth than that to turn this into a buy signal. So this more or less just repeats everything I said. There's one interesting thing. Friday was a 90% up volume day. In other words, advancing volume was more than 9 times declining volume. That's it's usually a pretty strong signal for the next day, but not much beyond that. However, we have been seeing these 90% down days and now up days occurring, and that just means the market's getting more volatile. And in the broad sense, a volatile market is more typically a bearish market than a bullish one. In fact, a lot of times the media just uses the term volatility to mean, bearish, but that's not really true, of course. But who's going to explain it to them? Anyways, so as I said, these are currently on sell signals and in oversold territory. We're waiting for some buy signals to come along here, but they haven't done that so far. I mentioned cumulative breadth. Cumulative breadth is just you take the advances minus declines every day and you keep adding that up. So at the current time, cumulative breadth is not saying anything. But what it's good for is in a rising market when S&P goes to a new high. If cumulative breadth does not go to a new high, that's called a negative divergence. And in this market, we had a negative divergence from June all the way through the final new high in early January by SPX. So, 7 months of negative divergence. That's usually a pretty bad thing for the intermediate term. And, we're down for 4 months, so maybe that's an intermediate term, but maybe not. So this was a big warning sign, though, and we were telling our subscribers about it along the way and trading accordingly. New highs versus new lows. This chart goes through last Wednesday, and you can see the red under net. That's new highs minus new lows every day. Whether you're looking at New York Stock Exchange data, stocks only data, in other words, optional stocks, or NASDAQ data, it has been horrendous. You can see that some of these days at the bottom of the chart here were just terrible. New York Stock Exchange, 5 new highs, and those are probably bond related things. 911 new lows. Now things improved Friday when that big rally day, but still this is not on a buy signal yet, and it's going to take a couple of days at least of new highs, not only outnumbering new lows, but new highs being at least in the triple digits or more. So that's not going to be an easy task to accomplish yet either. So it's on a sell signal and oversold. So you can see these common pattern emerging there. So finally, let's take a look at VIX and the VIX indicators, because they're very important to option traders and really to anyone paying attention to the market. If we're using VIX as an indicator of the market, there's two things that are really very important. Number one is the trend of VIX. It should be trending opposite to the way S&P is moving. And secondly, spike peak buy signals on VIX. So when VIX spikes up and back down again, that's a buy signal. So we've created a trading system based on those spike peak buy signals. I just wanted to comment, this again does not apply and hasn't applied really since about 2019. A low VIX. We haven't, it was surprising last year when the market went to new highs many, many times all year long. VIX didn't drop back to like the 10, 12 level where it often does. It stayed higher. And some people thought that was a warning sign. I guess they were right eventually. But anyways, a low VIX is overbought. But again, in that sense, it's not a sell signal just because it's low. That is not happening now. What's happening now is VIX is up in the 30s. This is the last year, and you can see the fairly large number of spike peak buy signals that's occurred. Again, red letters are positive trades. We have a system we built around this. Blue letters are negative trades. And we just had a new signal on Thursday, a new buy signal. So that is our only confirmed buy signal that we have right now. It's shown as a green letter because it's in progress. So when VIX spiked up here and then back down to here on Friday, that confirmed that as a buy signal. Actually, on Thursday's move was enough to confirm it as a buy signal. So that's a short-term buy signal, lasts 1 month at most, and it gets stopped out if VIX moves to a new high. Now, what's really odd about this chart, though, we're in a pretty difficult market right now. I think this is a bear market, and VIX has not responded well at all. You can see here, the VIX has not even gotten to 40 intraday, much less closing there. I think its highest close is like 38 something, or maybe 37 something. So it has really not gotten with the program. And there's a lot of reasons why. We might talk about that a little bit later. But the trend of VIX is bearish. And so the way we determine the trend of VIX, I'm just going to erase that what I just put on there. The trend of VIX is determined by the relationship between the 200-day moving average, the 20-day moving average, and VIX. So if VIX and the 20-day moving average are on the same side of the 200-day, that determines the trend. In this case, they're both above it. That means it's in an uptrend. You can see the 20-day moving average is moving up much faster than the 200-day, but VIX is in an uptrend. And when VIX is in an uptrend, that's an intermediate term sell signal. Now, you might say, well, yeah, but it could quickly switch to a downtrend. Well, it really hasn't. You can see here in January and here again in April, VIX went below the 200-day, but the 20-day did not. It came close, but did not. And so that's been on a sell signal, an upward trending signal, all the way since last November when they crossed above right there. That's the last time the 20-day moving average was below the 200-day. And so we're watching this, and it's still bearish. So VIX closes below the 200-day, with the 200-day right now is down here at about 22 and change. VIX gets all the way back down to there. That would alleviate the sell signal. But until then, this is an intermediate term sell signal, and as a result, it requires some amount of caution for the market. And this is also part of the reason we're holding that core bearish position. Now, I said the spike peak buy signal was confirmed last Thursday, so that's a positive thing. And of course, the trend, as I just explained, has been negative since December 2nd. So I really just go a little bit deeper into that. I was talking about how VIX has been at a relatively high level. So last year, the low for VIX was 15. And this year it's more or less been 19. Now, even when the market was at a new high in January, and last year the market was a new high many times, but VIX never got back down to, let's say, 12, where it used to get to. So what determines VIX is the pricing of SPX, S&P 500 options. They're very expensive options. They're priced, with strikes in the same numbers as the S&P, like 4,300, 4,400, that kind of thing. So big money trades these. Now, big money is not always smart money, but it usually is not dumb money. And so when they were holding VIX at that high level, they were worried. They were buying protection and still are. So if big money still thinks it's necessary to buy protection, maybe you should as well. Anyways, we can't trade VIX. It's a very complicated thing, and you can't trade it like you can the S&P 500 index, let's say. But you can trade futures on it and also options on those futures. So we can look at how the derivative products, the futures and the options, are what their relationship with each other is to determine further the trend of the market. So in a bullish market, the various futures line up positively. So the closest future will be the cheapest, and then they get a little more expensive as you go out in time. And that's the term structure, and the term structure slopes upwards. In addition, and when that's the case, VIX is usually lower. So VIX is below all of these. So they're all trading at a premium to VIX, and they're sloping upwards. That's a bullish market. We saw that for most of the time in 2020. But in a bearish market, this happens. The near-term futures go to a high price, and the term structure slopes downwards, and typically VIX is higher, and so they're trading at a discount to VIX. So if that happens, that's a very bearish market. So where are we right now? Well, we're kind of in between. I took these prices this afternoon around noon, and VIX itself at that time was 28.58, and the front month May futures were 28.15. I put this little asterisk here because the May futures are based on SPX options, in other words, those expensive options that expire on June 17th. And I'm not going to go into why, but just take my word for it. So I understand there's plenty of other expiration dates, and nearer term ones might be more expensive, although they're not really right now. But in any case, if we take 28.15 and we subtract off the price of VIX, that's minus 43 cents. In other words, these futures are trading below the price of VIX by 43 cents. So let's see how the futures look. Well, this is a little more expensive. June is a little more expensive than July, and than May, I'm sorry. July is a little more expensive than June. Then it starts to flatten out, and then here it goes back the other way. It goes down again in these last few. Meanwhile, the premiums are pretty small numbers. Usually they're much bigger than this. So that's a pretty flat term structure. So it's not really sloping upwards like I showed you in a bullish market, and it's not really sloping downwards like you would see in a bear market. So this is in between, and I'm not getting any signal from the term structure of the futures right now. Now, the futures are available on a delayed pricing basis on the CBOE's website. But if you don't want to do that, you can also quote these various CBOE volatility indices. They publish, well, VIX is a 30-day index, but they also publish a 9-day index, a 3-month, a 6-month, and a 1-year. And here you can see they're kind of all over the place. Some are higher than others, lower. So again, relatively flat in that term structure. A downward slope here would be bearish, and upward slope would be bullish. But right now it's kind of flat. So we're not getting a lot of information out of the term structure itself right now. But what we watch for very specifically, because this has been a big tip-off to a market that's gone into somewhat of a free fall, is if the front month future rises up and goes more than a point above the second month future. So right now, May is 28.15 and June is 28.75. So May is 60 cents below June, and so that's fine. That's not bearish. But if May were to rise more than a point above June, that was the case in February 2018. It was the case in February 2020, and many other times in the past when quickly the market deteriorated badly. This particular market has managed to avoid that, partly because this decline, despite being fairly large, at 20% already is really sort of orderly. It's not nearly as negative as, you know, we've seen in some of the other kind of little mini crash markets. February of March of 2020 was probably more than a mini crash, but it wasn't a real crash like the flash crash or the financial crisis. But in any case, this has stayed relatively calm. So that's somewhat encouraging, but it's been flirting with but avoiding a sell signal for the last few weeks. So, you know, I can't answer this question. This is the rhetorical question. Why is VIX lagging? I mean, there's really only two reasons. The lack of demand for SPX puts. SPX puts is what drives the price of VIX most obviously. And why don't people want to buy puts? Because even if the public is buying, let's say, SPY puts, that gets translated back up into SPX puts via the market makers and arbitrageurs. So why is no one buying SPY puts to speak of right now? Do they already have them? They're not believing in this bear market. I'm not sure what, but demand is relatively low. I mean, we see a lot of trading, but still relatively low. The implied volatility of those out of the money SPX puts is modestly high, but nothing like it was in 2020, for example. Or could it be this, that the puts are expensive and so it's brought out the sellers. So the sellers are saying, well, I'm going to sell those S&P puts because I think they're a good signal. There's high implied volatility. This market has not been that crazy, and I can handle selling those. That's more of a professional strategy, but there's certainly some of that going on as well. So we'll never really know the exact answer. I will say this: in 2008, when the market collapsed in the financial crisis in October 2008, VIX went shooting to the roof, like 90 or something. But then as this market recovered and went into January, VIX fell to like 55. And then when the market sold off for 2 strong months of sell-off back into the lows of March 2009, VIX basically just went sideways. It didn't react that second time around. And that was widely attributed to the first reason here, that everybody who wanted to own puts already owned them. Again, I'm not sure I buy that 100%, but this thing has happened before. So I don't think you can draw any strong inference from it, but you just have to trade it for what it is. But if you're looking for protection, right now, buying S&P puts for protection is far more efficient than buying VIX calls. And sometimes in the past, buying VIX calls was a tremendous way to hedge yourself, but not so much recently. So to summarize, here's where we stand. So we have one bullish indicator, that VIX spike peak buy signal. We have our main bearish indicators, which is the trend of S&P being down and the trend of VIX being up. As long as those two things are in place, we're maintaining that core bearish position. The construct of volatility derivatives was sort of bearish, but it's really moved more into the neutral category. These indicators are all in sell signals, but oversold, as we discussed. Put call ratios, breadth oscillators, new highs versus new lows, and the volatility bands, which are probing the -4 standard deviation line. So that's a bearish picture. It's a bearish but oversold picture, and it could change fairly quickly. Most of these indicators, as you saw, can swing pretty quickly. So, but that's option trading, and that's the way we treat things. But our intermediate term indicators are the most bearish ones, which is probably a much more negative sign. So last week in our main newsletter, The Option Strategist, I wrote a short article. Well, first of all, I paid respects to James Dines, who recently died. But Dines was, when I first started trading in '72, I got a hold of his newsletter, and he was bullish on gold. And thankfully, I bought some gold based on his recommendation. But he was also bearish on the market. And there was only one other guy that I saw at that time in '72, '73 that was bearish on the market. And that was Justin Mamus, who wrote a letter called The Professional Tape Reader. And most everybody else was just bullish, just kept buying new lows. These guys that keep saying, oh, every time there's a new low, buy it. With whose money? How many times can you do that? But whatever, that's what they did. Louis Rukeyser on Wall Street Week on PBS was terrible. Every week, they not only were they bullish, they made fun of the one technical analyst they had on the show who was bearish. It was just ridiculous. Anyway, so I got into reminiscing a little bit about that bear market because that was my first really serious traded market, and so I wanted to go over what happened then. It may not happen again, who knows? But there are enough similarities at the beginning here to at least pay some attention to it. Just to summarize what I've said coming up to this point is we are maintaining a core bearish position, and we will trade these buy signals when they come off these indicators that are very oversold now, but we're not necessarily abandoning the bearish position. We'll just trade them around that. So this is a 73-74 bear market. The Dow fell from 1,080 to 570. S&P was not much of a thing at that time, which is a 47% decline. And it began with S&P making a new all-time high. The Dow making a new all-time high at 1080 in January of 73. And it sold off pretty sharply, just similar to what it's doing now. But it had these rallies, these bouncy rallies in there. And the bulls were, all over the place saying, buy the dips, buy the dips, buy the dips, and whatever. And eventually there was this rally and then this one. And that one really hurt the bears. And there's an old saying that nobody makes money in a bear market because the bulls keep losing money because they refuse to sell, and the bears get wiped out by the huge oversold rallies that take place. So that was the beginning of things, the first three things: the all-time high, the bouncy downtrend, and then the big reflex uptrend. But then it moved into a more serious situation. So the oil embargo started in October of 73, and that drove the market down sharply. But then it started to rally as people predicted the end of the embargo. The United States was negotiating with OPEC and what have you. These two little circles here, you can hardly see it, but they're actually gaps on the Dow. The Dow gapped up on early March of 1974 when there was a rumor that the embargo was going to be lifted, and it traded a little bit higher. And then over here on the day the embargo actually was lifted, the Dow gapped back down again. So for those of you who are into formations, that was actually an island reversal, which is a very negative pattern, and you don't usually see it in the indices. Well, that really set off things. So then we started to trade kind of wild, volatile but down. The big things that were occupied the news at the time were the three I's: inflation, interest rates, and impeachment. Well, we don't have impeachment right now, but we do have inflation and interest rates being high. And then in August, so the market kept moving lower on, really inflation. And then Nixon resigned in August, and that set off this complete collapse down here into the lows in early October of 1974, which then by that time Jerry Ford was president, and he came out with the WIN buttons. If you're old enough to remember WIN buttons, that WIN stands for Whip Inflation Now. And it was nothing more than a silly slogan, but the market did bottom. And so I guess you got to give Jerry some credit for that. You can see the market rallied a couple of times up to this trend line right here, went down in December, retested the bottom. That's a W bottom. We don't really have those anymore. Last time we had a serious W bottom was in 2002 bear market. Anyways, they rallied, and then eventually the next time it got back up here, it gapped over that resistance line, and that was the end of it. Bulls were back in charge. So that just summarizes the whole thing. But someone asked me, well, if we're repeating this, where are we now? So I think we're right there. In other words, the market back then topped in January, and by May, it was making new lows. multi-month lows, 12, 14-month lows. That's exactly what we're doing right now. And, I would say if we're really in an inflation-oriented bear market, and back then the market proved, or inflation proved, that it couldn't be brought under control. I mean, Nixon tried wage and price controls, which was really not too brilliant. And then Arthur Burns was chairman of the Fed, and he was so ineffective. He was really an academic. Every time he got on spoke, the market had a big down day that day. So that we don't have anymore because of the plunge protection teams. Anyways, that's my 2 cents on what's going on. So I mentioned this offer we have. If you go to our website, optionstrategist.com/MetaStock, you can get 50% off on our newsletters, or on our 14 topic home study course that we just recorded last year. So it's pretty fresh. There's also a special offer that for $99 you can get all 3 newsletters, and you don't have to take them concurrently. You can take them consecutively. So if you go to that website, you'll see those things are there. The PDF of this presentation is also there at that website. Jeff is recording this session, so the recording would come from MetaStock. Our newsletters, the Option Strategist is in its 31st year. That was a mistake. 31st year of publication. There's full track record of all 31 years is on our website. The Daily Strategist, which is basically just the same thing daily, its track record is on the website, as is Daily Volume Alerts, which is a situation where we not only trade all these systems that we talk about, all of these trade those systems, but we look for unusual volume there. So even though we've been doing well, especially in the last couple of years with these newsletters, there's no guarantee that's going to continue on into the future. We also have a YouTube channel. I invite you to subscribe to our YouTube channel. I record a market message every Monday morning. And then we have 2 other newsletters. One is if you're interested in selling out of the money puts, that's the Daily Put Writer. And then we have one that just deals with special situations. So that's our contact information. Again, that website for those offers is optionstrategist.com/MetaStock. And then if you're interested in our money management, there's a different website for that. So I didn't really look at any questions, Jeff. Are you looking at them?
Yeah, I did. And we did have one that I promised to ask about for you. Okay. So Bobby wanted to know, with the S&P 500, how does stock weightage skew the analysis that you get off the oscillator?
I missed that. How does what?
Okay, so with the S&P 500 stock weightage, does that skew the analysis that you get off of the oscillator you're using with it?
Well, I mean, all the oscillators based on price, our oscillator is based on volume, but that's volume on the New York Stock Exchange, not just the S&P 500. So the capitalization weighting of the index, is that what it's asking about? That has no bearing really on any of the indicators.
Perfect. And that website again is, I put it in the chat for everybody, optionstrategist.com/MetaStock. Thank you, Larry. I appreciate you spending some time with us.
All right, Jeff. Good to talk to you.
It was good. I really enjoyed it. So thanks for coming in.
Good. Thanks for having me.
Okay. All right. Very good. Let's go ahead and kind of just switch back a little bit real quick here. And I will go ahead and make myself the presenter again. Share my screen. And very quickly, this is actually the wrong side. We're going to talk a little bit about CMT as our sponsor today. CMT has been a great sponsor of ours. We appreciate it. They've been kind of sponsoring the event for a number of years now. I can see Oscar coming up. He's ready to go. And welcome, Oscar. CMTAssociation.org. Very, very good association. We really appreciate it. I did take the liberty of drawing a newsletter, or doing a drawing real quick. So Scott G., if your email address starts with Arius, you are the lucky winner of our next prize. I'm going to tell you what that is right now. Where'd it go? Okay. So what we're going to give you is the complete chart pattern trading systems from Silas Peters. It's a basically it's a 10 simple money-making chart patterns that he likes to use, low risk option trading strategies for any account size, lifetime access to his on-demand training courses that he puts together. And all of that's a $299 value. Scott, you don't need to do anything. We will reach out to you sometime this week or next week to get you information on collecting the prize. And our next presenter is Oscar. Oscar has been a presenter. He's been working with MetaStock for decades now. We love him. Scott, Greg, our marketing guy who usually runs a lot of these webinars with us, calls him a force of nature. But we love how well he does. He loves to get into the charts. He loves to look at the patterns, and he does a really, really good job. He does do an Omni camp in Vegas several times a year where he actually does training on how to trade the markets. And he is one of the most entertaining guys. So let's go ahead and bring him in here. How are you doing today, Oscar?
Very well, Jeff. How are you? And thank you. Thank you for having me.
Great. I'm doing awesome. Let me see. I'm going to make you the organizer so you can see questions. And then I'm going to make you the presenter so you can share your screen. So there we go.
Let's move this over here. And I can show my screen. Well, Jeff,
and I can see it.
Much appreciated. I thank you so much for having me. I really enjoy doing these chart segments, if you will, during your Trader Summit. And I would just like to offer a round of applause for the speakers before me. Fantastic work. I'm sure everybody here can learn something from each of the pros that you will see presented. And MetaStock, thank you guys for having me and putting up with my madness since, I don't know, I'm 18 years old, somewhere around there. So traders, thank you. Thank you for tuning in. In my last presentation, the MetaStock Trader Summit, prior to this, it was April, right? A month ago, or almost a month ago. And I did a presentation, and in that presentation, I promised you two things. One, I wouldn't sell you any software. And two, I would leave you with information that you can use to make money moving forward. And we went over a series of about 20 charts. And on each chart, I said, here's what you can do to hopefully make money moving forward. That cost you nothing. If you like what you see, you come hang out with me in my live trading room at livewithoscar.com, which is here. So I left those charts in the exact same order that they were in our last presentation. And I am just going to update those charts with you and see what happened, what the analysis called for. Was it correct? Was it incorrect? Not every piece of analysis is going to work out. But I will tell you that a chart is the most powerful tool that we have. And a good chart read is better than any system you can ever try to count on. You know, right now, as the world works, the gods get to get in these markets. And if they go down, they continue to buy more. And if they go lower, they average cost buy more. And in 10 years, when the market's higher, they've done their jobs. I don't think the people tuning in to this presentation at the moment have the wherewithal to do that, right? We're us mere mortals have to figure out where these markets are going to go basically on a daily basis to get this right. Now, there are systems that may get you there, systems that may not, but if you've got to tweak indicators or tweak any of the parameters, the system then changes and we've got to start experimenting all over again. I think the chart itself, though, I can prove, as I do in each one of my presentations, does all the work for you. The chart is all the news. It's traders' reaction to that news. It's any reports coming out from the government, ones that have come out already, ones that will be coming out, traders' reaction to such. It's all built into a chart, which has all the information we'll ever need. Reading the chart is the difference between knowing where markets will go next and guessing. And guessing is very expensive in this business. So if you've never met me before, my name is Oscar Carboni. My friends call me the Chart Whisperer. It's a title that's slightly embarrassing, but believe me, I've earned it. I am that guy. You'll see as I go through this presentation. So in my last presentation to you, I mentioned that we all have an issue, us day traders or even shorter term traders, us non-hedge fund managers. You're not a hedge fund manager. This is who you are. This piece of paper right here in front of you. Problems that we have is Wall Street purposely confuses the public on purpose, undoubtedly, with jargon like algorithms, hedge funds, percentage returns, the float, the EBITDA, insider buying, insider selling, you name it. They've got everything that they can talk about, which is certainly supposed to scare us into thinking Wall Street knows everything. Let's just give our money to them, and us lemmings could never get this right. I don't think that's true. There is a fire hose of financial information coming at us at all times. It's blasted at us 24 hours a day. It's impossible to decipher. The list of scary terms, as I just mentioned above, they're endless. They'll go on forever. Put on CNN, put on a TV station. They'll scare you as well. The internet can have posts from friends of yours that you can trust, but that information might be incorrect, even though you believe the person that put it out. If I post something, what if it's incorrect and you believe in me and you take that and run with the ball for trading? You find out that I didn't even get my information correct to begin with. That's a big problem we have on the internet. So I asked 2 questions in our last presentation. Is there a method of trading to eliminate the fire hose of news and fundamental information and make things crystal clear? Absolutely. Is there a way to spot the next move before it happens? Absolutely. The solution is the chart, and I promise you that's what it is. It's a visual look at all the news and all the reports and all the traders' reaction to such in one beautiful picture, and there's harmony in that picture. If you like this presentation, come join me at livewithoscar.com. I live in a free live trading room. No credit cards are required. Just come hang out with me. It's like my new YouTube pit, they called it, since the trading pits were closed down in 2006-07. And I opened one up online, and I've been working my trading pit since. So come join me. I do actually have one thing that I offer. I allow 3 people 4 times a year to come out to Las Vegas and spend time with me. It's a 5-night, 4-day live seminar where I teach them the Omni. The Omni is a brand of analysis that I'm not going to show you in this webinar because I wouldn't dare do that. I only show it to a few people at a time live in Las Vegas. And if you like what you see here, I promise you this, the analysis I'm about to show you is my 101 pre-kindergarten analysis that I can do with my eyes closed, sleeping on a cot with milk and cookies. But it's powerful. You come out to Vegas, I'll show you some great stuff. So let me do an illustration for you. You are looking at the S&P Daily Bar. Right here is the highest we've ever traded. That happened on the 4th of January. Now, when I tell you a chart can tell you everything that you need to know, and I'm a very good chart reader, I want you to watch a little piece of a video. I'll try not to bore you too much, but I want you to, if you don't mind, humor me for just a moment or two. I want you to watch 2 different clips of a video, because this video, on January 4th, I filmed it on the high. And I was kind of bullish all the way up here. On the high, I filmed the video to explain what happens next and why that would happen, both technically and fundamentally. And this happened right in the beginning of the year, and I told all my Omniacs, you need to know this information. So let me show you that the fundamentals come out in the charts first. So humor me with a piece of this video, and then we will attack these charts and see what we've got. So what we have here is a video that I had filmed the very night at the top where I just showed you, and I'm not sure why it just disappeared, but it did.
Good afternoon, good evening, and happy New Year, traders from across the globe. Welcome back to work. Trading in 2022. It's going to be a busy year. Rates are going to move. It's going to be a long year of a lot of work, kids. So get ready. But boy, am I glad to be back. I hope you guys are glad to see me, but I am glad to be here in front of you. This video, first video in 2022, coming at you on a Tuesday after trading Wednesday, Jan 5th, 2022.
All right, so sorry about that. Sorry about that. So we know for sure that that video was filmed on that day, right? No questions asked there. So let's just go back for a moment. Kids, I have no idea why my screen is going blank, but I will get back to this in just a moment for you. So I just wanted to show you something else that we have going on. So this is proof. We filmed that video right in the beginning of the year when the market made the highs. So now I'm going to give you the actual explanation. What did happen here? Let's go into theater mode if we can, so it doesn't get too big on us. It's a full screen. So I'm going to take you to another spot in this video, and it's just going to show you that after I read the charts, here's what I depicted from the charts, and here's the fundamental to prove that the charts always show you what's going to happen first. So we were around here. Listen to this, if you don't mind.
We've got a lot of work ahead of us, traders. What I think will happen here, and I'll show you some charts in a moment, is this. Not what I think will happen. This is the inherent relationship between markets, real estate, and interest rates. They are getting ready to raise rates in the next 3 months. The market is noticing already that bonds are tanking. When bonds go down, interest rates go up. Whether you know it or not, we do not need the Fed to raise or lower rates. Traders can move the bond price and make rates move. Now, the Fed's been buying bonds forever to keep the price of bonds up, keeping rates down, and traders had no chance of fighting against the Fed. Well, the Fed is backing off on their bond buying, eventually stopping the bond buying, and then maybe raising rates, which makes bonds go lower. Now, if the street, the banks, all the traders in the world decide to just sell bonds, the rate will go up automatically, whether or not Jerome Powell flips the trigger or not. That's how this works. If bonds go down in price, the bond futures interest rates go up. Now, of course, the Fed raises and lowers rates, and how they keep them in check is by either buying bonds or selling bonds to make sure that the Fed rate doesn't move too much. But if they're not buying bonds, which means they're not selling them, but they're no longer buying as many, if the street sells or then the Fed's buying, rates, bonds will go down, rates will go up, and I'll show you some charts to prove that. Now, if you are buying real estate, here's good news. Rates are really cheap. If they raise rates, it doesn't matter. They're going up a teeny bit. It means nothing to you except for this. It will be, and we'll discuss this again when they get closer to raising rates. When they go to raise rates, this is called the get off the couch segment of interest rate movement. That is any company or any individuals, let's forget companies, individuals, you and your wife, husband, whoever, you're sitting there on the couch and you decided we should buy a house, interest rates haven't moved in so long, that's not a worry. The price of the house fluctuates a bit. We can kind of afford it, but there's no urgency to go out and get it. And then suddenly you hear that they're going to raise rates. What do? You get off the couch and you go buy the house before they raise rates and your mortgage goes up. Now let's go to companies. Big corporation, they're looking at buying a big property. If the rate moves a little, the rate moves a lot. So if they are going to raise rates, it buoys real estate. It makes it go up. Well, at the same time, it makes the stock market have to adjust down in price. Why would that be? If the stock market's made up of corporations, big, huge ones, those corporations sell forward corporate bonds, monthly bonds, quarterly bonds. So you give money to a big company, Goldman Sachs. They use that money for a month to pay their monthly overhead, run their business, and they promise you X amount of interest of return at the end of the month. Those are monthly bonds. Those are how corporate bonds are sold. If at the end of the month of the quarter they owe you 5% interest, great, you get your 5% interest. That's why you would buy a corporate bond instead of a U.S. bond that has low interest. Well, if U.S. bond interest goes up, the 10-year, 30-year, the interest that you get if you buy a bond goes up, well, these companies then have to offer more interest for their corporate bonds. That means they're paying more money for the same amount of money, which means their stock in price and must adjust. In layman's terms, I hope I didn't confuse you, but that's what will happen. When they start to raise rates, real estate will go up because they don't give it a boost, and the stock market will have to adjust down a little bit. So that will come in the future. We'll discuss it again. Get ready for that long term, short term.
Traders, that was filmed on this evening, right here at the high. Using technical analysis, told me start watching out now for the downside. Since that video and the explanation of why we would go down, and of course me having a chart to prove everything about it, the market has actually started cracking. And you've seen this very chart in my last video. So I left you off in my last video, and I said, look, this is bad juju right here. 90-bar moving average, the 200-bar moving average coming together. Algorithms, they have been using the 90-bar moving average for their algorithm purchases like crazy, and you can see it if you just look at the chart. So I went through this whole chart with you, and I explained that this is what you could use going forward in the future Next couple of weeks, this is me speaking to you right at the end of the last presentation, and the chart looked just like this. And I said, traders, I'm going to put my neck on the line. I'll show you this is what should happen next. The market should crack, and you can make money selling the S&P. Now let's go update this chart and see where we are as of this moment. Today is 5/14? 16? Yes, 5/16. Let's go see where we are. Wow, look at that. From the break of the 90 and the 200 when they came together, look at how it cracked all the way down. A bit of information that may have helped you, being that I gave it to you on this day of the red circle, the market would go lower. So, all right, good guess, Oscar. Let's continue looking at everything else and see if these are guesses or not. The Russell 2000. It all began here, traders, the very same chart right up till this day in my last presentation to you. I have not updated it since that day. I showed you that everything began with the Russell 2000. It started with the first major head and shoulders formation. Left shoulder, head, right shoulder. Got below the 90-bar moving average, which is this line right here, and dropped into a flag. And then I said, wow, even crazier. It's a bear flag. And a flag within a flag, meaning this whole thing right here is a big bear flag. And there's a little bear flag inside of the big one. And we're below the 90-bar moving average, which for whatever reason, this is the moment that Wall Street was keying off the 90-bar moving average. And I said, using technical analysis, you should break down to 1698. That is my projection. You know where we are at the moment? At 20 even, 1699. Okay, so we should, excuse me, at 1899, or that's 19. I can't even read it. Well, like 1900 points. I say it's going to 1698 based on my crazy analysis. The gentleman before me mentioned that in his day, they used to make fun of analysts. Well, when I started, I was a nut. I was a voodoo expert. That's why it says voodoo right here. The leader proves, the leader is, at this moment in time, the Russell 2000, the leader proves that this voodoo actually works. Now, how do I know? Let's update this chart and see what happened from the last video I was doing for you, my last presentation. Where are we now? Can you read these charts and see the future? So my projection on YouTube and in front of you guys is 1698. And today we will find out what happened so far. And that would be a 16 there. There we go. So this updates the chart as of today. Apply, and let's see what, look at that. You know what the low is right here, kids, on this green bar? You know what this low price is? 1698.30. Sorry, I didn't get it exactly right. That is how to use technical analysis. I did this for you before the event took place. I've got no crystal ball. I am telling you that if you read these charts properly, they give you all the information you could possibly need. Do you know what happened to the Russell since it hit 1698.30? It has bounced 150 points already. All right, so let's go update the next chart. In the last presentation, and this is that presentation. These are all the charts that we looked at. We're going to go over them all once again. So the SPX, I believe we've seen this one already. Let's go to the next one we have for you, right down the line. Another version of the S&P, but if you remember on this chart, some of you were here to see this. If not, please go back and watch the last MetaStock Traders Summit around April 24th, 3rd, 2nd, right around there. And I had the chart before your eyes, and I said this is a sell short moment right here because algorithms are just smashing away at this 90-bar moving average. I left you with the notion that you can sell this thing, and if we update it, it'll show you what we've done so far. And don't worry, I've got some new stuff for you as well. Let's just go see what the old stuff did. What we write about what we called a month ago, and will we be right this next week? Yes on both, because that's how analysis works. If you read it properly, you don't get it wrong. Trading it correctly, that's another story. Sometimes we get beat up, or we can call it using analysis like a banshee. Look at what happened after I showed you the sell short point. Crack, down, bear flag, crack, further. Good information, right? Just driven right off the chart. And anyone can do this, I promise you. This is really simple, abstract analysis I'm showing you, but it's very powerful. So let's go to the next chart. Let's see where we are. We've done the first three. Let's go here. Now we had NASDAQ. And on this NASDAQ chart, they were keying off of the 150 bar moving average, they being Wall Street. And it's very easy to figure out what algorithms are being used on Wall Street. At this moment in time, when I did this presentation for you, I showed you that they are keying off of the 150 bar moving average. In NASDAQ, they use different ones and all sorts of algorithms, but at the moment in time, 150. And it cracks from the 150, goes into a bear flag. And then I broke out one of my big gun averages and said this is a serious danger zone. If you get below this average, you get below the stop buildup, the danger zone. Below this red line is stops that will build, and you will take those stops out if you get below this average. Why? Because if the average was out here a little further, as it was before this presentation, you were able to hold it each time you got underneath it. The average sort of looked like this, and it held each one of those tests. So let's make this look like the average so everything looks in sync. Boom. So being that it keeps holding here, my work is, hey, if it holds there, repetitive pattern. If not, you've got to see what's coming next. So I did a projection of the flag and said we should crack through the danger zone. And let's go update and see if not only the 150 helped, but the big gun average helped, and did the danger zone help. And we are at 516. So again, I'm just illustrating how well technical analysis works. You can go out and buy any system you want, but if you got a good pair of eyes, you got the whole system right here. Right between those eyes of yours, where your brain resides, that's where your system should be. So you broke through the average, and you got through the danger zone and started to spiral. As expected, and can be calculated based on the formations that were set before it. So there is a pattern here. The pattern is technical analysis is a very, very strong tool. If used properly, it is a crystal ball. So let's go look at whatever we had next on that presentation. Oh, I showed you that not only did the NASDAQ have an ugly look to it, it had more reason behind it. A, huge head and shoulders huge head and shoulders formed on the NASDAQ. You can see left of the head, which is your shoulder. Then the head, right shoulder. The circles are kind of meaningless. It's the formations on the chart that matter more. And then there's something I call an Oscarism called the head test. And if you fail the head test, more downside ensues. So we failed at the head test, and our averages, the 50 and the 200, came together, clashed together, and down into a flag we go. I make a projection, and let's go look and see just how well the projection works out. And I'm sorry to say I made the projection. The analysis pointed in a direction. I said, thank you, analysis, and followed that direction, and it was correct. I have no special powers. I'm just following the chart. And look at what happened. As expected and projected. This action, meaning the big head and shoulders, the failed head test, the two averages coming together, then into a bear flag. There's nothing else you need to know if you're trying to figure out which way the market wants to go next. All the signs are right there. Let's go see what else we had on that last MetaStock presentation. Look at this one. The transportation average. Now, this one I told you, if you get back to the 90, sell it. That's how it works. Expect the market to get to the 90 and break back down. It's been using it perfectly. So Dow Jones Transportation Average, my advice to you is if you hit the 90 bar moving average again in our last presentation, you can sell it. Well, what happened since this? We had one arrow, two arrows, right? We had two tests where it failed. What happened next? Let's go look. Me, I find this entertaining. Great chart nerd stuff going on here. Because it is as easy as I'm making it look to you. Look what happened. The market went down after hitting here. Down, down, down. Came back up. Where did it stop at? Exactly where it was supposed to. Where you can tell Wall Street is using the 90 bar moving average as an algorithm. And it proceeded to crack right down here. Now, none of this existed, right? How could this possibly work out? You had none of these bars, and somehow when you get back to the average, it stops cold and drops. Remember, this is what it looked like. On 421, when I did the analysis for my presentation, this is exactly where the charts were. Okay, 1, 2, you only hit it twice. Now we go back to an update. And we'll see where it is now. Boom, it literally went back up, hit it again for a third time where you can then put your arrow, and down it went. You see, this stuff really does work if you know how to read it, and then, of course, you've got to execute. Big problem that people have is they overanalyze. They think about the analysis too many times. They give themselves analysis paralysis after coming up with a good piece of analysis. What most traders find themselves doing is they wait for the market to get close to that spot, and right before they put the orders in, what do? Pull up another chart. While it's busy and they're nervous and the market's going crazy, they pull up the chart then, and they go, let's see if I'm right. Was I right when I was quiet last night? And it was a calm moment, and I did my analysis, and it came out looking like I should be short right here. And then you wait for the moment to strike. You pull that chart back up and scare yourself. That's where people go wrong all the time. Once you've done your analysis, you put that chart away, and you execute your trading plan. So let's see what else we had after the transportation average. We went back to the Russell 2000. That was another chart to show that the Russell was doing the 90-bar moving average. That's what's in vogue, into a flag. I could project what will happen after that flag, and we already know what happened with the Russell. It went right to the projection. Now, I didn't make up the projection. I didn't sit and ponder. I didn't contemplate. I didn't go do yoga for 4 hours and come up with 1698. I projected off this chart right here, and it told me we would trade down to 1698. Now, I don't know that that's bottom by any means, and I think I'm going to show you a few charts at the end of review, which is reviewing the charts we did in our last presentation, seeing how they worked out. I've got a few new charts, what I think will keep you in line on what comes next. But for now, it broke down seriously after the flag and bounced. The leader proves that this voodoo actually works. These are projections I gave out, kids, not predictions. I don't predict. That's for crazy people. I give out projections based on sound technical analysis and ask anybody who follows me those projections, thank you, gods of trading, have worked out really well over the years when I produce them. So let's go and look at something else. In the list, we then go to crude oil. So crude oil above $75 makes the stock market have to start to go down. If you don't believe me, crude oil breaks $75 for the first time right about here, but it was short-lived. It came right down. And I started telling my Omniacs, if we break $75 on the upside, the stock market will crack. It cannot handle crude above 75. We get back above 75 on this day. Now, here's an interesting thing about this day. This is the same day that stock market topped out, right when crude oil passed. If you look at the date right here, 104, 105 is when the stock market topped out. Look what date I am on right now. 103, 104, date 103, 104, 105. As I've professed to my traders using technical analysis, you get crude above 75, the top of the stock market comes. Crude hit 75 on the same day the S&P puts its top in. So it's a very important market to our economy and to our stock market. Crude oil is. Now crude's at $110 a barrel, but here's exactly where the chart was in our last presentation. And the purpose of this was to show you that unlike the other markets I was showing you that were below the 90-bar moving average, below the 200-bar moving average, crude is above it, and traders and fund managers are keying off of it. So now we're going to update the crude chart, and it shows you that it's putting more pressure on our markets. Do not fall in love with the upside of the stock market is the theme of this video. You'll see at the end of it. But do not fall in love with the upside of the stock market, especially with something like crude. doing this. It's about to break out of a huge, or it did as of today, breaking out of a huge pennant. Crude's got some serious upside coming if this continues, and that's going to put pressure on our stock market along with raising interest rates. But that is the purpose of raising rates. They want the stock market to come down. Nobody needs crude to go higher, but raising rates is purposely to knock down the lofty mountain of the stock market. So what comes next after crude in our last presentation was T-bonds. Now, T-bonds, as explained in that video earlier, that little clip, if interest rates go up, it's when T-bonds are going down. This is considered a little teeter-totter or a seesaw out in the park. Bonds down, interest rates up. That's the way this works. Bonds have been going down from the top of this red line. You can see downward pattern. Bad news when the 200 bar and the 100 bar moving averages crossed, and the market continued. And I professed that this movement forces the stock market lower. But on the 4th of January, before it started to go lower, I said in a video, this is what happens, right? This movement will force the stock market lower. And I mentioned corporate bonds. Corporate bonds, they added the costs, which are higher interest rate and inflation, forces stock market prices to adjust down lower. Now, I gave the video, that video presentation in the beginning of this presentation on January 4th. I did the presentation that had this very same chart in it for you on April 24th, 23rd, somewhere around there. So what I said in Jan, based on the charts, is happening. Now we come to April. I do a webinar for you guys, and I tell you, look, it's doing exactly what the charts said it would do. So don't be confused by the movement out there. We know what it's doing. We're well aware. Trading, it's another story. I'll always say that, but we're well aware of this movement and why it's going. So being that we've been right so far, let's update this chart and see if bonds going down makes the stock market go down with it, which is what happens as interest rates go up. And this is 516, which brings us to today. And we apply, and lo and behold, we have dropped from this low I was pointing to all the way to that low, which makes interest rates go up and makes the stock market need to adjust. Now, this is not 2008, and we are not looking for a crash. I am looking for an adjustment, and I've got year-end targets that are higher, not lower, and they are still valid as of this video. Will they stay valid? That depends on how low the market corrects down to. But my upward targets for the end of the year remain valid as of this video. But 30-year bonds moving down is certainly not going to help the market move up, not the stock market. And we go to the next one after bonds. We had the US dollar. Interesting. Now, in my last video, and I think you're finding this to be true, in my last presentation, I said the US dollar, we see it, we hear about it, but we don't feel inflation unless you go to the gas pump. Why? Because the US dollar is just on a tearing rally, which gives you more buying power as inflation heats up. Imagine you using a currency in any other part of this world right now, from British pounds to euros to anything else. Our dollar's going up. Those other currencies are going down. Those people are feeling inflation. We're getting it padded by the dollar. Now, it's not penny for penny, but a lot better than the dollar going down while inflation's going up. Mentioned it in my last video that the dollar rallying will help keep the price, or help keep pace with inflation. Here's where the dollar was. I made a projection after the bull flag breakout, and let's go see what the dollar helping us by going higher, padding our inflation somewhat. Now, you might be yelling at the screen right now, but imagine being in another country. People think about this a little more abstract. Americans are being blessed right now. Look at the difference. The dollar just continues to rally. This is the addition of movement since my last presentation to you. It has now broken out of this channel, continued higher. When this goes higher, you are giving the U.S. buying power compared to other countries because our currency is getting stronger. Now, not my fault, kids. You can get mad at me if you want. My currency is getting stronger than yours. I'm not in control of rates. I just do analysis. You know what I mean? I'm just doing the charts. But this is what's happening right now, and this is helping pad our dollar. And believe it or not, the Fed knows, and the Fed's loving this. Now, I don't know if you know why the dollar would be going up, and if you think the Fed's falsifying things. It's not the Fed doing this. Let's call you, everybody out there. You are in charge of a sovereign fund of another country, billions and trillions of dollars. You need to move that money into something so that your country doesn't lose its wealth. Well, you've got to buy US dollars with your currency if you want to buy US interest rates or US stocks or US bonds or US real estate, but mostly to gain those US rising interest rates. You've got to flip your euros into dollars. You've got to flip your British pounds into dollars, your Canadian dollars into dollars. You've got to flip your currency into a US dollar, meaning you've got to sell your currency and buy US dollars to participate in our higher interest rates. That plus the Fed is helping to pad inflation, just as I told you guys a month ago. It is actually happening before our eyes. The charts tell you what to expect. You just got to know how to read them. All right, so then I said, listen, kids, you cannot even escape. The cryptocurrency market is not immune to this crazy head and shoulders pattern that's out there. The algorithms being fired off of at certain averages. Ethereum, the 200 ball moving average seems to be what they're firing off of. Fund managers come in and buy it here. They come in and sell it when it gets under here. They come in and sell it when it gets back under here. Now we've got a bear flag. Ethereum's below the 200, a bear flag is built. This is exactly where this chart was at our last presentation. And now we will update it for today and see what happened. Is crypto immune to the charts telling you when the market's going to go down? Absolutely not. Is crypto immune to raising interest rates? Absolutely not. Look what happened, kids. Out of the flag and down it went. As projected, because we do analysis and we don't guess at these things. So crypto's not immune. I showed you that in Ethereum. And then in my last presentation, I showed you that in Bitcoin as well. Same sort of look, bear flags, fails at the 200 ball moving average, huge head and shoulders. You can't hide in Bitcoin either, kids. This was my advice to you in my last video or my last presentation. So let's see, could you have hidden in Bitcoin? I think we know the answer to that. Absolutely not. That would have hurt you probably more than the S&P. In fact, it did because I'm long a lot of it, but for long term. So we won't discuss that at the moment. Look at what happened. I had those arrows to point going lower, and lower it did go. So these formations work in crypto just as they work in any of the charts. And they work on the winning side just as well as on the calling it right side and as well as on the losing side if you call it wrong. But if you call it right, they are magical, I promise you. So what else did we look at? We looked at, once again, I did this 3 times in this video for a reason. Please understand the power of technical analysis. If anyone tells you that it doesn't work or you need some kind of crazy program and it doesn't work without their crazy parameters, maybe they're right for their approach. But I am telling you now, if you learn how to read these charts with me, this is everything you'll ever need. So again, we see our projection. We know that it projected down to 1698. This big flag projects down to 1698, and I gave out that projection on YouTube and in my MetaStock presentation. And let's go take a look. As we know, we got blessed, and it went exactly to our presentation. To our projection. 1698.30 was the low tick on this green bar right here. That's not sick. I mean, come on, kids. Who can do that, right? You can't just come up with this craziness in your brain. No one's got that kind of power. But the chart, the chart's got it all built in. So let's move forward. Check this out. Now, Apple, another type of average, another type of formation, another type of call. This is exactly what your chart looked like. Please go back and review at the last MetaStock seminar, the Trader Summit. Take a look at Apple. I left you with this chart, with this circle and the words boom, and told you can sell Apple. That's one of the things you can do moving forward. So were we right for calling a short in Apple based on that spot right there? We're going to find out right now. Dear Lord, were we not, is that sick? Now, here's what's really interesting. If you catch, remember, I had this big channel here, and I left this green circle and said we should be heading towards that. Boom, 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 boom. You went even lower. Now, how much power do you see in this technical analysis nonsense, or voodoo, if you will? It's not nonsense. It's not voodoo. It is the strongest. You know, I've been involved in this business since 1982 as a programmer, as a trader in real time, in the trading pits, off the floor, on the floor, and as an experimenting technical analyst. And I have been through every program you can think of. I helped TradeStation, PFS First Choice, all the stuff in the beginning, MetaStock. If it was out there, I helped them build the software, develop it, build the tools, because I was a nerd back in the 80s. I was into computers in the 80s. Go figure that out. You go look at the dates of the 80s when I was in computers, and you'll recognize I was a nut about this. So I've learned how to read charts using technology, and I've also learned that most of the technology is not all that necessary. That's what, after all the hard work I put in, what I learned is simple is so much better than complicated. We don't need to be scientists. We need to be artists. This is a fine art, not a science. The scientists, they get too wrapped up in things and parameters, and they think they're right. The chart is always right. The market is always right. Rule number one. Rule number two, if you think the market is wrong, please refer to rule number one. The market is always right. So you should be able to call it correctly if you just listen. The chart whisperer, you got to listen. So let's go to the next stock that we looked at, or chart, I should say, that we looked at. So where did we just go? We went to Apple. Oh, yes, we did NVIDIA with the knock-knock formation. Remember that, kids? If you were here, knock-knock. And I said, listen, you cannot just keep knocking on the door in this industry this many times without it opening. It failed at the 90-ball moving average, which for whatever reason, the street back in April was using that as their trigger. It drops into a bear flag, and it knocked for the 5th time on this red line down here. Knock one, right? Knock two, it just keeps knocking. And this is one of my, Oscarism type techniques. I call it the knock-knock technique. Knock two, knock three, knock four. 5th knock creates a bear flag. Boom, I leave you with that and tell you, you can sell short now NVIDIA for the next few weeks. And let's go see what NVIDIA did. All of this was in my last presentation to you, kids. We're just finding out if analysis can be counted on or if I'm crazy. And look what happened after the boom. Down this bad boy went. Boom, boom, boom. So you see this stuff works really, really well. You just got to know how to control it. You got to know how to read the charts, control your own emotions. So nice chart, NVIDIA, beautiful movement. It worked out as we thought it would. Let's go see what else we had on that menu. Amazon. Oh, yes. Remember we left off with Amazon breaking the 200-ball moving average. And what I said is you can now use the 200-ball moving average on Amazon going forward. It gets anywhere near that line, or what I was saying on that day is it's cracked that line. It's now ready to go down. It failed at the 200-ball moving average. It's ready to go down. So if that information was correct, it's purely on charts, because how would I know anything about Amazon except for it's a great company, right? So my non-crystal ball, which is the wonderful chart that is actually a crystal ball, told us that, yeah, you sure the heck could have sold it at the 200. Look at the crack. Then once it gets through support, it not only gets through support, it gaps lower at the support line. And down you go. Technical analysis works very well, kids. So what else is out there? We didn't even finish. Forget about the new charts I want to show you. We didn't even get through the last webinar. Yes. Remember I showed you Zoom 55-ball moving average, and I told you the last signal was 126.44. Just wait the next one, because that 126.44, which is right here, it worked perfectly. Boom, right? It was the right trade. So I showed you that if you're going to mess with Zoom, use the 55-ball moving average on it. Look at how well it's worked in the past. All right, kids, so if that's going to work, await the next signal. And if you get near that 55-ball moving average, you can sell it. We project down to at least 99.30. But wait for the signal. You got to hit that moving average first, or at least get near it, right? Let's see what happened. I have not seen this chart since I presented it to you. I don't know what happened. I'm assuming we got down there. We'll find out right now. Never really seen many of these charts, the physical ones. I've only looked at other versions. Look at that. So it did get there, and then it cracked, and it got lower than 99. It got down to, well, we need this. It got down to, what's the low? Got down to 79. Forget about 99.30, but go technical analysis, right? This stuff is fantastic. Let's see what else we have. We did that. We did Zoom. So check this out. The Dow Jones Industrial Average in that last presentation. Here's where the chart was. We talked about failure now at the 200 ball moving average, as well as the head and shoulders, and failure at the head test of the head and shoulders would create a downdraft, and you can probably be short on the downside. And of course, like everything else we looked at, we know this cracked. Let's just go see how hard it cracked. So look at the action that took place since that circle. Boom, 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 all the way down as expected. Why? Well, you've got a head and shoulders, which I can easily calculate how far the market is supposed to go, especially after the failed head test, which is what I did. And it's one of the reasons why we had 1698 in the Russell. Its head and shoulders projected the best. It was basically the most symmetrical. And that's the one I used for my projection. Another head and shoulders, not as symmetrical, so I didn't bother using that for projection. But believe me, the projections work. What else did we look at in our last video? Oh, we're up to new charts now. Hooray. So here's the theme, kids. What am I going to leave you with going forward? This is for next week now. With this week leading into next. The last presentation, every chart that I showed you gave you some kind of information that may have helped, meaning the charts worked. Again, I've got no special powers. I actually do, is it here? I do actually have a crystal ball, but it's really little and it doesn't really tell me anything. But the charts, they are a crystal ball. So here's my advice to you. Do not fall in love with the upside. Why? Here's what we've got lately. The E-mini S&P bounced off of the support line. Now, this support line is being supported, if you will, with the proof of look at the times that it holds there, right? Boom, it stops at the top, it stops at the top. What does it do? It drops to the bottom. So it goes from the bottom to the top, down to the bottom, to the top, to the bottom. Guess what you can't fall in love with here, kids? If I were you, I would not fall in love with the upside. Because where are we going? The very, very likelihood is that we're going here, and then we're going to run into trouble. So markets do not go straight up, just like they do not go straight down. But in the end, even if it takes a few bars, we expect this to peter out somewhere when it gets up here. Do not fall in love with the upside. You are looking at E-mini S&P. All we did was bounce off support here, kids. Okay? There's no averages involved. There's none of that right now. I can tell you this, algorithms lately, you can see that they're running on momentum and not expected algorithm average spots. They're running on momentum. My traders have watched me the last couple of days jump in and out of our trades as the momentum picks up, right at an omni level. We duck in, we duck out, and it seems to be turnaround moments because they don't have all the averages right now. The averages are way above the market. See, look, averages are way above the market right now, right? So this one, they were using this, the 50. Remember, we looked at it a bunch of times. You can't even go down to a 20 right now. Watch, they're using no averages. Averages right now are not going to help you. So you could go as low as a 20 average and still find out that that ain't helping anybody at the moment. It's in no man's land. But look where it's getting up to, kids. It's getting up to that average, right? And it's getting to the top of this channel. I kid you not, this stuff, it works so well. But what else are we looking at for this week moving forward? What will help you? Russell 2000, exactly the same situation. Kids, do not fall in love with the upside of the Russ. Yes, it's rallying, but if you'll recognize, it's stuck in a channel from the low to the high. Back down just about to the low. Boom, up to the high. Down to the low, 3 tests. Maybe it gets back to the high. Don't fall in love with it, okay? Omni gave us a buyer of dips trade this morning. We pulled a bunch of points out, thank you, Omni, and stopped because buying dips is scary in this environment. As you can see, we are in a channel. That channel's pointing lower, but I follow whatever the Omni says, and I just want you to not get too happy if we rally for a couple of days. And here's the last thing that I remember spotting today that I'd like to show you that hopefully you could make money on. Look at Amazon. Not only did Amazon bounce off of this channel, just like everything else I've shown you has been in lately, but look at the bigger channel, this big monstrous blue channel. This one up here, which the bottom is here. Insanity, right? That is what's going on right now. And if you ask me, we just bounced off the bottom of it right here. 2 trend lines, massive trend lines come together, right? The one that keeps this channel in check, the bottom one, boom, you ran into that, and you ran into this big, longer term support channel. So that, of course, is going to get the attention of Wall Street, and it got their attention. But I am telling you right now, do not fall in love with the upside, because if you do, I think you're going to find out that it's only going to go up in between interest rate rises. Even if it does, when they raise rates, it's going right back down until we reach equilibrium on our rate rises. Traders, this is what I wanted to show you. I hope this will help you moving forward. I really hope that you'll join us, and if I can find it, I'll show it to you. I hope that you decide to join us at livewithoscar.com. You can easily find me. Just go to livewithoscar.com, and it'll look a lot like this site right here, because that's the site. So go there, log in. It's a free membership. It'll ask you for no information at all. So if you hit sign up, you want a membership, this is all it's going to ask you for. No credit cards, no nonsense. Do that, and you'll end up right here. Once you log in, and you log in with your username and password, you will end up at the Omni page, where you can see the trades I'm doing, the chart below that, reasoning why. Most important, though, we want you to end up here in the chat room. So you go to Chat Live with Oscar, click right here, and that will literally put you in a live trading room with me, and we can share these thoughts together, and I can show you much more sophisticated technical analysis that I use when I come up with my day trades each day. And, of course, at livewithoscar.com, you will find me. And if you'd really like to learn how to get this right, you will join me at my next session. I believe we've come up with a date. That date is September. And not with a typo. Let's make that a cap there. September 8th is the weekend. You come in on a Thursday, and we're together. We get together on the 9th, 10th, 11th, and 12th. And we learn the Omni together. You would go to Omni Bootcamp and fill out that application. I'm only going to accept 3 of you. Everyone else is going to be turned away. Barring that, kids, I've got nothing to sell you. I've got nothing else to do except for hope that you use this information that I just showed you moving forward, and know that, let's go back here. Know that, let's just go back to the first one. Technical analysis really, really works well. Used properly, it's the only roadmap you will ever need. Traders, thank you for tuning in. I hope this has helped you in some way.
All right, Oscar. Good job. We loved it.
I just thought it was a little fun.
Dan said that you should talk about, or somebody named Dan said you should mention your 4-hour class, 4-hour seminar.
So at some point, a few months back, MetaStock had asked me to come up with a 4-hour seminar that would be exclusive only for viewers that purposely came to watch that seminar. And I decided to add some interesting techniques and tips in that seminar that I normally am a little hesitant to give away. But I gave away some really good tips and tricks. In fact, one of my staff said to me, Oscar, seriously, some of the stuff you said in that seminar or webinar, I should call it, I didn't expect you to give out. Well, it turns out I did a pretty good webinar, MetaStock, and you can purchase that from them if you'd like. It's what I showed you here, much more in depth, giving you the know-how to do some of the techniques yourself. So
I'm ready to talk about that. I will talk about that.
I wasn't planning on selling anything, guys. My apologies. I don't sell anything. I do my analysis and I leave. But if
I
you
have
want
a couple quick questions.
Oscar.com.
If you could do a rapid fire question or two, Oscar.
Sure. What do you got?
Question what came in from Amit. Why does the dollar go higher as inflation is going higher?
Because many countries and big hedge funds, if you will, that have money that are in euros and other currencies, they have to repatriate those currencies into US dollars in order to capture our raising interest rates. So sovereign funds from other countries are coming in. They have to purchase the dollar if they want to participate in any of our circus going on here, being real estate, interest rates, you name it. If you're not from this country, you've got to buy dollars, and that's what's driving the force. Here's the second thing. If you own a huge amount of cash in any other currency and you haven't thought about flipping it into dollars, you have a really bad financial advisor. So they have no choice. They've got to flip their money into dollars right now, as dollar is king.
Last question. Fitz wants to know if you see a peak in oil or in energy.
Sorry to say, I do not see a peak in oil yet. We did look at this chart. Let me just go back to it because it's a kind of descriptive of what's likely coming next. Now, of course, we know that this crude is extremely news-driven at the moment. Get rid of the news and look at the chart. We should end up probably testing almost the highs here. Based upon this formation, you should end up somewhere up here where I'm drawing this line. Using pure technical analysis based on what I see, of course, it is the fundamentals, just visual fundamentals. You should end up there at some point testing that high, or at least getting close to it. Now remember, anything over $75 in crude is detrimental to the stock market. So if we're expecting this, you know you got to expect more pain in the stock market. So that's my opinion about crude oil right now.
And then help me pick out my next winner. Give me a number between 1 and 8,054.
A number between 1 and 8,054. 4,022.
Okay. I will thank you, Oscar. A couple comments. That's great. A couple comments. Great job. The site is great. Oscar is the real deal. Mike wants to say. Thanks, Oscar. Thanks for joining. Sandra says she's going to join. So she's look for in the chat room.
You know what? What else? No, I'm going to give you one more thing. Anybody who's watching this right now, I will give you a free subscription to follow my trade recommendations for the next few weeks. Will cost you nothing. You'll see exactly what the Omni does. Put the trades in the simulator and watch what I can do. Everyone who's watching now will get a free membership. You've got to either contact me at livewithoscar.com or go to, where I showed you Omni Bootcamp. And Jeff, of course, will give us your names, and I'll make sure that each and every one of you get the free offer.
All right. Thank you very much. Appreciate it, Oscar.
Thank you for having me. Love these. Call me anytime. Good luck out there, trading.
Thanks, Oscar. He does a good job. All right. So as promised, let me go ahead and turn on the presentation back to me real quick. To me. Okay. Yes. And then you should see this. So the masterclass he was talking about was basically a 4-hour class that we recorded back in November. And the actual name of the class was Trend Lines and Technical Formations, the Mystique Removed. If you enjoyed what you watched at today, I would recommend this masterclass. He spent hours and hours and hours. I remember we were recording it on a Saturday, showing about how to exactly draw up a chart, how to do the trend lines, the support and resistance, the different technical formations. Fantastic, fantastic class. The feedback that we had from this particular class was amazing. And again, we recorded it just back in November. And back then, the normal price on that was $499 for access to the class. We're going to do a conference special where we're going to offer it to you at $349. You can give us a call. We'll help you get set up for it. It's instant access. You'll be able to start going through it right away, or maybe wait till another day where you haven't been watching 8 hours of technical instruction, but whenever. It'll be available for you on demand whenever you're ready for it. So you can give us a call at 800-882-3040. You can chat online with one of our reps here at metastock.com/sales-chat, or you can go to metastock.com/conf-promo to get that. I did promise to find a winner. I know we are running a little bit late, Tyler, and I promise you can go as well as long as you want. So, but let me grab our next winner for the next contest. The number that we had was 4,000. Let me go ahead and go down here. Okay. And our next winner is Lester H. Lester H, you also have the same email address as your first name. If that describes you, you just won a prize. So let me tell you what you won real quick. I'm running out of the ability to talk, which is a commodity. Yes. So let me go ahead and go look right here. I'll tell you kind of what the prize that you're going to get is. We are going to give you an ebook and course that was created by Jeff Tompkins. It was called How to Fix Losing Option Trades. And so one of the things that he does is if you're in a trade that's bad, well, here, I'll just read the description to you real quick. Discover some of the most popular option strategies and how to fix trades when things don't go as planned. Jeff Tompkins will share some of his most prized adjustment tricks to fix bad option trades. He'll even demonstrate how you can take a losing trade, turn it around into a big winner. This is a must-have information from today's market. So congratulations. I will be contacting you, and we will be kind of arranging to get that prize for you. So there you go. So let's go ahead and talk about one of our sponsors. We're going to do CMT for a reason. You're going to find out in just a minute. Wanted to say thank you for CMT for supporting the Traders Summits that we do and the Traders Conference. The only difference is Traders Conference is a week-long. Traders Summit is generally a day-long. But they've been supporting the events that we do for almost about, I want to say 6-7 months, maybe a little bit longer than that. They've been a really, really good sponsor. I love Tyler's presentations, and he's going to come in and talk for an hour about CMT. So that's why I wanted to kind of start with him. And here's a picture of Tyler. Let's go ahead and, without further ado, let's get him started. How are you doing, Tyler?
I'm doing very well, Jeff. How are you doing tonight?
Very good. Thanks for joining us. We've had a great day.
Excellent. This is such a fantastic conference, and you've got the world's top talent when it comes to trading education, technical analysis, and a lot of CMT charter holders I saw on the list. So
yes.
Happy to see.
You're doing the quiet talk. I can't hear you anymore.
Oh, you can't hear me anymore. How about now?
No, I can. You don't touch anything. It's working.
Good. So, but yeah, I really appreciate the invitation, Jeff. And I know it's the end of a long day of learning, so I'm not going to go over an hour. In fact, I'll do this in 45 minutes, and we'll keep it light and entertaining. And hopefully, I'll leave you guys with a lot of things that you could take home with you and add to further study. Maybe come back to this over the next couple of weeks. But just by way of introduction, want to make sure you can all see my screen. I'm here representing the CMT Association. It stands for Chartered Market Technicians. And this organization exists really for two purposes. We're an educational credentialing organization. We try to help people improve their investment decision-making and then also open up career opportunities in the field of technical analysis. So let's talk a little bit about how we got to that mission and how we got to where we are today. Organization is almost 50 years old. A lot of familiar names to those of you who've been around the block for a while. The men and women of Wall Street who actually created a lot of the indicators that you'll find on MetaStock and other charting platforms are the folks who founded this organization. And what was happening in the late 1960s, the go-go years of the investment world here in the United States, there was a lot of exuberant overconfidence amongst money managers. Not enough attention being paid to the risk management side. And so technical analysis really got an interesting sort of leg up in the business as we entered the 1970s and range-bound markets and all of that. We tend to grow when the markets are doing poorly. So huge growth right after the dot-com burst, huge participation in the CMT program after the great financial crisis. And of course, everybody was a genius in 2020 because anything you bought went up after the COVID crash. And this market has been a lot more difficult for people who are new to using technical analysis. So we exist in 137 countries around the globe. We've got over 65,000 folks who participate in our education, conferences, webinars, publications, you name it, who are just trying to understand the tools of technical analysis. So that's what we're going to talk about today. There's a lot that the CMT organization does beyond just the credentialing program. That's a mainstay of what we are here for. The institutional professionals who might manage your mutual fund or have created ETFs that you invest in. Those are CMT charter holders. Whenever you're out in the marketplace and you're talking to a financial advisor or a trading coach, you might want to look for that credential of excellence. It just attests to their mastery of the body of knowledge. You know you're getting somebody who's really dedicated themselves to the profession. But for all of you who are not seeking or aspiring a career on Wall Street, you should also check out the CMT Association, not right now, but after tonight's presentation, to check out all of the different educational opportunities that are there. One that I'll just highlight, it's a labor of love for me. Every month I get to co-host a podcast with David Lundgren, who's a 40-year veteran portfolio manager, some of the biggest funds up in Boston that you all know and love. And he and I get to interview the men and women of Wall Street and Bay Street and Dalal Street and folks from all over the world who use these tools. And it's really a fascinating fireside chat each month about their philosophy and their tools and their process. We really explore sort of what brought them to technical analysis. Many of them fundamental analysts by upbringing or by education, but they came to find a lot of value in their CMT. The other thing I would highlight, we just concluded our flagship event. Every year we host the CMT Symposium, predominantly for institutional money managers and research analysts at the big banks and hedge funds. But for those of you who are interested, there's replay content available from that. You'll find that at cmtassociation.org in the coming weeks. Okay, so what we're going to do today, I know you've already had 7 hours of content, but we're going to define what technical analysis is. And hopefully this will help you even as you're explaining to your friends and family or to your financial advisor what you want to see in terms of technical analysis. Then we're going to talk about 3 basic tools, really core concepts of the technical discipline, how that can help improve your decision making going forward. And then I'll share a little bit with you about the CMT program. For many of you who are new to the field of investing but are aspiring to a career in financial management or portfolio management, this might be a great path for your career. So let's dive right in. How to define technical analysis. It's really quite a large field of study, and I think a lot of people have developed these biases, or they think about technical analysis in one very niche lens. Just over the weekend, in fact, I was reading an article from Bloomberg News, and it cited a real critic of technical analysis, this woman from the Financial Times who had developed the vomiting camel asset management. And if you haven't seen all of the meme videos that she created, she's basically making fun of, oh yeah, it's just squiggly lines on the chart and people identify these patterns and it really leads nowhere. It's totally subjective. But what we're talking about when we talk about technical analysis is really the study of all the statistics and the big data that's coming from the market itself. And we didn't make that up. That goes back to Edwards and McGee. This is the Bible of technical analysis as we know it today, written in the 1940s. So for anybody who thinks, oh, technical analysis, that's like high frequency trading, right? This is like the new nonsense that happens in order execution. Not at all. This is the oldest game in town. Predates fundamental analysis by about 150 years. We also know that supply and demand is a big component of technical analysis. The great folks down at Lowry's Research have done a ton of work on what topping formations and bottoming natures look like in the marketplace as it relates to supply and demand for individual shares. We're going to talk a little bit about supply and demand in a minute, take you back to your Econ 101 class. And then the last thing that I want to point out is Perry Kaufman, who's one of the most featured authors in our CMT curriculum. And he talks about the systematic evaluation of price or volume or any market statistics for the purpose of price forecasting. And that's a word that needs a little caveat. We're not here to predict the future. What technical analysis does is it provides you the ability to react quickly and responsibly to what the market is telling you. We want to trade with probabilities on our side. We can look at historical corollaries, but we are not trying to predict the future. And anybody who tells you that they can predict the future, you can go ahead and run the other direction. But when we talk about systematic, I really want to point out this great quote from John Henry. This name might be familiar to you if you've read the book Moneyball or seen the movie. John Henry was actually a commodities trader, born on a soybean farm in southern Illinois. But he understood that with trend-following investment strategies, meaning quantifying what was happening with price and volume, he could systematize his rules. He could be very rules-based and have a repeatable process that led to profitability over time. So John Henry says that if you could take the emotion, the would be, could be, should be out of it, and then quantify what you're seeing, you'd have a big advantage over other human beings. And he's touching on some really key points. We're going to talk a lot about behavioral psychology. There have been a lot of Nobel laureates awarded in the last 20 years for their work discovering or basically explaining human psychology, which technical analysts have known about for hundreds of years. But when we talk about systematic investing, it means coming up with a rules-based approach. And so we're going to talk about some of the ways to do that today. We at the CMT Association came up with our own definition, and it's a long one, I warn you. We said that technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes through a disciplined, systematic approach to market behavior and the law of supply and demand. And I know that's a lot of words. As any technician will tell you, it's best explained in a picture. But where this comes from is the blog writings of Oscar Carboni. He's an NYU Stern School of Business professor and frequently cited in the curriculum for the CFA exam. So what is the predominant technical analysis body in the world citing such a fundamentally minded investor? Well, in his blog writings, he was very frustrated and he was sort of picking at why the market is so often wrong. So from a fundamental perspective, there's an estimate of what intrinsic value is. And the market can be way above, can price an asset way above or way below an estimate of intrinsic value. And so Oscar Carboni, Dr. Carboni was looking at what these other forces were that drove market price. Like I said, every technician under the sun will tell you that it's best explained in a picture rather than words. When I first joined the organization over 10 years ago, Ralph Akampora said, Tyler, if you're ever talking to people about technical analysis, make sure to show them this picture. And Ralph taught for 40 years at the New York Institute of Finance, basically taught everyone on Wall Street about technical analysis. And so in his lectures, he would use a chart of IBM. That was the mega cap value, the mega cap stock of the day. We're going to talk about Apple. And in the top half of this graphic, I want you to consider Apple, the company. There's some really important information to know about a company. For instance, their PE ratio, their competitors in the space, the management team, and whether or not they're very efficient or very inefficient at allocating capital across the firm to new projects. They might pay a dividend. That's important to know if you want to invest in the company. And they have products that are going to generate future cash flows, which are going to work their way into your DCF model, discounted cash flow model, to help you arrive at intrinsic value. Now, unless you are Warren Buffett or a private equity firm that's buying the whole company or investing over decades, you are only buying shares of that company. You're buying stock. And the stock often behaves very differently from the company. There's a whole other set of information that you need to understand if you're going to trade the stock. For instance, the price, perhaps the most important element of shares, the volume at which that trades, other information like open interest that the stock market provides. You want to understand supply and demand relationships, not just for that stock, but for the sector group that it's in, for the asset class as a whole. And then, of course, you need to understand the psychology of the market. Now, when I've given this presentation before, there's a wonderful crowd psychology, a candid camera video, but we don't have the copyright to share that with you today. So instead, I'm just going to talk to you for a second about some of those Nobel laureates that we were talking about. Well, the work of Daniel Kahneman and Amos Tversky, people like Sir John Templeton that talked about the fear and greed cycle of any bull and bear market. What they were trying to understand is that the human mind is not a purely rational investor. So in the fundamental world, they talk about efficiency of markets and that all information is available at the same time to all investors and that we would act in our rational mind. But unfortunately, those economic models don't really translate to human emotions. And what Kahneman and Tversky understood, and many other behavioral psychologists, was that we have evolved traits over thousands of years through human evolution, things that we cannot escape, mental shortcuts, if you will. So envision yourself on the plains of the Serengeti as a Neanderthal 15,000 years ago. You understood that it was safer to travel in the group so that you wouldn't get picked off by a saber-toothed tiger, right? Safety in numbers. Well, they call that the herding principle. And herding in a stock market means that we all pile into the same trending investment. If everybody owns Apple, then you better own Apple. And for money managers, professional money managers, it's career risk to not own Apple. Your clients are going to leave you and leave your fund if you don't. That herding principle, as technical analysts, we just call that price momentum or trends. And markets trend to the upside and they trend to the downside. And as news comes out and behaviors change, as we're getting somewhere in here with the fear, maybe even a little bit of panic or depression, maybe we haven't hit full capitulation yet, but we see more and more people as their portfolios are down 20, 30, 40, 60%. They're finally unloading all of those ARC stocks and high growth, long duration equities that were so popular through 2020 and 2021. But just haven't been working this year. And they're starting to pile themselves into oil and commodities more broadly. And so we're seeing those trends work their way to the upside. And those can pan out over long periods of time. Now, we also know things like support and resistance. These are technical terms. We know that there are areas on a price chart where things tend to bounce or get, they run into the ceiling. Well, the same behavioral psychologists talked about things like the anchoring bias. We call that support and resistance. And so we know that these cognitive psychologists have helped explain things that we've seen on the charts for years and years. All right, now I mentioned earlier I was going to take you back to your Econ 101 class. Let's talk a little bit about supply and demand. At a fixed rate of supply, an increase in demand is going to move up along this equilibrium, this supply curve, and increase the price, right? Price is set where supply meets demand. Think about the open outcry markets of the Chicago pits or the New York Stock Exchange years ago. Price was set by the market makers where they could find a buyer and a seller, where the bid met the ask. And that still happens today in the electronic formats that we all know and love. Now, what's important about supply and demand is that you might own an asset with much higher intrinsic value, but if nobody wants that right now, it doesn't matter what your fundamental thesis means. And just to help illustrate a few examples, how about AMC? It's a $6 stock that went to $250, right? Wall Street Bets created all of that greed and a huge crowd, a huge herd that piled in and piled in and piled in to break the backs of Melvin Capital and others. All right, beyond AMC, how about GameStop, right? Have you been into a GameStop store recently? Are there lines out the door? I don't think so. This is not intrinsic value. This is supply and demand. And then, of course, our beloved cryptocurrencies, just a long-term chart of Bitcoin. I remember 2017 at the Thanksgiving table, my Aunt Pam asking me about, what is a cryptocurrency, Tyler? And how much should I put in my retirement account? So at the end of the day, price is our most important indicator. That's the first thing we need to understand if we're going to understand technical analysis. And another great trend-following investment strategist, Mark Abraham, great money manager and incredible trader, said, ultimately, It is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, right? That's that supply and demand. That's the market psychology. And that consensus is revealed by analyzing price. All right. Very good. You're still with me. We're through the first section. Let's talk about some of these tools that can help you with your own investment decision making. Obviously, we've talked about price trends. We could talk all day long about moving averages and trend lines and how to draw them. Talk a lot about support and resistance. But instead today, I want to focus on relative strength, breadth, and divergence. Okay, 3 topics that you can put into your quiver, put into your toolbox, and use right away tomorrow with tomorrow's trading. So relative strength, let's dive in. What does that mean? This comes from Martin Pring, featured author in the CMT curriculum. He says that relative strength is a technical concept that measures the relationship between 2 securities. So it's comparative, right? We're not just looking at the absolute trend of a stock. We're looking at one security divided by the other. Now, relative strength can be used to better understand an intermarket relationship or across sectors, or just comparing holdings within your own portfolio. You can also compare securities against a benchmark. All right, so let's see this in practice. This is the market going into the 2020 COVID crash. We've got growth equities in the top panel. We've got value equities in the bottom panel. Now, just eyeball this with me for a second, right? Chart's going up, COVID collapse, chart goes back up. Okay, that's growth equities. How about value? Chart goes up, COVID crash, chart goes back up. So they're the same, right? Growth, value, doesn't matter. Own both, own either. Own all value, own zero growth. How do we know which one is better? Well, we can look at relative strength between the 2, and that's this third line, this red line. So consider on a relative basis what's happening when growth equities divided by value equities, when this relative strength line is going up, right? On an absolute basis, both are tanking. In February of 2020, COVID collapse, world is shutting down, go buy bullets and canned corn, it's the end of the world, zombie apocalypse, whatever the headlines were saying. But we knew that growth equities, these are the names in the technology, communications, discretionary sector, growth equities were outperforming value through the collapse. That's the rising line. And then when we head into 2021, we've got this period in February and again in May where there was a big jump in the interest rate markets. And there you saw value outperform growth. That's the relative strength line decreasing, right? So right here and right here. That relative performance, obviously, as we get into 2022, this red line tanks off the right side of the map. It's been in all value, all cyclical or defensive sectors, things like energy, building materials, industrials, even some play to the financials, consumer staples, utilities. These have been outperforming in 2022 as we've rotated away from growth equities and into the value space. So technical analysis allows you to compare assets. And when you think about trying to beat a benchmark, maybe your goal is, I want to manage my own money and I want better returns than the S&P 500. Well, some would say it's mathematically impossible to beat your benchmark unless you own securities that are beating the benchmark. So you might want to take a look at your own holdings in your portfolio against the S&P 500. So if you've got 20 stocks in your holdings, how are they doing compared to the S&P overall? Are you owning the leadership? And if not, let's get you involved in the leading sectors, the leading stocks within those sectors. Relative strength is a very powerful tool. And I know for any professional money manager out there, they are very focused on relative performance. So if the market is down 30% and their portfolio is down 3%, they're going home a hero and their clients love them because they protected capital. All right. So now we all understand relative strength. We can use technicals to compare across assets. Well, now let's talk about breadth. And this definition comes from Perry Kaufman, again, frequently cited throughout the CMT curriculum, really fantastic researcher and money manager himself. Perry says that breadth measures the imbalance between advancing and declining stocks. A net increase in the index with while more issues are declining, should generate concern that the upwards move is poorly supported. Okay, That's academic lingo for the fact that if we're sending a team to the championship game, we want to make sure they've got really deep bench strength. All right, sorry for the sports analogies. For those of you who don't follow sports, we want to make sure that every player on the field is really participating in helping win that championship, right? We can't do it on the backs of just a few. So breadth is an important understanding of what market internals are telling us, right? Is it a stock market, or is it a marketplace of stocks? And can we look across all of those that are participating in the upward move? So again, using 2020's COVID crash as a great case study, if we're looking at IWM, that's the Russell 2000 small cap equities, as we are moving up into February of 2020, we see breadth as determined by the advanced decline line. There are many other measures of breadth, but we'll just talk about the AD line for a second. As we're moving into February of 2020, we see increases in breadth, meaning more stocks in the Russell 2000 are participating in that upward move. However, ahead of the collapse, again, these two red arrows line up. Well ahead of the price collapse, we saw many holdings within the Russell 2000 begin to decline. So they were not participating in that penultimate price advance ahead of the COVID collapse, which gives us a leading indication that there is trouble. There is something brewing under the hood of the index. So if you just look at S&P, NASDAQ, Russell, you miss what's happening in broad leadership or narrow leadership. All right, COVID collapse, we see a positive divergence here as the price starts to pull back up. These two green arrows line up. We see more participation amongst the Russell 2000. Breadth is improving. Now, this range-bound mess that we had in the fall of 2021 really caught a lot of folks off guard because we had basically a head fake. We moved out of this range and then quickly collapsed below. This AD line, right, we showed improving breadth, right? There's rotation in the marketplace as price was range-bound. It was shifting through all of those as more and more securities were participating to the upside. And then breadth collapsed, and so did the entire Russell 2000. Coming into 2022, this has been a really tough game to be involved in. Small caps have not fared well. So breadth gives us an understanding of whether or not the market leadership is broad-based or very narrow. 2020 was a really fascinating year for many market participants because the index continued to climb, talking about the S&P 500, on the backs of just a very few names, a massive influx of new traders, new investors who really were just holding the most familiar FANG names. They wanted to have a piece of Facebook, Apple, Google, Netflix, and obviously that narrow leadership did not play out well for the marketplace. All right, third and final lesson for today, one more tool that you could take with you. We're going to talk about momentum as the example for divergence. But first, we got to understand what we mean about divergence, right? Price is key, but other indicators or calculations made as derivatives from price, volume, breadth, etc., can be used to identify important market action and to help you separate signal from noise. What that definition means is that we can look to our other suite of tools, other indicators, to give us a preview, either a confirmation or a divergence from what price is telling us. Obviously, price that is confirmed with strong momentum, great breadth, confirming on volume, we want to really participate in those uptrends. And technical analysts are going to use a variety of different indicators, hopefully not all at once, but a variety of different indicators to help us understand what's happening with those market internals. All right, let's talk about momentum for a second. And I'm actually going to pull from a future presentation for those of you who are going to be with us on Thursday afternoon. I'm also the co-founder of Go No Go Charts, and so Alex Cole and I are going to talk a lot more about trend following investment strategies. Alex has been involved with the CMT Association for well over a decade as well, and also instructs. He's the lead subject matter expert for the CMT prep classes produced by Wiley. But he talks about price momentum in terms of rally cars, right? The rate of increase is what we want to understand, the rate of change in price. And that's going to help us understand the strength of a price move, right? So these are derivatives of price. But if we think in terms of acceleration, our car would leave the starting line, moving from 0 to 10 miles an hour, 10 to 20 miles an hour, 20 to 30 miles an hour, 40, 45, 48, 48 to 50, right? We are continuing to increase our pace, but at a slower rate of change. Instead of 10 miles per hour, it's 5, then 3, then 2. Okay. So to see that graphically, right? Acceleration is something we can think about in terms of momentum, right? Our price may still be gaining, but it's gaining at a slower rate, and there are fewer participants in that buying herd. Okay. All right. So now that we have an understanding of momentum, let's take a look at a MetaStock chart. Here we've got, again, I think these are, what did I put in this chart? Growth equities. And on the bottom panel, we've got RSI. So we're looking at the price gains and we're looking at the momentum, the participation of the crowd. So here's overbought momentum, right? Strong upside participation. Here's extreme oversold momentum, strong downside participation. But what we're looking at right here are major divergences. Price continues to make new highs, 1, 2, 3, 4 new highs. Each time price makes a new high, we have a lower high in momentum. That's the divergence, right? Momentum is not confirming price. At these higher and higher levels, we have fewer participants buying shares at that level. That gives us a leading indicator that this move cannot be sustained. Now, that might mean a small consolidation before momentum resurges in the direction of the trend. That's the buy the dip moment. But what it's telling us right here on the chart, imagine you can't see the right side of the screen, is just that we're going to exercise caution. We're going to be focused on risk management as that divergence plays out, right? It wouldn't have made sense to exit the trade at that first point of divergence or the second, but at this third, we want to see here that our rules are being broken from a trend perspective, and momentum moving negative. That's our chance to get out. Works in the opposite, right? So the principle of polarity is that a lot of technical concepts work in the inverse. So a divergence, a negative divergence or a bearish divergence when price is moving higher. We can also see a bullish divergence as we reach this bottoming pattern. Price makes a new low, while the RSI momentum indicator makes a higher low. So there are fewer participants to the downside, fewer sellers, if you will, at this lower price point. That positive divergence then leads to a resurgence in price. Okay, well done, family. Thanks for sticking with me. That's 3 tools you can use in your trading beginning right away tomorrow. The other piece that I want to talk about that the CMT program spends a ton of time on is really in the context of portfolio management. So it's not just managing your individual trade, but thinking about your entire trading discipline. So there's finding the right trade, asset selection, security selection, but then there's also managing the risk. And in a portfolio, we have to think about the expectancy formula. We have to think about our trading plan more holistically. We spend a lot of time in the CMT program, obviously focusing down here on picking more winning trades. But we also need to understand up here, the profit ratio is going to dictate how profitable we are over time. So what this expectancy formula is showing us, this curve right here, is our break-even trading systems. So right here on this dark blue dot, we're only picking winners 50% of the time. That means half of the trades that we choose are losers, right? They didn't work out the way that we thought they would. But if we close those positions quickly, if we get out, if we manage our risk responsibly and let those winning trades really carry us, 2-to-1 profit ratio on our winning trades, we can be profitable over time. And this is the efficient frontier. All trading systems further out to this upper right quadrant are going to be more and more profitable. So if you can find an edge in selecting securities correctly, and you can stick with trends for the meat of the move to capture the bulk of that gain and get large outsized winners, cutting your losers short. That's where the most profitable trading strategies come from. Now, this gets back to this behavioral psychology point that we were talking about earlier, right? John Henry says you need to quantify what you're doing, make it systematic, repeat it, and take all of your emotions out of it. for me and for you, for most people involved in the markets, we tend to hold on to losing trades. We do not want to admit that we were wrong when we selected a trade, and we hold on to it long after we should have exited the position. Same thing with our winners. We exit them way too quickly because we want to recognize that gain, recognize that we were right, lock in that profit, and maybe you capture that first 5% of the move. Well, what about the next 50% move, right? So we have to be patient investors, and we have to develop trading systems and strategies that are repeatable and that manage risk responsibly. Now, I learned a lot of this from the president of the CMT Association. Back when I first started, David Keller was the managing director of technical research at Fidelity Investments. So again, big institutional mutual fund manager. He was also learning to fly a plane at the same time. And Dave told lots of stories about spending so much time on the tarmac with the flight instructor, going over checklist after checklist after checklist. But what he learned was that before you put that plane up in the sky, before you're 10,000 feet above the ground in a little tin can, you need to have your checklist, because the flight instructor is going to kill the engine, which is terrifying, as Dave tells me. The plane noses down and you panic and you forget all of the simple stuff. And without that checklist, you would be making very silly mistakes, potentially life-threatening ones, right? We want to check if the fuel gauge just got pushed in, or maybe your knee kicked the key out of the ignition. It could be something that simple, but most importantly, we have a plan in place about what to do when something happens. So the same thing is true for technical analysis, right? When we are trading, we want to have our plan lined up ahead of time before we get into the markets. We're going to look at things like trend lines and moving averages. We're going to do our checklist of support and resistance levels. We're going to look for confirmation from other indicators like volume and momentum. We might even consider Dow theory, multiple time frame analysis, and then of course paying attention to volatility. When our rules are broken, when the trend is over, we get out, regardless of whether that happens 2 seconds after we place the trade or 2 years after we place the trade. Your time frame is up to you. Your risk tolerance is up to you. Those are personal matters. But the idea of having a checklist and a routine is something that everybody should think about adopting. I want to share this chart. Alex and I use this in all of our Go No Go presentations as well. When I first started, Ralph told a story about going onto the trading floor at a new firm. They'd hired him as his chief market strategist, and he came across the trading floor, and there was a young guy who had like 6 vertical monitors, and every chart had 100 panels and lines going everywhere. And Ralph leaned over and he said, "Son, I have never seen technical analysis done like that. This is amazing. What are you looking for?" And the kid looked up at him and said, "Sir, please don't tell my boss. I have no idea what any of this means, but he thinks I'm a genius. He thinks I'm working so hard." And that is the pitfall that I think a lot of folks get caught up with, which is that searching for a silver bullet, trying to find the combination of 100 different indicators that'll give you a clear signal. Well, what's clear about this? You can't even see the price panel at the top. We can't even identify any areas of support and resistance. We can't do any classical technical analysis, and we miss some of the most important information that the market is giving us because we've overloaded our chart and we've caused analysis paralysis. So please be my friend, be Ralph's friend. Do not do that to your charts. Pick a couple of tools in your checklist that will work for you, that give you a complete technical picture. But again, you don't need 12 different momentum oscillators. All right, I have to talk about the original technician in this country anyway, Charles Dow. He's the father of the Wall Street Journal. Great technical analyst, but obviously brought up in a time where fundamentals were pretty key. He created the Dow Jones indices, the transportation, industrial averages, but he also talked about how markets trended. Sorry, I'll back that up one line. And he was a very nautical man. He said, the primary trend of the market is like the tides of the ocean. This is unflappable, unchanging. And it's driven by long-term macroeconomic GDP expansion, the underlying fundamentals of the economy. And that trend, whether to the upside or to the downside, right? We have an expanding or contracting economy. We're in a recession or an expansionary environment. You have to understand that primary trend in order to trade with the underlying bias of the market. Then he said the secondary trend, this might be weeks to months, but that's largely the reaction of the marketplace to information about the underlying fundamentals. Remember, companies are only reporting once a quarter. Macroeconomic data at best is coming out monthly, but oftentimes with a 3-month lag, as the economists calculate. So that is lagging information, but we can get up-to-date, to-the-minute information about the reaction of the crowd to that information. Technical analysts have long understood that trading with that secondary period can be very, very profitable because they understand the underlying bias of the market, and they're able to pick these spots that are well depressed below the underlying trend and then carry them through extension. And finally, the minor trend, or the third period, he talked about being the ripples on the surface of the water, and that those were really quite short-lived and could be easily manipulated by any news event. So for you, picking your time period is totally a personal decision. Many of you may trade intraday. You might be looking at 5-minute charts or 1-minute bars. That's great. That's the periodicity that you found success trading in. What I would encourage you to do is to think out a couple of time frames as well. Maybe you look at daily charts to get an understanding of the underlying trend of the market right now, and then look to your intraday charts to find those mean reverting moves. That is a repeatable process and a core concept of all technical analysts. All right, here we are. It's 6:43. We've got about 10 minutes left. I'm going to let you go early, but I wanted to talk to you just a little bit about the CMT program for those of you who are interested in pursuing a career in finance. Excuse me. So we've talked a little bit about systematic and repeatable. Quantitative and algorithmic are names that get thrown around a lot. These are really just extensions of how you can apply technical tools. For those of you who don't think you're technical analysts because you run an algo, think about what those underlying principles or those first principles of the market are that allow you to create those algorithms. We have a lot of CMT charter holders who are extremely quantitative and algorithmic in their approach. They're coding more than they are charting, but they're still technical analysts at the core because they're using those concepts. So as we talked about, the CMT program is really covering those 4 key areas of risk management, systems development or repeatable processes, all in a portfolio management context, and then considering the applications of behavioral finance that can really help you understand when the market is irrational, but also your own biases and trying to unpin yourself from those mental shortcuts. So what is it? What is the CMT program? Well, it's a series of exams, 3 levels. They are completed in sequence. So you take level 1, then level 2, then level 3. You cannot take more than 1 per cycle, and we do offer all 3 levels only twice a year. So the next exam cycle is going to be this June, followed by December of 2022. Now, the reason most folks are looking at the CMT program is that it's the preeminent global designation for practitioners of technical analysis. So if you are a newsletter writer, or you are hosting a trading room, or you are advising clients, or you are a professional money manager, or you are developing an indicator to sell on MetaStock, the CMT program may be a very helpful tool and a very powerful designation for your career. I get asked to quantify that all the time, so let's do it. We do survey our members all the time, and our friends in the marketing department made this cool little infographic. About 1 year after receiving their CMT, how many of our members received promotions, new positions, more responsibility, contact from recruiters, salaries and bonuses, the list goes on. But I want to draw your attention to this more responsibility. Over half of those who received their CMT reported greater AUM a year later, more assets under management in their funds a year after receiving their CMT, which tells us that there is a lot of inherent trust and belief in both from their firms as well as clients that what they have mastered is going to be beneficial to the long-term outcomes and the profitability of their funds. So we know that the CMT holds a lot of weight with investment firms across the financial services industry, but also with clients who are looking for somebody with a better risk management track record and a better ability to capture trends, to generate alpha, to outperform the benchmark. And of course, the CMT program is a very well-structured form of study for technical analysis. For a long time, folks learned technical analysis on the job, on the trading desk, on the floor of the Chicago Board's options exchange. And now there is a structured way to study the craft. Many university students ask me, okay, so if I get a CMT, like what's the career path? And the fact is, it's widespread. This little pie chart shows you that there's no one concentration. There are analysts, there are portfolio managers, there are client advisors, there are algo developers, there are individual investors, and many others that have the CMT charter. And I think that going with that acronym, Chartered Market Technician, really has changed the face of what the organization first started as. They were all New York-based equity sell-side analysts, meaning they all wrote research for a big bank and only looked at the equity space. Now we have commercial hedgers, and we have crypto traders, and we have algo developers, and we have folks all over the apparatus of the industry. And that really is a testament to all of the growth from the CMT Association and really much wider acceptance of technical analysis throughout the industry. There are a number of changes. So for those of you who've seen this presentation before, you've known about the CMT program for years, this might be new to you. We have changed a number of structural things, including no longer requiring any membership in the CMT Association in order to sit for the exams. And that was long-standing bylaws. We started as a membership organization and then introduced the CMT program. So everyone was a member before they sat for the exams. Now we've reversed that. You can sit for the exams at any point, whether you're a 20-year career veteran or you're just getting started in the industry. The exams are open to all. There are no prerequisite requirements. You don't have to take classes from us or have an undergraduate degree in business in order to sit for the exams. They're really open to everybody because we know that passing the exams is a big step towards job placement on Wall Street. We also offer remote proctoring. I'll talk about that in just a second. It's going to be with us long after the COVID pandemic is over. I wanted to talk about the curriculum, which is published by Wiley. And then, of course, we have an academic partner program. So for any of you who are college and university students who are listening today, or perhaps you're even professors at business schools around the world, by all means, reach out to us. You can email me directly. I'll get you set up with some scholarships and some resources. So real quickly, the remote proctoring is just that. We have test centers all over the globe, every major financial center, all major cities around the world, offered by Prometric. They're our testing partner, and they have really uniform, high security, high stakes testing centers around the world. And why that's important is that whether you're in Mumbai or Memphis, we want the testing environment to be exactly the same. And we take exam security very seriously. So in the pandemic, when all of those test centers were shut, we actually worked with Prometric and a couple of other vendors, and we developed a way to deliver a live proctored exam with another human being directly in the comfort of your home or office. So whether it's a tidal wave or another round of COVID problems, we can administer that exam wherever you are at, remotely and safely. So check out more information about that on our site. I mentioned the curriculum. It used to be that you studied a stack of books and you had a few chapters from each of them. We've consolidated all of that for a much more efficient path of study. And that's available from Wiley, that's our publishing partner. You can go to efficientlearning.com. And even if you're not ready to sit for the exams, I encourage you to pick up a copy of the Level 1 curriculum because it's a wonderful digest of a lot of the introductory material. It covers a broad understanding, much more beyond the 3 tools we talked about today, but really just to give you a basis of understanding for technical analysis. And the friends at Wiley said to give you guys a 30% discount on that curriculum. CMTTW30 is your discount code. Again, you can always email me after this and I'll help you out. As well, we have partnered with the CFA Institute. For any of you who are CFA charter holders, you can start your testing in the CMT program at level 2. And the reason we've done that is there was a growing body of dual charter holders, folks who were fundamental in their initial approach, who came to the technical view on the markets, money managers, analysts, financial advisors, you name it. And so there's a lot of testimonials. If you're interested in understanding how those two disciplines can work together, There's a lot more information on our website, cmtassociation.org/CFA waiver. So check those out. And I'll close here. For everybody who's a technician, you know you want to get in on a trend early. And this is about the most bullish I've seen this chart. We continue to drive towards all-time highs in the program, expanding worldwide. And it looks like a breakout of a pennant in my view. So if you want to get started, you can enroll in the CMT program, schedule your exam. The next dates are going to be this June, or you can wait until December. Schedule your exam with Prometric, and then work out your career as a technical analyst and a CMT charter holder. Jeff, that's what I brought with me tonight. Oh, I should also add, you can save $100 on registration for those CMT exams if you're interested in sitting for June. Thank you guys so much for having me. I really appreciate being a part of these MetaStock conferences, because it's really, core to the mission of what the CMT Association stands for, which is education, getting together with like-minded individuals, talking about what's working and what's not working in the marketplace, sharing ideas, and hopefully helping everybody achieve better results. So thanks so much for being with me tonight. I promised to let you out a little early, but I'm happy to take any questions if there are any.
We do have one.
Okay.
The first one, we're getting a lot of spam on our YouTube channel, but between these sexy adult dating sites, Mike wanted to know if there's a Canadian CMT affiliate.
Yes, of course. Well, Mike, we're happy to have you. We have members all over the world, including Canada. And interestingly, the Canadian Society of Technical Analysts has been a long-standing partner of the CMT Association for over 20 years, and we're actually we're getting a lot closer now. So they're going to be a part of CMT Association officially, and we'll have a lot more information coming about that. But if you're in Canada, I'd be more than happy to introduce you to a number of the other Canadian CMTs, and we've got a lot of really exciting programming and events coming out this summer and this fall.
All right. One more question. What was the PC? I wanted to know, what is the momentum indicator you're using?
Oh, well, there are many. What I put up on this chart when we were talking about divergence, this lower panel is just RSI. Now, to be confused with relative strength, this is the relative strength index, so a momentum indicator, not a comparative study. But RSI is a great momentum indicator. MACD is a popular one, and one that I've used for a long time that gives you a little understanding of trend and momentum.
All right, cool. And let's put up the website one last time. That's all the questions we've got. So
awesome.
Great job. It's always entertaining to watch you present. Thanks for CMTAssociation.org is where you want to go.
CMTAssociation.org. And if you want to get a hold of me personally, I'm on Twitter, T-Bone Pickens, or you can email me, Tyler@CMTAssociation.org. I have to apologize, Jeff. I am fighting a little bit of bronchitis. I made it through almost the whole presentation without a cough, but it's been a hectic 6 weeks on the road.
If you would not have told me, I would not have guessed.
Oh,
it came across that well.
Good.
Hopefully you feel good, because you're coming back in a couple of days. So hopefully you're feeling all better by then. So
I will be all better by Thursday for sure.
Take that vitamin C with rose hips.
Absolutely.
All right.
Thank you again,
Thank you
Jeff.
very much. Thanks, Tyler. Great job.
I'll see you again real soon. Cheers.
Okay. Let me do this real quick. I want to talk about tomorrow a little bit. Give you guys something to look forward to. All right. Let me go ahead and make myself the presenter as well while we're doing it. Okay. And show my screen and hide this. I want to just talk about, I hope you enjoyed today. I thought all of the presenters did a really, really good job and very, very impressive. I hope you come back tomorrow, because we have another great roster of people coming in. We're going to start with Vince Fora. He's going to pick us up and show us how to find powerful trades in inflationary markets. Ed Downs is also speaking. The one and only Kelly Clement, right behind me. He runs the control room. He's going to come in and talk to you about the Rahul Mohindra oscillator and how you can use it to find good trades. We've got Serge Berger, Mark Leibovit and his volume reversal triggers, Silas Peters, Marina The Trader Chick is going to be here, and Sunny Harris. So we have another outstanding 8 hours of free content for you tomorrow. If you watch this on YouTube and you want to join, you want to be eligible to get some of the drawings and kind of all that kind of stuff that we're doing, just come in here to basically metastock.com/traders-conference. And I'm pretty sure a link is going to show up in the YouTube over here pretty soon. So we look forward. We're going to be running this event all week. I thought we are off to a good start. I hope you agree. So I hope to see you tomorrow as well. I do want to say thank you real quick to Technical Analysis of Stocks and Commodities for being awesome sponsors. If you do any of the offers today, any of the MetaStock offers today, you're going to get a free 5-month subscription to Stocks and Commodities magazine. Great magazine, great people, good to work with. If you do $300, if you buy any add-on that's worth $300 or more, they're going to give you 2 years subscription. Then we're not paying for that. They're actually providing it to you free of charge. They've been so excellent for sponsoring these events for so long. We really appreciate it. Also, CMT Association, great association, as you just saw with Tyler's speech. Thank you for being a sponsor of the event. We do appreciate that as well. And of course, MetaStock. Give us a call. Right now it's a really good time. We're going to go ahead and kind of break for today. We'll be back tomorrow, but you can get that MetaStock extended trial. We're going to have people here for as long as we need to. 800-882-3040. If you want to chat with it, call Ellis. If you have any questions, Ellis is the sales guy right now. If you have any questions about anything that we did today or any of that kind of stuff, give us a call. 800-882-3040. You can also go online and chat with him at metastock.com/sales chat. So I do want to say thank you for coming. I hope you had a great day. I thought that was awesome. I hope you enjoyed it, and I'll see you tomorrow.